wage growth decelerate, I think that's the number to watch rather than the jobs number, which that 20,000 was for. That's not even close to the revisions we've seen coming out of these numbers before. But if you look at wage growth, it's been a steady decline. That's great, but it's likely to stay inconsistently higher with 2% inflation. And that is the rub for the Fed. All the numbers are moving in the right direction, but they're not moving fast enough back to that 2% target.
Yeah, Laura, how quickly do you think that the Fed can reverse course? I mean, I know it depends on the strength of the economy, it depends on energy prices, but like, do you push it back?
So at this point, we are penciling in a Q3 rate cut next year. And I think the crucial thing is that in the near term, markets have priced out the next rate hike if we do see a strong print come in today. So there is scope for the move that we have seen in yields to extend and even reverse more of this bull steepening rather than the bear steepening. And I think that's really crucial to watch for around the next recessionary indicator, because timing that downturn has really been the most challenge facing strategists and commentators.
All right. So thank you both for joining us. Neela Richardson, Chief Economist at ADP, Laura Cooper, Senior Investment Strategist at BlackRock. Both stay with us. Also, Bloomberg has learned that ExxonMobil is in talks to acquire the shale-focused Pioneer Natural Resources. Now, the deal is huge because it's worth some $60 billion, potentially the largest acquisition of the year. It would make Exxon the top producer in the most prolific U.S. oil basin, talking shale oil. It would also make one of the largest oil companies in the world even bigger. Now, pre-market trade, Pioneer, you can see 10% higher, Exxon down 2%. Much more ahead, and this is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there.
The Fed Bank of San Francisco President Mary Daly there saying policymakers can hold interest rates steady if the labor market and inflation continue to cool or financial conditions remain tight. Now we're back with Neela Richardson, Chief Economist at ADP, and Laura Cooper, Senior Investment Strategist at BlackRock. Okay, so the treasuries are all over the place. Do you buy anything right now? We also had a story yesterday saying issuance in 2024 may be tricky because there's just so much of it.
And the issuance next year is one of the key reasons why we're not extending duration in our positioning. And if anything, yes, we saw the term premium, as I mentioned, about 30 basis points for that 10-year tenor. Back in 2021, we saw about 3 months of that where it's close to that peak, and then we saw this renewed bids and a sharp compression. But we don't think that's going to be the dynamic this time around. So instead, we are seeking short duration exposures in treasuries. But there's more opportunity, we think, if we look, for example, real rates. The fact, we think that's quite an attractive opportunity, given this is an environment where U.S. economic growth is slowing. But it's about looking for opportunities elsewhere. So looking at the European bond space, which has really been caught up in the spillover effects of the Treasury sell-off, we think at these entry levels, it's quite attractive because the growth and inflation dynamics are materially different than what we are seeing in the U.S.
Yeah, interesting. And we've had some really big moves also in Europe. Now, when you look at 6 weeks ago, I think it was all about China and concerns about China and the slowdown in China, what that means for the rest of the world. Now we're focusing on the U.S. But globally, what do you worry most about?
That inflation, even if we get it back down to a more comfortable number for all of these global central banks, that it's not going back to where we were before the pandemic, 10 years of slumber. That these central banks, no matter where in the world they are, they have to be much more careful about inflation and its effect on growth. And so it's not just a one-year story going forward. This is a multi-year, probably through the next decade. If you look at labor shortages in advanced countries, if you look at a hopefully growing China and the geopolitical concerns that leads to higher inflation or higher oil prices, all of that adds up to a different picture for the global economy structurally than we saw before the pandemic.
But if you look at, I guess, supply chains, but also this was started under the presidency of Donald Trump, right? The fact that a lot of the supply chain changed because he moved away from China. Are we there, or is there still quite a lot of deglobalization or de-unpacking to do?
I think we're seeing a reshuffling of supply chains, trying to produce the resiliency that won't be disrupted by events around the world, but that resiliency comes at a cost, and that cost could be higher prices, which feeds inflation. So definitely a different type of supply chain policy or strategy for companies going forward.
Anything else, Laura, that you like? I don't know whether you're looking at. I mean, yen also gave us a little bit of a scare, a bit of attention this week.
So in the equity space, I mean, we do still like Japanese equities because we are seeing this inflationary regime shift there as well. But we are taking a more selective and granular approach if we look at U.S. and European equities. So we think tech leadership can persist. We've seen 3-month earning revisions become quite strong. That's an area that has those defensive properties, but as well more of that pricing power in this inflationary environment. And in Europe, it's about looking for those industries that, yes, they can be cyclical in nature, but they're not necessarily acting cyclically. So energy, for example, we think is supported by supply-demand dynamics, and as well industrials, given where we are in the decarbonization cycle and the capital expenditures that we do expect going forward from the transition.
Thank you both. That was really, really fun joining you. Actually, also, even if it was a pretty big news week. Laura Cooper from BlackRock and Naila Richardson from ADP. Now, coming up, Bloomberg understands that Exxon is in talks to secure what could be one of the year's biggest deals, so we'll have the details next. And this is Bloomberg.
say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
More on the story we told you a little bit about earlier. Bloomberg learning that ExxonMobil is in talks to acquire shale-focused Pioneer Natural Resources in a deal worth as much as $60 billion. Now, it's potentially the largest acquisition of the year. You can see pre-market, Pioneer gaining 10%, Exxon down 2%. Now, joining us is Bloomberg's oil and gas reporter, Laura Hurst. Laura, this is huge. Thank you so much for coming in. I mean, this is worth like $60 billion. What's the logic behind a deal like that, and how does it actually fit with the Exxon strategy?
Well, Exxon has been on the lookout for deals in the Permian, which is that shale basin in the US. And so they just haven't had the right timing because of the coronavirus pandemic. But what that allowed it to do is cut costs severely. So now it's got a lot of cash, oil is back up, and it's a good time for them to buy.
I mean, we used to talk. I feel like every couple of months we talk about oil at $100. Is it now more or less likely?
Well, there was a lot of talk about that earlier this week when OPEC Plus scaled back production. But that sort of had a bit of an adverse reaction in that products, gasoline, consumption has started to go down. And there's talk about demand destruction as a result. So it might have not had the intended consequences from OPEC Plus.
Laura, Shell. So Shell is higher this morning. The company said that earnings from its gas trading rebounded in the third quarter. The new chief executive is not without controversy because he's also just bluntly saying, look, they want to be less green. So how's that playing out with shareholders?
Yeah, so it's a mixed bag. Of course, you've got environmentalists and more green-minded investors who don't really like the change. But then there are a lot of them like Dan Lode, the activist investor at Third Point, who's saying the company is doing great, they're focusing on returns, and that's what we really need right now.
So what are you focusing a lot of your reporting on? Again, there's OPEC Plus, there's this mega deal with Exxon and others. Do you think there's going to be more M&A, or is it just a retrenching? I guess everything goes back to the fact that we just don't have enough resources for what we want to do.
Well, certainly there is a lot of opportunity now for the oil majors because they have a lot of cash. They've cut their costs down a lot. Yeah. And as the war in Ukraine has shown, there's still a very big need for oil and gas. So there's a lot of talk of is this the time to now go back, increase production, increase reserves, rather than explore for oil, which takes time and is very costly.
Laura, thank you so much for joining us. Laura Hurst there, our Bloomberg oil and gas reporter. Now, some of the other news that we're watching, Russia lifting the diesel export ban that has roiled global markets. That's according to a government statement. Now, weeks after imposing the block, shipments can resume, provided that the fuel is delivered to Russia's ports by pipeline. Moscow did impose the ban after surging domestic fuel costs drove up inflation. Now, the U.S. Securities and Exchange Commission wants to force Elon Musk to testify as it investigates his purchase of Twitter shares before taking over the social media platform. Now, the Wall Street regulator said Musk failed to appear to testify last month as requested. Before acquiring all of Twitter, Musk first purchased a 9.2% stake in March last year and disclosed it the following month. While the SEC's rules require most people who buy more than 5% of a public company to disclose it within 10 days. And FTX co-founder Gary Wang has taken the stand at Sam Bankman-Fried's trial, saying immediately that he and his former childhood friend and MIT roommate committed to a multi-billion-dollar fraud. Now, Wang is cooperating with prosecutors after pleading guilty to fraud. His testimony promises to be among the most powerful in the government case against Bankman-Fried, who has pleaded not guilty. Coming up, Perry Warrijo, the Indonesian central bank governor, joins us here for an exclusive conversation. That's coming up shortly, and this is Bloomberg.
Obviously, we're trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
Traders prepare for a U.S. payroll print forecast to show hiring slowed last month, while the Fed's Mary Daly says rates can hold steady if the labor market continues to cool. We're live from Granada, Spain, where EU leaders will be laying the ground for the bloc's strategic agenda. The Ukrainian President Volodymyr Zelensky urges them to stay united in the face of Russian aggression. Plus, Bloomberg has learned that Exxon is in talks to acquire the shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals this year. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Indonesia's foreign reserves have fallen by over $2 billion to a 10-month low. This comes as the central bank intervened to stabilize the rupiah and the government repaid external debt. Well, with us now is Bank of of Indonesia. Governor, he's Perry Wadijo. And thank you, Governor, for joining us for a robust conversation on how difficult it is to set monetary policy right now. How quickly can you cut interest rates?
Well, we have to hold our policy rates for a while, not because of Indonesian inflation, which is very low. We need to support good because of the global spillover, which is because uncertainty and the Fed fund rate increase and the pressure of very strong dollar. So we need to wait that.
But, Governor, what's a while? Is it the first half, the second half of next year? How difficult is it at this point to try and calibrate when the move down could come?
Well, in this very difficult, uncertain world, for instance, I have the idea. But of course, the data dependent of the global is very important. How the Fed fund, whether this November will be the last one, whether U.S. Treasury will be decelerating, and how the dollar will be declining from 106 to 100 and so on. All of them are depend on that.
And you said in the past, actually, that you don't need to match Fed rate hikes. And what you're explaining is extremely important, is that you have an idea, but then you have all of these things that could come and hurt that idea. What's your biggest concern that would make you come off plan, the plan that you have in your head right now?
Well, every country in the world must protect their domestic inflation, price stability, and financial stability against the impact of dollar strength, yield increase, as well as the uncertainty unfolding in the U.S. The best way to do that, policy rate directly to domestic, while for addressing spillover, adjusting the yield of the government bond vis-a-vis U.S. Treasury yield. This is what we are doing, not only intervening in the FX market, but also selling our Bank Indonesia Rupiah certificate.
So how effective actually has that new Rupiah securities, for example, been in attracting inflows?
Well, it was working quite nicely until the last 2 weeks when dollar 106, when UK pound depreciating, when yen depreciating, then there is outflow again. But I'm sure when this uncertainty coming down, then investor will be coming back again.
But so, Governor, are you thinking and actually close to doing, for example, FX denominated securities? Would that help in stabilizing?
Yes.
Is it something that you're considering actively?
Yes, we are in the process of developing that. FX Bank Indonesia securities, Rupiah Bank Indonesia securities, but also FX swap, domestic non-delivery forward. So investor can have different variety of instrument. This actually will attract portfolio inflows. At least do not making the outflow becoming worse.
So, Governor, and I know, for the SRBI securities, you're saying that they were working quite well until a couple of weeks ago when you had that bout of volatility.
Yes.
Do you worry that because they're short in nature, they actually exacerbate the volatility?
I do not think so, because we are coordinated closely with Minister of Finance. Fiscal is about longer term yield, 10 years, and beyond. Our securities for the short-term liquidity, this actually creating liquidity, also building market mechanism in the domestic yield as well as domestic rupiah vis-a-vis dollar. This is actually adding even more efficient market.
But your biggest concern is that you're now going to import inflation, weaker rupiah, higher energy prices.
Yeah.
This is concerning.
This is actually our objective of stabilizing exchange rate. Not targeting the exchange rate, but minimizing the volatility of the exchange rate and their impact to the imported inflation. So what we addressing, for instance, is imported inflation. Because otherwise, if imported inflation high, inflation rising, then I have to address with interest rate. This is cutting the global spillover to not, going into the domestic problem.
But so, given all the uncertainty with the Fed, how much volatility are you still expecting from outside currencies, from some of these outside shocks that then spills over and makes it more problematic for Bank of Indonesia?
We have 137 billion US. It's more than enough to intervene. One. Second, we have also incoming inflows from this portfolio inflows. Our management of Bank Indonesia Rupiah and FX securities, as well as increasing FX deposit from natural resource. They're already increasing. We expect end of this year will be about 8 to 9 billion US from natural resource export policy. This is government regulation.
So, Governor, you seem to be suggesting that because you have that firepower, you'll probably have to intervene some more in rupiah.
If needed, yes. We will be continue in the market for stabilizing exchange as well as managing our yield differential of the government vis-a-vis US Treasury, so that the portfolio inflow will be there, stabilizing our exchange rate. So this is the tactic of, in a different, X on the basket. We do intervention, we do also managing yield, and the target inflow of portfolio, stabilizing the exchange rate.
Governor, do you think that your next interest rate move is a cut or a hike?
Well, friends, we have inflation very low. Last month is 2.7. End of this year, 3%. Next year, 2.8%. Then, actually, the natural response, if we only consider domestic, then actually our policy rate need to be lower. But I cannot lower our policy rate because of the global spillover. So we have to be patient. We have to be patient on that aspect.
But again, in terms of sequencing, so do you need to see a Fed rate cut before you cut?
Well, depending on the investor preferences. What I'm seeing in the foreign investor is seeing the uncertainty. Whether the November, the last cut, and the last increase of the Fed fund rate. Whether US Treasury will keep rising or declining. Whether dollar will be declining from 106 to 104, 101. If that's stabilizing, then foreign investor, okay, time to invest in Indonesia. Time to go to Indonesia because Indonesia is one of the best performer in emerging market. Whereas, if that happening, then rupiah will be strengthening, right? So this is the dynamic that we are seeing of the coming month. Friends, in this uncertain world, we have to be patient. The patience is very important, right?
Are you looking again to calibrate or reducing the RRR as a possible pivot point? Is that your first point to try and change monetary policy?
Well, we have a good practice in the bank, central bank, that we need to forecast 2 years down the road. Inflation, growth, exchange rate, what the likelihood of Fed fund rate, US Treasury, and so on. We calibrate that month by month, and then, of course, we will announce every board meeting. But from now on, we want to focus on stabilizing our exchange rate and holding our policy rate. Our inflation will be very low, coming down. Our economic growth will be much better. Indonesia continue the best economic performance.
Governor, a final question. How much volatility are you expecting from election season? And what can the central bank do to prepare for that?
For?
Elections.
Well, Indonesia is a big country, a very democratic country. We have been going into a number of peaceful, election. I'm not expecting that the election will adding volatility in our macroeconomic and financial stability.
Okay, Governor, thank you so much. It was a really great pleasure to host you here in the studio. That was Perry Warjio, the Bank of Indonesia governor. Now, coming up, Ukrainian President Volodymyr Zelensky is looking for concrete pledges from his European allies, while U.S. officials are trying hard to reassure their allies that the money is coming. We'll go live to Grenada for more on the EU summit next, and this is Bloomberg.
times in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
EU leaders gather for a second day in Granada, Spain, after Ukrainian President Vladimir Zelensky urges them to stay united in the face of Russian aggression. Meanwhile, the U.S. ambassador to NATO, Julian Smith, sought to reassure European allies, telling Bloomberg, quote, the U.S. is not going anywhere.
I think American leadership is here to stay. We've seen the United States take the important leadership role ever since Russia went into Ukraine. We obviously have a temporary situation right now with this continuing resolution that does not include increased support for Ukraine, but based on broad support across Congress for U.S. support for Ukraine, based on what President Biden said when he got on the phone with our allies and with President Zelensky in recent days, and based on what you see in terms of polling across the United States, we anticipate that American support for Ukraine will continue. Americans fundamentally understand what's at stake.
Now, for more on all of this, let's get straight to our European correspondent, Maria Tadeo. Maria, good morning. A diplomatic effort from the Ukrainian president. What did he actually achieve?
Yes, Francine, and as you played there, when we spoke to the NATO ambassador to the U.S., she asked and answered those questions about Zelensky, some of his concerns, and not just Ukraine, but really the European Union, about whether or not the Biden doctrine is changing. And she said this is just a temporary situation. But nonetheless, this really permeated debate yesterday here in Spain. And to answer your question, President Zelensky was here. It was, so to speak, a diplomatic offensive. He was here for less than 24 hours, I should say. As far as we know, he traveled to Poland, and now he is back in Ukraine. And he carried almost a twofold message. One is that both the U.S. and Europe made a promise to help Ukraine, and this is a moment of unity. Francine, just to let you in on an anecdote from yesterday, when the session was over, a small group of journalists were called into a room and spoke to President Zelensky, and one of the questions that was asked is, does he fear, however, this is the end of the Biden doctrine, weapons and money to Ukraine? He did say that is a dangerous prospect. He said that politics is dangerous. Some of the voices in the U.S. he described as being somewhat strange, but nonetheless also said that for Ukraine, there's not been an easy day ever since the war started. Now, the second point made by Zelensky is that the country will also need a logistical operation going into the winter. The concern for Ukraine is not just a counteroffensive and the change in the weather, but it's also potentially seeing a repeat of what happened last year. Remember when Russia attacked some of their strategic infrastructure, the country went into a blackout for a number of days. They say they want to avoid that, and for that, they will need more air defense fast so they can have it in place by December.
Yeah, I have to say, Maria, there's also quite a lot. I think there was an interview yesterday with the former European Commissioner, Mr. Juncker, talking about corruption in Ukraine, which we probably need to spend a bit more time on. But the focus turns also to European politics, and I don't know whether they focus a lot on AI or whether the European leaders now look at a possible Trump win and think of tariffs.
Yes, and Francine, I'm going to go slightly off script here because you made a very good point. Jean-Claude Juncker said enlargement for Ukraine, and that is the issue that will be debated today, is not possible because the country is corrupt at every level. I actually asked that question to Zelensky, and he told me that Mr. Juncker has not been to Ukraine a single day ever since the war started, and he also told me, anyway, he's an old man, I wish him health. So that was the response from Zelensky. In terms of today, again, enlargement on the agenda. Yesterday we spoke with the head of the European Council. He manages this debate, and he says that by 2030, the European Union should be ready to take in new members. But that is nothing short of a revolution almost for the EU. Let's take a look.
The candidate countries, the applicants, they need to do their homework, and they know what we are expecting from them. We are expecting reforms, rule of law, independence of justice, fight against corruption. Why? Because the purpose of the enlargement is not to be bigger. This is not the main purpose. The purpose is to be more influential, more powerful, to protect and to defend the interests of our citizens. When I say 2030, this is ambitious, I know, but it's realistic.
President Michel talking to Bloomberg yesterday. He says 2030 for the actual enlargement to happen. But when it comes to Ukraine specifically, the country says it wants to open accession talks this year, before the end of the year.
Maria, thanks so much. As always, I have to say that was quite a put down, actually saying, he's an old man. I wish him well. We have to get you back on that to talk about some of the epic put downs that we've seen over the last couple of months. Maria Tadeo there in Granada, Spain, of course, following the EU leaders. Now, here in the UK, the Labour Party has won a by-election in Scotland on a large swing from the Scottish National Party. The victory boosts Labour leader Keir Starmer's argument that his opposition party is on track to win enough seats to win the next general election against the Prime Minister, Rishi Sunak. Well, Bloomberg's Ruth David now joins us. Ruth, I love it. It's only the big political things that get you on air. So I'm very happy anything big happens. And what a delight to have all of your insight analysis. So how significant, first of all, is the result for Labour?
Well, if you're listening to Keir Starmer, it's seismic. I think a few things to keep in mind. One, this is the first major election, Ruth Glenn, that they've had since March, when a very popular leader, Nicola Sturgeon of the SNP, stepped down. And this Scotland, the seats have always alternated between SNP and Labour. Absolutely, this is a big comeback for Labour, but it's one seat in a special election, and they're putting a lot of weight on it. But if you look at what the bookies were saying and what the strategists were saying, if they hadn't won it, it would have been a huge headache for Keir Starmer, especially going into their annual conference over the weekend. So I think we have to put it into the context of what's happening in the broader scenario. Labour is kind of clawing back some of the gains in Scotland, where their opposition to holding another referendum and going back to the European Union had undercut their wins. But the SNP is facing its own struggles, right?
Yeah, and this is, you're right. If they hadn't done it, that would have been a huge story, and it would have put a lot of question marks surrounding Labour. So what are we expecting from the party conference that starts on Sunday?
He's going to start it on a high note, absolutely, and lay out his strategy for winning the elections next year. Labour is still polling 20 points ahead of the Conservatives in the polls, so they have that kind of lead for them. But the UK's election of first past the polls, the way that they gain victory in Parliament means that just because they're polling this much higher is not a certainty, and they still have a long way to go. I mean, some of the economic headwinds that are facing Rishi Sunak, and when we're talking about just how much room do you have to give away fiscal, like tax benefits, or to cut taxes, or to do any of these things, the economy and the state of it is going to stay the same. So voters will be thinking very carefully, if we get Labour into power, what changes for us? And unless they can come up with a coherent plan of what really changes to make voters' lives better, I think that discontent is something that might colour both parties.
Ruth, thank you so much, as always, for your insight. Ruth David there, our London bureau chief, looking at the politics of the UK. Now, the US and China are said to be moving closer to setting up a meeting between President Joe Biden and Xi Jinping at next month's APEC summit in California. Now, sources say both countries have been scouting meeting sites in San Francisco. Well, Biden and Xi have not spoken since the G20 in Bali last year. Neither side has confirmed the meeting. Now, coming up, it's been a turbulent time for Sweden's biggest pension fund after losing its chairwoman and billions of dollars. So we look at the future for Electa. That's next, and this is Bloomberg.
almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Switching gears to European rates in the property sector, Sweden's biggest pension fund, Alecta, which manages 1.2 trillion kroner pension funds for a quarter of the Swedish population, is once again under the spotlight. Now, for more, let's get straight to Bloomberg's Love Lehman in Stockholm. Love, so what's causing the worries there, and how's the reaction been so far?
Yeah, as you said, it's Sweden's biggest pension fund, Alecta, with around $100 billion in assets under management. That is once again in the crosshairs after the debacle that we had earlier this spring with the U.S. niche banks, where it lost $2 billion. This time it has made a nearly $5 billion bet on a single real estate company called Heimstad and Bostad. And now there is a risk that bet might go sour if it doesn't invest even more capital in it. And you have the wider media really scrutinizing this investment, the public as well, and they are questioning the grounds on which it was originally made.
So, Lovi, what's at stake here, actually? Are there any really contagion risks?
Could you repeat that, please?
What's at stake? Could we see contagion? Could it spread to other parts?
Yes, well, it is one of the biggest bond issuers among the European property companies. It has got around $10 billion worth of bonds issued. And some say there is a risk that if things go really bad for Heimstad and Bostad, it could lose its investment grade rating. And in that case, you might see more widespread contagion.
Mm-hmm. All right, interesting. Thank you so much, Love Lehman, there in Stockholm. Now, Aviva, one of the biggest risers in Europe following the so-called uncooked mention in the Betterville report regarding potential takeover interests from the insurance company. Now, Bloomberg has reached out to Aviva representatives for comment. You can see Aviva gaining 9%. Now, Philips also suffered another setback as the U.S. drug regulator requested additional tests on its sleep apnea devices, warning that the company's analysis of the recalled products is inadequate. Up next, we have plenty more on the markets with our Bloomberg Brief. Danny Berger in London, Manus Cranny in New York. The big story today is, of course, what's going on in the U.S. The U.S. left, right, and center with the jobs report, hopefully giving us a little bit of clues of what the Fed does or doesn't do next. This is Bloomberg. Happy Friday, everyone.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. On's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer this Wednesday on Bloomberg.
This is Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
It's all about bonds and jobs. We're counting down to the U.S. labor report that will help define the path ahead for the Fed. Mary Daly says the central bank may be able to avoid further hikes.
If we continue to see a cooling labor market and inflation heading back to our target, we can hold interest rates steady and let the effects of policy continue to work. Even if we hold rates steady exactly where they are today, policy is going to grow increasingly more restrictive as inflation and inflation expectations fall.
Bloomberg has learned that Exxon is in talks to acquire shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals this year. And it's been a tough 24 hours for Elon Musk. The SEC seeks to force the billionaire to testify on Twitter. And Tesla, it's cutting its prices again. Good morning. There's only one number that you've got to focus on. It is your jobs number, 170,000. Will it dip like ADP did? This is the state of the play in the bond market. We've got yields just rising ever slightly. Mary Daly really being very clear. The market has done for us pretty much what we'd hoped for, that tightening from the yield market. Real yields are at a 20-year high. That will transmit at some description. Still, the houses out there, Bank of America say there's scope for 10-year yields to get to 5 1/8. What will Stephen Major, the Uber bond bull, make his call today? SocGen say the clearing rate for this bond market is 5 1/4, 5.5%. So let's see what the jobs number does to redefine risk. Do you want a real amount of risk going into this number? Probably not. Crude manages to go back in the green, down 9% on the week. Goldman says you don't want to pay too much attention to those gas numbers from yesterday. They say a soft landing remains on track. It is but a fleeting moment in the gasoline inventories. I thought we'd pop the dollar up there because ING, wrap it up beautifully for me, Danny. The dollar is expensive to sell here, and we have a feel that a wobbling bond market is the reason why you may just want to hold on to a few dollar longs. Danny, good morning.
Good morning, Manus. Well, we're holding on to everything right now and waiting until we get that jobs number. Very calm morning, not surprising again for an NFP payrolls day. S&P and NASDAQ futures, little change. European stocks, they have been surprisingly resilient amid the pummeling of this global bond market. But SocGen does say that 5% 10-year yields, that's where the market is expecting it to go. And should that happen, S&P will go to 4,000. S&P futures right now, 4,292. They still say buy the dips over the next 6 months. Now, Bank of America points out, Manus, that it is the bond market that has priced in a recession. So the good news from them, this is from Michael Hartnett over there writing in their weekly Flow Show report, that should we actually get a recession show up in the data because the bond market has already priced it in, that sovereign bonds, that treasuries will be the best performing asset class of first half 2024.
And yet still, the money flows in, Danny, to the very short end of the money market for funds. 64 billion went in last week. We have now got a record amount in these money market funds. And that caused us a lot of dislocation earlier in the year. 5.71 trillion has gone into money market funds, up from 5.64. So again, this is the kind of velocity that you've got in that race for cash. We've had various guests this week come on the show and say, I want to hide in cash. Danny.
And that thing is concerning, Manus, because these money market funds, the frothiness of them and the stark pull out of it during COVID is what forced the Fed to step in. Look, there's been plenty to worry about this week. So here's a quick recap of what some of our guests had to say about the dramatic moves in yields.
Everyone's concerned about catching a falling knife.
Bond volatility has been the bogeyman recently.
Typically with markets, things do overshoot. The 5% level is quite a scary level. We also need to focus on real yields.
It's really hard to know where we go from here.
I have a feeling that people haven't actually woken up to the fact that for the first time in over 20 years, the yield on the bond market is actually higher than the yield on the equity market.
Something has to happen to make more people want to buy more bonds.
We're seeing a little bit of an oversold market here headed to 5%.
I think the fair value is somewhere closer to 5%. But don't assume that just because it's around 5%, we're there and so people should buy bonds. No.
A 5% 10-year Treasury is decent value. It's not great value.
Let's add another expert voice to that. Stephen Major, HSBC's Global Head of Fixed Income Research, joins us now. Stephen, I want to pick up where Bill Gross left off. He says decent but not great value. Is 5% on the 10-year yield just decent value to you?
You're talking to someone who's been very wrong. Because I would have thought that was good value at 4, so yeah. 5 should be even better value. I think we've been wrong for mainly the right reasons. So we need to see these conditions changing that have caused this. So many of those guests pointed out the valuation piece. So real yields are above trend GDP. Bonds versus equities, bonds look good. Bonds versus cash are looking good, looking better at least. So the valuation piece is there, but the conditions that got us here, it's the deficits, therefore increased supply. With good times maintaining in the economy, no recession, and an inverted curve. Now, it seems to me that you could be getting to the point where maybe 2 out of 3 could be shifting. So if the data starts to tip away from good times towards bad times, then there's no lack of demand for the increased supply. So where we've been wrong is the fact that normally I don't think deficits matter, but investors have been asked to take these bonds when there's a big inversion and there's loads of them. So if you can remove the inversion and change the data backdrop, then the valuation piece will come in as well. So I think slowly the conditions are getting better.
Well, it takes a pretty big person to come on the show and say, listen, I've been wrong all the way up here. But laying out your stall. Good morning, Stephen, by the way. It's good to speak to you from New York.
Morning, Manus.
Term premium. I don't know the math. I'm not that intelligent, right? But you are. So term premium is turning higher, and this is part of the narrative for you. I know that. Is it rich enough for you to make a sort of a doubling down on your it is time to get long, or do you think you need to see more term premium before this market clears?
Yeah, so term premium is a symptom of something quite big happening. The last time we were writing about term premium was in 2014. That's after the taper tantrum when it was really high. So that tells you something. So just to be clear, term premium's that additional bit of yield you get on top of what you would have had if you were just rolling bills. So it's the additional yield that you get from bonds as opposed to just holding bills through the life of that bond. Now, under most measures, it's risen by about 100 basis points, Manus, and that puts it back to levels of 15 to 20 years ago. So it's definitely more interesting. You are now being compensated to go into bonds. And if I go through these where the yields have been rising, initially it was because the Fed and others were behind the curve, behind the inflation. Secondly, they doubled up and they went for 75 basis point hikes. You got a huge bear flattening.
Right.
And now the third stage has been the back end flipping, which is the term premium piece. So it could be that we're there, but someone like me, I have to say these things very quietly now because you come on this show, you say something big, and you get hit immediately.
Unfortunately, Stephen, whether you say it quietly or loud, we will take notice.
Thank you.
Look, I think this element of humbleness is interesting. That the surprise that the deficit has mattered so much to the long end. So, to you, is that illogical? And if so, where is fair value right now?
I've made a thing, and most of the investors who follow our research will know that I say bonds are not potatoes. So you don't treat bonds like they're potatoes. They're sophisticated financial instruments. They can be repoed. They normally roll down the curve. The problem is right now they are like potatoes because they roll up the curve. So when you have an inverted curve, they're falling in price, and there's loads of them, and they're rotting. So they're just like potatoes. So you need to change the conditions that have pushed the bond market into the situation where it's being compared to vegetables. So that's slowly happening. I mean, I never really thought supply could ever matter. Saying that an increase in supply means a fall in price is kind of naive because it presupposes the demand backdrop and all the other complexities. So it looks to me that with a recession, and here we come back to the data, with a recession, you won't have any lack of buyers at the right price.
So here's the thing then, Stephen, and we've got a piece of that, an important piece of that data today on wages and on jobs. You used a very interesting word. You used the word capitulation in conjunction with term premium. So I stand here for 4 days in a row going, bond vigilantes, unanchored moves in the bond market. Now, it's not. This is not what I would call parabolic unanchored moves in a bond market because you've lived through them, as have I. How would you describe this move? And if you're using the word capitulation, that suggests to me we're at some kind of an exhaustion point in this bond move.
Well, it seems to me it is. So it depends on what your reference point is, Manus. This time last year, we had a UK fiscal event, and I think we had a 100 basis point shift in one day on the UK gilts. I can go back and I think 2014, we had a flash crash when yields went down. So they went in the other direction in a huge move. It looks to me that like this last 100 basis points or so is mainly explained by term premium, and it's come through the last 2 months. Maybe it's not of the same speed as the UK move from this time last year, but look, it's on top of a big move already.
Yeah.
So I use the word capitulation because I think there is evidence of throwing in the towel, and that's what I mean by capitulation.
Stephen, we have much more to cover with you. Stay right there. Stephen Major there of HSBC is going to stay with us. First, though, some top stories trending on the terminal this morning we want to make you aware of. Former U.S. President Donald Trump is endorsing Jim Jordan of Ohio to be the next U.S. House Speaker, saying the hardline Republican has his, quote, complete and total endorsement. Now, at the same time, the New York Times is reporting that Trump revealed nuclear submarine secrets to Australian billionaire Anthony Pratt at Mar-a-Lago soon after leaving office.
Well, the FTX co-founder Gary Wang has taken to the stand in the Sam Bankman-Fried trial, saying he and his former childhood friend and MIT roommate committed a multi-billion-dollar fraud. Wang is cooperating with the prosecutors after pleading guilty to fraud. Now, his testimony promises to be among probably the most powerful in the government case against Bankman-Fried, who's pleaded not guilty. Danny.
Now, Iranian human rights activist Narges Mohammadi was awarded the Nobel Peace Prize for 2023. Mohammadi was awarded the prize for her fight against the oppression of women in Iran and her fight to promote human rights for freedom and all.
Well, coming up
Matters.
later this hour, we'll have more on the big deal brewing at Exxon, the energy giant's biggest since 1999, as it seeks dominance in the U.S. shale production. But up next, more from Stephen Major at HSBC. We'll get his view on the Bank of Japan and the global perspective that's taken hold of the bond markets, right here on Bloomberg.
Obviously, we're trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. On's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel CFO makes you a better CEO, and a CEO makes you a better CFO.
Watch Chief Future Officer this Wednesday on Bloomberg.
This is your Friday edition of Bloomberg Brief with me, Menace Granny in New York, Danny Berger in London. We got there, Danny, but we didn't manage to break anything. The bond markets did that for us. Let's talk about JGBs and the UADA shock and the Bernanke taper tantrum, which Mr. Stephen Major of HSBC, Global Head of Fixed Income Research, lived through and survived. Stephen, this is from Martin Malone over at Oral. He said, Manus, take a look at this. The taper tantrum, 2013, as you remember well. But the YCC, the dislocation of YCC, to what extent did the ripping off the Band-Aid of YCC have a more global impact, perhaps, than we are assuming? Good morning, Mr. Major.
So it's a good idea to compare the two. So in March 2013, Bernanke was already talking about it. There was a paper that mentioned term premium 15, 16 times. So no one was listening. It took until May for people to start to realize that they were serious about going from QE infinity to QE end. And then it got really moving. It got motoring through the second half of the calendar year. With this one, the first move from the BOJ was just before last Christmas. And we've had other iterative shifts since then. And actually, in the current guise, the YCC includes the number 100. So that there is a tolerance for JGB 10 years to get to 100. The 40-year was through 2% this morning, which I think someone picked up on Bloomberg. So everything says that we're on the way towards what is some measure of fair value. So Bank of Japan modeling has put it between 80 and 100.
Mm-hmm. Right.
How much of a surprise would it be if they ended YCC right now?
I mean, maybe not a surprise, because more folks see it coming. But if they do, what does that do to the picture that Manus just showed us?
Yeah. So let's look at the counterfactuals. If they had done this 2 years ago, when the US 2-year was 15 basis points, it would have been pretty explosive. But if the 2-year is 5%, 500 basis points, then obviously there's more scope for global fixed income to soak this up. So I don't think it's a huge surprise. Put it this way, if you were a strategist working inside the Bank of Japan, when are you actually going to do this exactly? Do you think that you can wait another year? I mean, wouldn't it be a crying shame if you went through a whole interest rate cycle and they missed the chance to get rid of the YCC and the negative rates? So it seems to me that they must be ready to go soon. And I think that the issue for them is the noise and the volatility. So it's trying to do it smoothly without creating big eruptions. But the idea that higher JGB yields means higher Treasury yields, I think that's one for in the past. I don't think it's going to matter so much now.
Okay, that's fine, but you do draw the comparison. You say the prevailing US exceptionalism, as if outside events just don't matter. So you've put down your stake that the recession could come, the data could roll over. But you talk about a new normal of the US economy was made 25 years ago under Greenspan, and that was questioned. You are worried about other events that could come to pass, aren't you? And what is the biggest event? Contextualize it briefly.
Yeah. So thank you. You've seen it in our research. So it's easy to look at the cyclical and the local factors for the US. So that's the data and maybe regional banks. But globally, what's going on in China? What's going on in Europe? This divergence between the big blocks in the global economy, that does not go unnoticed. Now, is it through the FX or capital flows or through trade or some kind of contagion? I don't know, but it has to matter. And we look back through history and you see these great divergences that they tend not to end well. So without knowing exactly how this plays out, it looks to me like it's another thing that we should consider. At the moment, the market's pricing US exceptionalism, but you know, how far away can US yields get from the big blocks in Asia and Europe?
But still, I look at Europe and I look at what yields have done over the past 2 weeks, and it's hard not to say this isn't fundamentals. This is the U.S. This is the U.S. bond market causing this sell-off. So what does that mean for Europe if the bond market is being bullied around?
So, and notice that European yields have followed the US, but Chinese yields haven't. So there's definitely an Asia-Europe-US disconnect here. So the last thing Europe needs is higher bond yields, because you would have thought that the data, if you just looked at the data, it was pointing more to recession risks in Europe than just about anywhere else. So look at the loan growth, for example, and some of the recent incoming. So this is the last thing that the ECB needs right now. And to me, it just kind of bakes in the cake the idea that we're at the peak in the cycle.
Okay.
And really, it now becomes a question of when the rates go down.
Let's get two last stakers in the ground from you. You know, you started the show by saying, "Look, I was wrong on the way up here," but you do like gilts and you do like UK long-dated paper. Where can that get to in the medium term? Put your stake down for Christmas.
Well, yes, we shouldn't be too encumbered by what's happened. So we take a clean sheet of paper, you look at the long-dated real yields, and it's the UK and US that stands out.
Yeah.
And I think that hopefully we've learned our lesson. We've been wrong, but it's the entry point. I mean, how wrong can you be when you've got real yields that are so far above the trend GDP, and the valuations of bonds versus equities starting to be in your favour? So it's the long end of the UK and US that we like here.
All right, Stephen, looking forward to you joining us again shortly and being able to say you were right this time. Stephen Major of HSBC, always a humble gentleman joining on the show. All right, as we had to break a quick check on these markets, much more calm, but it is jobs day, so that is not surprising. The long end, that's where the value is. UK 10-year yields, those just above 4.5%, 10 years 4.7%. This is Bloomberg.
18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
From New York City,
in London, in
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Brief. I'm Danny Berger in London, alongside Manish Krani in New York. The SEC is seeking to force Elon Musk to testify as it investigates the billionaire's purchases of Twitter shares ahead of his takeover of the social media platform. But Manish, that's not the only trouble Musk is facing. It's been a tough 24 hours for him.
Yeah, I mean, it's been a tough old 24 hours. We're also seeing more price cuts come through on Tesla, Danny. This is on the Model 3 and the Y. This is here in the US, and this was on the miss. If you remember last week, we did the miss on the quarterly sales, etc. And again, prices have been slashed. Model 3 comes down to $38,990, down from just over $40,240. So again, more price to come. And again, it's the battle for market share, isn't it?
It is. I mean, BYD, the cheaper Chinese-made electric vehicles, have really been nudging their way in. In other EV news, a really bad day for Rivian to a record drop, Manus. They announced plans to issue $1.5 billion in convertible bonds. One analyst from Evercore ISI saying, look, the numbers were what we expected. It just came too soon, and the market, I guess, hated it.
Yeah, I mean, there's a small bounce back there. The stock sank by 23% yesterday, and that's below the IPO price. I mean, I think they were just surprised that they came for a call of cash so soon. One other piece of breaking news for you. We'll pick this up through the show. Unions plan to resume industrial action at the Chevron LNG site. So we'll keep an eye on that breaking news. Austrian Finance Minister joins the brief next, right here on Bloomberg.
We're back
for another season of AI IRL.
My opinions sometimes elicit unfriendly responses from my peers, but let me try to explain my thought on it.
So to start, Twitter and X are two totally different companies in my head. Companies are driven by the culture of the people who are there. They're two totally different places.
Not to ask people about their bosses, but Mark Zuckerberg, how is it changing his priorities?
A lot of time and thought is invested into how you can innovate.
It turns out that the popular chatbots, ChatGPT, Bard, and others, are so easily hackable to actually drive a different agenda from what is bounded as a response mechanism.
There's a tipping point here where the images have become so good that really smart people who are by design critical are falling for it. That was number one. But here's the other one that really scared me.
Do you think that there's potential to see kind of an AI Rust Belt of sorts?
My personal opinion is no. That might be somewhat contrary to what others are thinking.
Do you think that it can replicate the solace and comfort some people feel with religion?
What I have seen is that it really varies depending on how people think about the way that, higher powers or the divine might move through the material world.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. It's all about bonds and jobs. We're counting down to the U.S. labor report that will help define the path ahead for the Fed. Mary Daly says the central bank may be able to avoid further hikes. Bloomberg has learned that Exxon is in talks to acquire shale-focused Pioneer Natural Resources. It's potentially one of the biggest deals of this year. And it's been a tough 24 hours for Elon Musk. The SEC seeks to force the billionaire to testify on Twitter, and Tesla is cutting prices again. Calm in this equity market, but it is jobs day, so it's not unusual to see this morning. The handover from Asia was calm too, but of course China is offline. Will be interesting to see what happens Monday when those markets open back up from the Golden Week holiday. So we're higher across the board, be it S&P and NASDAQ futures. European stocks do even better, up 0.5%. But again, SocGen says that bond yields are going to 5%, and that when that happens, it's likely the S&P will go to 4,000. Manus, we also just had some breaking news just moments ago. European natural gas prices have jumped. They're now higher by about 5%. That's off the back of the news that Australia's unions there around the Chevron LNG sites have decided to resume their strike. They are going to resume industrial action. Manus, we learned earlier in the morning that workers had accused Chevron of reneging on some of the commitments that were made last month, and that was to end a dispute that roiled global markets. It had really impacted, again, European natural gas markets. This pop up right here is all we've seen, so not a huge move at least for now, Manus, but something we're going to keep an eye on.
Well, we'll certainly bring that question on gas prices as a result of strikes, but also the weaponization of energy. When we talk to the Austrian finance minister in just a moment. How prepared is Europe for another weaponization of energy? Across the asset board, yields this morning, they're nervous ahead of the only one figure that matters, which is the jobs report. 170,000 is what we're looking at. Yields pop just up. The question is, the message from the Fed, Mary Daly saying, look, the market has already tightened the extra hike that we need to do. We just caught up with Stephen Major. He said he's surprised how much deficits have mattered to the narrative within the bond market. He says term premium, which is at a 20-year high, is now something that the market will pay attention to. And he talked about capitulation in terms of a sense of exhaustion in this market. Crude is down by an eighth of 1%. We've dropped by 9% this week. Of course, we saw the drop in the gasoline consumption in the United States. Goldman Sachs say very clearly, stop looking at that. That's not really something. It's going to be fleeting, if anything. The soft landing for them still remains on track. Again, going back to what Stephen Major said, once this data turns, there's going to be buyers aplenty coming in to gorge on these bonds. Bloomberg Dollar Index, it's expensive to short. That's the message going into this jobs number. The dollar is expensive, according to ING, and we feel a wobbling bond support that view on the dollar. So that's the state of play on the markets. Danny.
Yeah, and again, I I find this thing from Stephen Major really fascinating, Manus. The humbleness to admit, look, I am surprised, is what he told us, that the bond market was so obsessed with the deficit and so obsessed from supply. But we got to be honest, it's not just the bond market, it's also Fed officials. They've pointed to supply being an issue for higher yields too.
They have indeed. And the other dislocation, just as we go into this jobs day, is that money is gushing in to those money market funds. 5.71 trillion has gone in, 64 billion last week. So that flow of money has not ended, and there are repercussions. We have seen that before. How will that play out again? Danny?
It has repercussions in global markets. European yields are also moving higher. Now, all of this, the backdrop geopolitically for it, is EU leaders gathering for a second day in Spain. That's after Ukrainian President Vladimir Zelensky urged them to stay united in the face of Russian aggression. U.S. Ambassador to NATO Julianne Smith sought to reassure European allies, speaking to Bloomberg TV yesterday.
I think American leadership is here to stay. We've seen the United States take the important leadership role ever since Russia went into Ukraine. We obviously have a temporary situation right now with this continuing resolution that does not include increased support for Ukraine, but based on broad support across Congress for U.S. support for Ukraine, based on what President Biden said when he got on the phone with our allies and with President Zelensky in recent days, and based on what you see in terms of polling across the United States, we anticipate that American support for Ukraine will continue. Americans fundamentally understand what's at stake.
Let's now go to our European correspondent, Maria Tadeo, who's been on the ground in Granada. Maria, what's top of the agenda?
Well, Danny, there's a lot on the agenda today, but just to take a moment, of course, to reflect, as you say, on this diplomatic mission that President Zelensky was in yesterday. Really hectic 24 hours for the Ukrainian president. He got here in the morning, and as far as I know, he should be back in Ukraine now. And again, his message was that of unity. He repeated this is a moment where the United States and Europe has to support Ukraine. Just to let you in on an anecdote, by the end of the session, a number of reporters, including myself, we were taken into a room. We spoke with President Zelensky, and we asked that question, however, do you fear the Biden doctrine, money and weapons to Ukraine, is coming to an end? This is a man who's obviously very aware that this is an election year in the United States. He says that is a dangerous prospect. He talked about some strange voices in U.S. politics, but he also said there's not been an easy day for Ukraine ever since the war started. That's on the diplomatic front. When it comes to the logistics of the war, the Ukrainian president said that, of course, the counteroffensive continues before the weather changes. And when it comes to the winter, he also said the country will need more air defense, because what they fear now is that we're going to get a repeat situation of what happened last winter. Remember, Russia hit their strategic infrastructure. The power went down. The electricity went down. For some days, the country went into blackout. President Zelensky says he wants to avoid that this winter.
Maria, thank you very much for that. That's Bloomberg's Maria Tadeo reporting from Granada, Spain. Now let's dig more into the picture of not just the geopolitics, but economic picture facing Europe. Joining us now is Austrian Finance Minister Magnus Brunner. Magnus, thank you so much for joining us, Minister. Look, the global landscape in front of you at this moment. You have yields marching higher across the world, but in Europe specifically. You have China delivering less velocity than many had hoped it would. So Austria skirted a recession so far this year. Are you confident that it can continue to avoid one and that you will have a strong bounce back in 2024?
Well, I'm always confident, but not naive. That's my attitude. No, we're in difficult times, very challenging times, I would say, economically. We did quite well last year, having a growth of GDP of more than 5%, which is above the European average, above Germany. We always compare ourselves to Germany, have to.
Everyone has to.
Everyone has to, but especially Austria, of course. We were doing quite well, but of course now the times are different. And especially because of Germany also, because we are very much dependent on Germany. And sort of we're going into a recession in the third and fourth quarter of this year, but the expectations for next year are not that bad. We're expecting growth of more than 1% for next year, so I'm still quite optimistic.
Good morning, Minister. Good to see you. That optimism obviously depends on a great deal on the global stage. France is flatlining. Germany is the sick man of Europe. China is not growing. So what is it that's going to help you be confident that you return to growth in 2024? What is it that's going to drive that growth for you?
Well, especially how we present our budget. That's probably the most important thing. And we've got some Some things to do in the budget, definitely. Challenging times also for budgets in all over Europe, especially because I talked about the dependency of Germany. And we are all in the same boat in a way, because there are all these export-orientated countries like Germany, like Austria, like Sweden, Netherlands, and others are in difficult times. But what we have to do now in our budgets is to set the right scene for next year. We've got some priorities to do, like we're setting a lot of priorities on microelectronics, for instance, and to get the economy up again in the next year to come.
Well, you've long been a proponent of stricter fiscal rules for the entirety of the EU. We're in this situation now where you have both France and Italy looking like they're going to go above the 3% limit. What is at risk for Europe?
Yeah, we need new fiscal rules. We're just discussing these fiscal rules on a European level. Probably next week is sort of the next challenging time. But we have to, well, first of all, we have to get new rules. That's for sure by the end of the year. And I think we need some sustainable fiscal rules. I think that's a good attitude to have, in my opinion. Get more transparency also, and more enforceable rules. Because we had rules in the past which were not very enforceable.
Minister, what happens if we don't get that? What's at stake?
Well, we stick back to the old rules then. That's for sure. We definitely need rules, and if we don't get any new rules, we stick back to the old ones.
Well, the old rules, many people sort of fudged them in the first instance, Minister, time immemorial in Europe. I want to deal with a story at hand at the moment. We're tracking gas prices this morning. There's a strike in Australia. That's a constriction on supply. I want to get a broader perspective from you on Europe. Gas prices have plummeted since the Russian invasion of Ukraine. How prepared is Europe for a new weaponization of energy in this winter? Are you prepared? What are you doing? Are you on the front foot?
You're perfectly right. I think Russia and Putin uses gas and the energy altogether as a weapon against Europe, against the world, against Ukraine. And we have to prepare ourselves in the EU member states. And I think Austria is well prepared. Our gas storage capacities are very high compared to other European countries, and the gas storage capacities are full by more than 93%. So we are very well prepared for the winter which comes up. That's the good thing. And we have to work on more diversification of our gas system, because we were very much dependent on Russian gas. Not only Russian gas, but rather the pipeline gas. And it was very good for our economy in the last years, of course, because it was cheaper gas than the LNG. Yep. And as Austria hasn't got an LNG, hasn't got a sea access, as you know, we are very much dependent on the pipeline gas. But we managed to diversify in the last months more to Norwegian gas, more to other gas systems, and that's a good perspective.
Now, one of the other issues facing Austria, and let's be honest, the world is facing this right now, is labor unrest. You have metal workers in Austria asking for a nearly 12% raise. Social workers, it's 15%. Can you realistically afford that? Can the country afford that?
Well, it's not in the politicians' hand to do these wages and the rises of wages. That's in Austria. It's the social partners who discuss that. But you're right. I mean that of course fuels the inflation again, and the Austrian inflation is too high. We are now above the European average. We used to be below the European average last year. We are at 6.1% now. On the EU statistic level, we are at 5.8, which is far too high, but there are different reasons for that. And one reason is, of course, the very high wages, the rise of the wages. We are the highest in Europe, together with Belgium, and that fuels the inflation again.
Minister,
That's a big problem, yeah.
Very briefly, a response to, we've just caught up with Maria Zelensky, is speaking there about the concerns around the lack of funds, or the break in the momentum of funds from the United States of America to Ukraine. How concerned is Austria? How concerned are European peers? Briefly, a response to the break in funding from the US.
Well, we are, of course, supporting Ukraine with all we can do. I just had a meeting with the EBRD this morning. We are supporting the EBRD. We're supporting the EIB as well. We're doing a lot as a small country, a small European country, to support the Ukraine. We have to stick to that as a European Union, but as a world altogether.
All right, Minister, thank you so much for your time. That is, of course, Magnus Brunner, the Austria finance minister. Now, coming up on the program, a big deal is brewing at Exxon. The acquisition that could be the energy giant's biggest since 1999 as it seeks dominance in U.S. shale producing. This is Bloomberg.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of at the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Manus Granny in New York, Danny Berger in London. So Bloomberg has learned that Exxon, Danny, are in talks to acquire the shale-focused Pioneer Natural Resources. It's a deal that could be worth as much as $60 billion, potentially the largest acquisition this year. Joining us now is Will Kennedy, hot back from the Middle East, where he's been talking oil all week. So I want you to shift from pure commodity to pure deals. This is a beast of a deal. Does it make sense?
It's a very important deal, and I think if it goes through, could end up being seen as a landmark deal in the oil industry for several reasons. It will be Exxon's biggest deal in almost a quarter of a century since 1999, and of course be the defining move of Darren Wood's time as CEO. But what it would really do is change the landscape of the shale industry. Shale has been a boom that's been driven by the independent sector, companies like Pioneer, rather than the oil majors. They've got into it more latterly, but this would make Exxon by far the biggest beast in the Permian. They would have more than 1 million barrels a day of production from the Permian Basin alone, and they would be the dominant player in the US shale industry. So it really would change the landscape of the oil industry in the United States.
The backdrop for this is the conversation around $100 oil, and we were getting close there. We're above 90. Now we've slid back below $80. There's all this concern about demand, but Will, how warranted is it?
It's really interesting, and I was having a couple of conversations in the Middle East this week with people who sell oil, essentially, and they were saying that, they don't see the demand weakness. If you look at Saudi Arabia released its official selling prices. Those are the premiums they sell oil at over and above the market price, and they put them up. And that's a sign that they're confident that the oil market remains quite tight and they can place all the oil that they want. I think there's a feeling that the price action has been driven by the wider gyrations in macro markets, perhaps some profit taking, perhaps some very elevated prices last week on the front month. Well, the broader theme people seem fairly confident still.
Yeah, they do. I mean, those cuts are still there from the Saudis and the Russians. The Russians have just taken off their embargo. We didn't actually get through any more. You've had a great week in Abu Dhabi, great interviews with the Indian oil minister and beyond. I look forward to an upsum. Make sure you file that before you take the afternoon off. Will Kennedy there, tracking the oil movements. And we're going to stick with a quick check on the markets. It is jobs day. 170,000 is the number that is penciled, etched in your brain. S&P are slightly in the green. You got the dollar holding on to some gains. ING said it's expensive to short that Yankee. Good morning from New York.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at BloombergLive.com/screentime.
This is Bloomberg Brief. I'm Manus Crenny in New York, Danny Berger at London HQ. We're counting down to the main event of the day, the jobs report for September. It's due at 8:30 a.m. Eastern Time. Michael McKee got up early for us. He braved the early morning call ahead of surveillance. He is, of course, our international economics and policy correspondent. Good morning. Mike, good to see you. 170,000, it's the number that's in my brain. But take me beyond that number. Or is that the critical number versus
wages. How do you break it down?
This time I think it is the critical number, and the reason is the bond market and what's been happening in the bond market. It's almost less important what the numbers are today than how the bond market reacts to that, because as you heard Mary Daly on Bloomberg yesterday talking about how the bond market has functionally given us another quarter point of tightening. And so if we get a strong number today, you may see the market do the same thing and may start to get ahead of the Fed. Right now we're expecting 170,000, as you said, and we're expecting the unemployment rate to fall. Last month it went up 0.3, a big bump because so many people came into the labor force. That's not expected to repeat. And the wages number could be a surprise, but at this point looks like it just sort of stays on the status quo.
Mike, I might be getting ahead of myself because I really don't care about September. I care about October. And I mean, that's because it is backwards looking by its very nature. That's what I'll stick with. But as we're entering a world of tighter financial conditions, will we look back on the report today and say, hey, perhaps that was peak, that was as good as it gets for this American job market?
Well, there's some people who think so. Bloomberg Economics is suggesting this is going to be the peak, but there are other analysts I've read who are saying we shouldn't see a whole lot of fall off at this point. We're getting into that time of year when companies are hiring extra for the holidays, and the question is, do they hire as many people as they normally do? If so, then maybe things don't drop off. If they think we're going to go into recession, they might drop off. The interesting thing today is that the market is leaning towards the idea of a stronger jobs report. The whisper number out there is 190,000, while the forecast is 170. So the market thinks maybe we're not quite there yet. We're still going to see some strength going forward. But you're right about September in the sense that September is not going to show any of the strike activity. The UAW and certainly the healthcare workers who went on strike won't show up until the October payrolls report in November, which comes after the next Fed meeting.
How tight is the wages market here? I mean, it's been something that has been constant in the reports in terms of the wages, the tightness, and organizations holding on to people and paying up. We've gone through a few strikes, as you say. Some of them have been resolved, some are still ongoing. That tightness in the wages market is what Larry Fink referred to with Danny. He talked about embedded structural inflation. So how important is the wages numbers today?
The wages number is important, but it has been coming down. So the Fed sees progress there. I mean, we were seeing people get 6, 7, 8, 9% increases to come back to work. Now that many of those positions have been filled, we're running at a 4.3% annual rate, and the Fed thinks that's just a little bit above the 3 to 3.5 that they consider sustainable. So at this point, it's beginning to look like progress is being made, and if that continues, then the Fed's going to be seeing, they hope, some progress on inflation. All we have is anecdotal data, but a lot of CEOs are telling Fed officials, who are telling me, that they don't have to pay as much to get people to come to work these days.
Do we just need Beyonce and Taylor Swift to go on another round of tours, Michael? Is that what's going to save us?
Well, yes, because then Danny can get tickets. You know, she's coming to London, and I'm sure you're standing in line for that. There is
for research purposes.
There's an argument about the big tours this past summer having added a lot to GDP. The numbers are kind of all over the place, and it depends on what you use as a multiplier, how many extra jobs are created by the jobs that are created. But there are rock tours and music tours every summer, so I'm not sure how many additional people got hired. Taylor Swift had 2 crews alternating, so maybe they added a couple hundred people to the payroll, but that's not going to make a big difference in the overall number of jobs. And besides, all those people would have started back in March when she started her tour.
Yeah, well, Taylor Swift's too busy with football and going to football at the moment. So maybe
don't go there.
Maybe
don't go there, Manus.
Don't go there. Maybe that's a broader conversation. Mike, good to see you. And we look forward to you breaking those numbers on surveillance in just a moment from Danny and I. Look, you know, we didn't break anything, did we, Danny? But the bond market felt as if at one stage this week it asphyxiated at just over that 480 level on the 10s.
Yeah, I feel like Mary Daly in saying we didn't do the thing, the bond market did the thing for us. So an eventful week. That's it for Bloomberg Brief. Surveillance is ahead. Good morning from London.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
It feels like something's cracking.
I think it's problematic for the equity markets that you're having such convulsive moves in the bond markets.
These high yields are starting to spread into credit.
We are not calling for a recession. We think that call is premature.
The economy is not going to be able to handle these rates, but the Fed is going to be the last to admit that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market positive by 0.1% on the S&P 500, poised potentially for a fifth week of losses on the S&P 500. In the bond market, the epicenter of the pain over the last couple of months, the epicenter of the headlines worldwide. TK going into all of that. 170 the estimate on Wall Street.
170 an estimate on Wall Street. We're going to conflate here a lot of economic talk. Mike McKee with our leadership at 8:30 and John the markets as well. And my major message here at 6:00 on a Friday is the markets still matter. It's going to be fascinating to see the reactions towards the jobs report and at 8:31.
Drum roll, I want your reaction to this. Is bad news, good news a little bit later this morning. Do you want to respond to that? Good news, bad news, good news?
No, you know how much I hate that. I get confused by it. And I'm sorry, employment in America is a big deal. 170 is frankly a generous number. And the unemployment rate actually matters this time around.
The ADP report was a little bit of a test for that theory earlier on this week. And Lisa, for ADP, bad news was kind of good news.
Except that if you look at some of the revisions from a lot of different analysts, they've actually revised upwards their expectations for what we get for the jobs report. The whisper number is 187,000, similar to what we saw last month. There is this question, though. At what point is it just bad enough to be good news, but not too bad to be actually something that's economic Armageddon? And really what I'm feeling is everyone's waiting for something to break this cycle. And even though we have a little bit of common markets, there's still a 4.73% on a 10-year Treasury.
Amazing. My favorite note on a Friday comes from Michael Hartnett. It's called The Flow Show. Comes out every Friday morning. And in it, there's a question that he gets asked, and he provides an answer. Here's the question. What is no one asking you about? Here's the answer. 2024. How bizarre is that, Tom? Here we are in Q4, and it's so weird that we just need to get through the fourth quarter. Hardly anyone's talking about 12 months out
This is
next year.
so important. I'm old enough to remember as Steve Whiting that we used to have a 3-year vision. People like Steve Whiting would sit there and go, we believe 2027, boom. And it's just come in with the pandemic and with the shock of this bond market, with a lot of the media catching up with what you and I have been talking about price. The answer is the vision is maybe out to Halloween.
Let's talk about the vision forward. A couple of companies thinking about the vision forward. Pioneer Exxon. Let's check out those pre-market. TK, Exxon very recently, all-time highs. I understand that Darren Woods is looking for something to buy, and that Scott Sheffield might have something to sell, because Mr. Sheffield is looking to retire, and Pioneer might well be on sale, according to the Wall Street Journal.
On a game theory basis, my headline here is they've only got one person to sell it to, ExxonMobil. One is number 2, one is number 4 in the Texan basin. People are expert at this. Amory Sen to join us here with some perspective as well. Frankly, Citigroup leads this morning with a terrific essay. We'll get to that later. John, let's look at scope and scale quickly here. Employees, Exxon and Pioneer, you know, it's maybe a 9-to-1 ratio, 10-to-1 ratio, and you've got free cash flow as well, about a 9-to-1 ratio.
Lisa, we're talking about potentially Exxon's biggest deal since '99, a $60 billion takeover.
Is this the beginning of reinvestment in fossil fuels, or is this the beginning of just basically consolidation as much as you can right now for cheap? Because there is this feeling that if you have big pockets, you'll be able to do things for a smaller company that the smaller company can't do on their own.
Exxon has big pockets. That stock is slightly negative in the pre-market. Pioneer a little bit higher. We'll talk about that a little bit later. Here's the price action if you are just joining us going into Payrolls Friday. Futures are positive by 0.2%. Yields are a little bit higher by a couple of basis points, 473.81. The euro going absolutely nowhere. Bramo 105.57.
I'm wondering if we could really write the obituary on some of the bond market disruption if we do get some sort of upward surprise at 8:30 a.m. We do have the U.S. jobs report. The expectation is for 170,000 jobs, down from 187,000 last month. However, as some people are expecting, the whisper number is for it to be the same as last month with a declining unemployment rate. If we get that, what does the bond market look like? 9:45 a.m. I am so looking forward to this discussion. U.S. Acting Labor Secretary Julie Su joining our very own Jonathan Farrow on Bloomberg Television to talk about the labor market. Very curious to hear what she has to say about some of the labor movements and some of the action there.
He's going to grill.
I think it'll be a really fun interview to listen to.
This is going to be very polite, very relaxed. Tell us what you're seeing. What's happening? It's going to be that kind of conversation.
How do you feel?
How do you feel?
He comes on.
How do you feel?
The earnestness.
Isn't that what I usually ask policymakers how they feel, right?
Always.
How do you feel?
What is your childhood like? Okay, 3 p.m. we have U.S. consumer credit for August coming out, and I think this is also pretty interesting at a time where you are seeing credit card debt rise at a significant and accelerating pace. How much of the consumer strength is being fueled by debt? Is this a warning sign or just a re-leveraging on pristine balance sheets post-pandemic?
Lisa, thank you. Steve Whiting with us this morning, I'm pleased to say, here in New York in the studio, Chief Investment Strategist, Chief Economist at Citi Global Wealth. Steve, good morning to you.
Good morning.
What are you and the team looking for at about 8:30 Eastern Time?
So look, I think 170 is not too high a reading. If you just take a look at what happened in the month of August, unadjusted employment again was, held back a little bit. You already said these are trivial numbers if you really think about it, but we know them. We know that the number of strikers were down in September versus August. We know that claims were quite low. So if the reading is in line with that Bloomberg whisper number, it wouldn't really surprise me too much. And, in the big picture of things, the last 3 months, Chairman Powell pointed out at the FOMC, was 150,000. The prior year was 430,000 for the same 3 months. So if it's not slowing fast enough for everyone, if it's not collapsing so we know it can only get better, I'm sorry. It's in a very gradual slowdown.
Two-part story, the data, how the market responds to it. TK hates this stuff, but we have to talk about it. Is bad news good news today?
Well, look, I think that there's been just tremendous apprehension. There's signs of capitulation. The Bloomberg's measures of market liquidity, again, have weakened for the Treasury market. Shorts look to be at record highs, but whether or not we can come to grips and change that trend on an employment data point, I'd be guessing to say. But it'll be fascinating to see the actual results.
I'm going to get to the profit picture, which you're expert at in a moment, but I've got to ask you about the bond carnage we're seeing, and folded into a piercing paragraph in your note, it's not the 1970s. Is it just simple? Is disinflation to the rescue?
Well, I think that you'll see measured disinflation in the CPI in the coming year, for sure, just like we saw it this year. I mean, we were at a peak of 9, we got to a low of 3, we're headed a little bit back up. But by the end of next year, particularly shelter measures are going to be much lower on the CPI readings. Now, whether or not this is satisfying everybody about the long-term inflation outlook is unclear. But yields here again, where you take a look at real yields at 2008 levels, another period we had some difficulty with liquidity. If you believe the economy is slowing, this is satisfying. I have to say that the long end of the Treasury market with an inverted yield curve, it's counting on the Fed cutting rates. And that's what's been embedded for a long period of time. Just the mere fact that you're not collapsing the economy, the Fed is not shutting us down very hard, that's going to be hard to maintain that inverted yield curve, and that's part of the pressure here.
Right.
So it's really, again, much more of a normal rate than it is either 1970s or 2020.
The heart of my analysis, which goes exactly to what you've done for years at Citigroup, is to analyze corporate profits within the broader economic algebraic function. Great. My theory is the corporations will adapt like they've done before. Do you agree with that?
I do, and it's been a tough period to adapt. I mean, if you look at this past year, the rate of employment growth has exceeded GDP growth by the most since 1974. One of those really great years. So it's been an unusual period where labor markets have outperformed the economy. But that edge that the labor markets have, despite all of the labor action, I think is receding. And the coming year, like jobless recoveries of the past, is going to see the labor market slow. I think output actually has a chance of gaining some steam, particularly over the next 2 years.
John mentioned Michael Hartnett over at Bank of America. He also said this: bonds should be the best performing asset class in the first half of 2024. This is partly predicated in the idea of something collapsing or being taken down, some accident, something happening in markets to cause some sort of downturn. Do you get on board with this?
It's hard to find this area of collapse. And, by the process of elimination, we find that there's all sorts of things are already happening now that make it hard to really generate a collapse. And, again, why? If the inflation rate is coming down, if we happen to have a low unemployment rate, is that enough for us to force a collapse in the economy? I think the Fed could collapse the economy if it really wanted to. When I take a look at the massive delivery of multifamily apartments that are coming, about 1 million that are still ready for completion, this is an issue. Do I see that as a larger issue than the larger geopolitical risks? No, I don't. So sector by sector, we go through this. Look at the ISM report, how the manufacturing sector has been contracting for a year. Trade across the world has been contracting for a year. Residential investment down over 20%. Is this just the beginning? I don't think so. I think we're going to be in another period very similar to the Fed's forecast, where the economy stays below trend, where it's absorbing, these losses. And unfortunately, but it's not this clear as day V-shaped decline in recovery.
So what I'm hearing from you is bonds maybe not so good, because if we could stay at this level and nothing breaks, then it's not necessarily a given that yields go down. And on the other side, you could see some of the stalwarts, the tech names, do all right, muddy through because they're growing revenues, but the rest of the sectors are going to continue struggling.
It's always wonderful when you can just say one asset class will greatly outperform the other, when the reality is that they're going to perform together to some extent. That if bond yields decline, there will be certain equities that do well, even depending on the reason that yields fall. But I think it's important to see that the bond market can still be a successful place to invest if you hold to maturity, if you hold bonds of 4 to 5 year maturities with 6% yields in the investment grade corporate market. I mean, this is going to be higher than the cash yield over that same period.
I know we can't do single names with you, but I've got to ask you about what's happening in the energy patch this morning. Exxon nearing its biggest deal since 1999 with Pioneer, based on the reporting from the Journal and according to a person familiar with the matter that we've heard from. When you wake up and see a deal like that, potentially 60 billion US for American oil, what do you take away from that?
I think OPEC deciding that it's going to decrease its market share and it's going to cut production more than the entirety of the rise that we have seen out of American oil producers, again, is providing value, soft landing, all of this to every Western energy producer. And if you want to talk about alternatives or conventional, we're building redundancy in the energy market, and it's benefiting everyone. And it means, again, a relatively higher price, but it's going to benefit energy producers outside of OPEC that they've done this.
Is it a sector you like then?
I think it's a sector that we think is going to be firm, that's going to be solid, and it's usually one we worry about in slowdowns. This is a case where I'm not worried about energy. in a slowdown.
That's a big change.
Yes.
Walk us through that.
Well, the typical energy sector response to recession, and again, my view of recession is it's not quite that. It's a real slow patch. But the typical average recession, the last 4 times, the energy sector was unprofitable, right? About a 100% drop. And we're not talking about the special case of 2020 with negative oil futures and loss. So it was horrendous. But even all of these other downturns, you've seen oil plunge to the 30s, to the 20s, and you've seen unprofitable energy companies. And American producers have been cautious. They've been raising production very slowly and conservatively, and under those circumstances where there are significant supply risks around the world, Russia its oil exports are 6% of global consumption.
Yeah.
These things and OPEC cutting, all of these things together, has really arrested the decline. The energy sector is not going to suffer the kind of losses and a slowdown that it has in the past.
Hey, Steve, it was great to catch up.
Thank you.
Steve Whiting, Citi, on Payrolls Friday, on the potential there for a big deal for U.S. energy. From New York City, much more still to come. On a payrolls report, the estimate 170,000 in our survey here at Bloomberg. Coming up through the next hour, Priya Misra of JP Morgan Asset Management. Do not miss that conversation. From New York this morning, good morning.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
So you're not selling the Patriots, you're not selling the packaging company. I guess you don't like to sell things, right?
I really don't. We try to create a family environment in everything we're involved in. People want to be part of something that's bigger than themselves.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, today on Bloomberg Television and Radio.
The second area that we think is really attractive is energy. This is really, again, it was the darling last year. It is actually at a very, very important technical level right now. If you look at a variety of different things, whether it's XLE or other variables, we are sitting at some really key levels. So understanding what we look into earnings season for energy market is still that discipline from corporations they've really been forced to by shareholders. So energy is interesting.
Energy is very interesting this week, that's for sure. Eric Friedman, CIO at US Bank Asset Management. Crude, the underlying commodity, heading for the biggest weekly loss going all the way back to March. Speaking of deals, according to reports here at Bloomberg, the Wall Street Journal, Exxon in talks to acquire Pioneer Natural Resources. potentially for 60 billion US dollars. More on that in just a moment. Let's turn to the price action. This payrolls Friday. The estimate at the moment 170,000. Equities on the S&P 500 slightly positive by 0.3%. A little bit of a lift here. Yields high by a couple of basis points. 473.81. But what a turnaround in the oil market. All the way back down. TK to 82.53. Slightly positive this morning, very negative on the week.
It's going to be interesting to see. And the major thing about it here, coming down from the 100 level, 90, whatever it was, down to the 80s here, is not so much that we came down, but it was the speed of it. And a lot of the research I read, brings it right over to
resolutions or, again, Ukraine. So the U.S. government is working just fine. It's just that anything that requires a decision from the House of Representatives is not going to happen, not by next week, probably not in 2 or 3 weeks.
James, what do you make of this whole border wall issue? The fact that President Biden came out yesterday and basically said, my hands are tied. I have to finance this thing that I said that no more money would go to this. Is this basically a way of him having his cake and eating it too, coming to some compromise and looking like he's doing something about the border without having accountability?
Well, it's a tricky issue because there's not going to be any funding for Ukraine unless there's some movement on the border. I think that if you parse what the House Republicans are saying, they're not categorically opposed to Ukraine in all circumstances, but they want to see border funding at the same time. Meanwhile, if you look at the polls, Republicans are currently at a 40-year advantage over Democrats in issues such as immigration, the economy, and crime. It's really ironic that Republicans have such a commanding lead in the polls on the top issues that voters care about, and yet they're completely feckless in the House. They're wasting this opportunity. I think this, in part, is a defensive move by the president to deal with the issue as best he can.
Based on what you have heard, there's a lot of disagreement within the Democratic Party about how to go about reforming immigration policy, which may be why President Biden is trying to lean into one idea and say that it's out of his hands. Are you hearing the Democrats coalesce around anything concrete with respect to immigration policy and having a serious conversation about it?
I think they are. I think that the first thing, the most important and hopeful thing is that at this point, both Democrats and Republicans recognize that there is a problem here and that there is something that needs to be done. Now, would Democrats go for a border wall? Maybe not. Would Democrats want punitive treatment? Maybe not. But everyone agrees that there needs to be some mutually agreeable package here.
Okay, well, what is it? You've got decades of experience of people agreeing to disagree. I'm fascinated, James, with great respect for your work at Prudential for years. Where's the compromise on immigration? I, frankly, with respect, don't see it out there.
I'm not sure I see it either. I think that simply putting some numbers on the table, more dollars for border enforcement would probably go a long way. Restoring something like the Remain in Mexico policy might go a long way. Modifying the
okay, but James, I don't mean to interrupt, but we spoke with the governor of Connecticut, who's a little bit removed from this, Lamont of J.P. Morgan, and of course all of his, focus in Connecticut. It's a unique story to say the least. Governor Lamont told us, stop them at the border. Isn't that the national attitude?
That is the national attitude, absolutely.
I'm fascinated how we legislate stop them at the border. Have you heard a theory?
Well, again, more money, border technology. I think the problem with the wall, more than anything else, is that President Trump made it so iconic, so totemic that it's untouchable for Democrats. But, everyone agrees that the situation in cities like New York, Boston, cities across the country is becoming untenable because it's not just the frontline border states, Texas and Arizona, that are dealing with this flow. It is now downtown New York.
James, when you talk about how the Republicans have been unable to really capitalize on this, where do you see some of the discussions going in the House and the certainty of a government shutdown come November 17th?
Well, I think the shutdown is fairly certain because there's been no progress whatever on moving appropriations in the House or the Senate at this point. The real question is how the House could possibly pass a continuing resolution on November 17th. I do think that something will get done eventually because what's going to happen is that the Senate will pass something, send it to the House, and that bill from the Senate will eventually be moved by means of what's called a discharge petition. So I doubt any shutdown is going to be more than a couple of days, and there is a mechanism for resolving it quickly. But if you see a potential speaker like Jim Jordan, a Jim Jordan speakership is not going to be one that is congenial to getting a CR done. So, I think we've got to count on a shutdown, assume it lasts a few days until the discharge petition kicks in, but the next one is going to be longer and harder.
So, James, just to put a bow on it, just to jump in, you get Jim Jordan, base case shutdown?
Yeah. Yes. Well, actually, my base case is shut down no matter who wins right now. I think that while Scalise and Jordan are the leading candidates, neither one is certain. There could be a third person, but I just don't see how anyone will be ready to handle the CR by November 17th. I hope it's a short shutdown. But what worries me is the prospect of multiple shutdowns after this and a major showdown on a large appropriations bill or series of appropriations bills at the end of the year.
I think we all hope we don't have to talk about it anymore, but I think we expect we will. James, thank you. James Lucy there of Capital Alpha Partners. TK, base case shutdown. He's not alone. I don't think it's contrarian. Then that's rather consensus going into November 17th, isn't it?
Let us remind ourselves, and I have the image of walking into Ames, Iowa, into real wrestling years ago, John, which I can't even explain to you the impulse of that. Jordan is a legit Division I stud in wrestling. The football equivalent is like he won the Rose Bowl and scored 3 touchdowns.
Are they skills he's going to need? What are you implying?
Those are skills. Lucier, I've known Jim Lucier for years. He is the most deadpan analyst in Washington. And the backstory here is we're going to have a wrestling star. I mean, this guy's heavyweight with an economics degree, I might point out. But Jim Jordan, in his shirt sleeves, wrestling the house is going to be absolute original history.
I think his demeanor, Lisa, captured the moment, didn't it? It's how most people feel about this story.
It's just basically resignation and basically, you know, they're kind of ironic amusement as you watch.
A lot of voltage there.
1 hour away from the payrolls report. Ellen Zedner, Morgan Stanley, coming up.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. ON's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer this Wednesday on Bloomberg.
60 minutes away from the payrolls report in the United States of America. 170,000 is the estimate in our survey. Your equity market going into it slightly positive on the session, down on the week, up by 0.2% on the S&P 500, up by 0.22% on the NASDAQ 100. In the bond market, phenomenal moves over the last couple of months. 474.22 on a 10-year, up by 2 basis points today, heading towards 5 consecutive weeks of yields climbing, Tom, on a 10-year maturity.
I think we need to frame this right now. It's so important, is that problem in bonds sustains this morning. It's ever so slight, but I got yields set higher this morning. I got 210 spread like a rock at negative 30 basis points. And as Priya Misra talked about, I got a 10-year real yield higher this morning, 2.43%. So there's that tension into the report.
Speaking of tension, we had a 30-year nominal yield 3.5% earlier this week, 490.67 at the moment, up by a couple of basis points. The fate of this bond market today, at least, potentially in the hands of the jobs report, which is just 60 minutes away. In foreign exchange talk, tons about this. The euro against the dollar, 105.54. Slightly positive today, slightly negative on the week. Least of this would be 12 weeks of euro weakness against dollar strength if we closed here.
Who's going to go long euro right now? What is going to be the motivating factor to go long euro at a time where U.S. data has been outperforming and you have oil prices that are seriously in question? This is the challenge at a time. And I do wonder, based on the volatility and lack of conviction, a job surprise to the upside, what does that do to the euro?
Yeah, not good things, you'd imagine, based on the price action we've seen so far off the back of high yield, stronger dollar. The other way, maybe Lagarde sitting there wanted it to go the other way. I don't know. I'm just saying.
You think he's trying to game the jobs market?
Just throwing that out there. 60 minutes time. The median estimate in our survey calling for a print of 170,000, with the range of calls from Wall Street's biggest banks. Citi at the high end, 240. Wells Fargo at the low end, 150. We'll catch up with Alan Zentner of Morgan Stanley in a moment. 180. That 240 over at Citi. Andrew Hoddenhorst, TK, still looking for another hike from this Federal Reserve.
Well, it shows the disparity, and what we're doing here at Surveillance is we're talking to the different opinions, and to go from Wells Fargo to Citigroup here shows that the efficacy of 1 over the square root of n, the standard error of this report, is ginormous. It's embarrassing how everybody has to be certain, but they're really not certain.
Let's talk about a deal, the potential for one.
Yes.
Exxon nearing a takeover of Pioneer in what would be the company's biggest acquisition since merging with Mobil back in 1999. The deal could be worth as much as $60 billion and maybe finalized in the coming days, according to the Wall Street Journal. This morning, Lisa, Pioneer up by 11%, Exxon down by about 2.4%.
So synergies here in the shale patch, I believe it values the shale patch at, $60 billion or something of that nature. At this point, I do wonder whether policymakers in the U.S. are going to sign off on this very happily, to say if we can have something that's as efficient to be competitive with the Saudi Arabian OPEC plus complex, well, kudos to us, because go back to the energy independence, that might be what people are looking for after what we've seen over the past couple of years.
Do you get a seat in Vienna if you're producing 1.2 million barrels a day? If you're a country, you probably do.
If you're a country, you do. I don't know. I doubt it. I highly doubt that they want to really include this particular part of their club.
Amazing. Amazing to see, Tom. Just an absolute monster.
We're so time compressed with the news flow this morning. John, let's do it real quickly. Scott Gruber's at Citigroup. He was at Sanford Bernstein with Bendel, and pros look at this transaction. They do not look at what the media is looking at. They say to themselves, if you take out a set of synergies, what are they buying on West Texas Intermediate equivalent when they buy Pioneer? And the answer is they're buying a blended average, this is my approximation, of $69.25 West Texas Intermediate, and then Citigroup sets that up to their $78 bogey, and they say that's the arbitrage where Exxon comes in and they get a gross up off the post-synergy value.
WTI,
that's how the adults look at it.
Right now, Tom, 82, Brent crude, 84. Let's finish on this story. Tesla cutting the price of its Model 3 and Model Y cars in the US after its third quarter deliveries missed estimates. The Model 3 and Model Y cars account for the bulk of Tesla's sales in this country. The stock a bit softer here by 1.4%. Lisa, I've now lost count.
Exactly.
How many times this has cut both ways this year so far?
But this comes on the heels of a disappointment when it comes to deliveries. And that, to me, is really telling. It is also telling when you have BYD, basically of China, eating their lunch. I mean, they are selling cars at a much lower cost point, and they have the backing of the Chinese government. And so what's Tesla's game plan at this point? What is their edge?
What is the brand destruction of the uncountable price cuts? I just don't get it. How do you feel if you bought a Tesla, whatever, X months ago?
To be honest with you, I'm not thinking about Tesla or the Chinese manufacturers. I'm thinking about everybody else. This is a war between some people who can have that war. Tesla, the Chinese manufacturers, everybody else. This makes it very painful for Detroit's Big Three to get what they're trying to do off the ground, Tom, up and running to compete with Tesla and the Chinese manufacturers.
We begin our jobs coverage. We do so with Ellen Zentner, Chief U.S. Economist here. We go into the next hour and then beyond. I want to go to your wheelhouse, which is your reading for the years you've been doing this of the American consumer. Into this jobs report with a summation of Morgan Stanley research, including an analysis of small business, how flat on their back is the American consumer?
So I still think that the lower income consumer is struggling. I do think with their real wage growth turning positive as inflation comes down, it's been getting better. But job growth is slowing, so overall labor income is slowing, and that predominantly drives spending. Credit quality is still good. And you can see that delinquencies are rising among subprime consumers, lower credit quality segments. And you could breathe a sigh of relief and say, yeah, but it's only just risen back to pre-pandemic levels, except the pace at which that deterioration is occurring is worrisome. We don't think the bottom is falling out of the consumer, but I think already we've seen early signs of credit card data that have really fallen off in September. And whether that's the Taylor Swift effect fading, the Barbenheimer effect fading, it's going to be seen in the numbers. And it's going to look like a tremendous loss of momentum.
The bottom fell out of the Treasury market. Can you give us an idea of what the conversations with Matt Hornbeck sounded like this week when you two were talking about what's been going on and what it means for Fed policy?
So I think there's the strategist side of it, right, which is flows. You've lost a lot of big buyers that just aren't there, including the Fed. And that's driving yields higher. From an economist perspective, it's why does the market suddenly believe the Fed? Why do they suddenly give 110% probability that the Fed is going to be right in its forecast and deliver exactly the kind of policy restriction for this long? Tom mentioned 2.5% real yield. That's only going to get higher the longer they remain on hold. And the thought that the economy could withstand even higher real rates from here for a quite extended period of time, I just think is a pipe dream. And if I were the market, I wouldn't say, yes, you are right. You've given me the stop plot. You've told me this is what you're going to do. Why? Why are they suddenly putting all their eggs in one basket?
Well, you mentioned two things there. The big buyers stepping away and this general acceptance of what the Fed is saying. So are you saying that it's more heavily weighted to accepting the Fed's forecast and not the latter? In other words, that this is truly just a misperception in markets versus a structural change that could keep rates higher, even if, the Fed does shift gears in any way?
Yeah, so I do think that structurally real rates can stay higher for a time because we still need to be restrictive, right, in order to ensure that inflation continues to fall toward goal. You're asking the million-dollar question, right? How can you extricate the two and say, okay, this is the basis point owed to flows, and this is the basis point owed to just a difference of opinion and outlook, right? You do have to have some risk built in that the Fed is right and you're wrong, right? It just seems to be an extreme. And if I'm a policymaker, I'm looking at these moves and saying, you're doing a lot of the work for me. And so maybe I don't need to be as restrictive. There's still a lot of effects to come through to the economy from this.
From an economist's point of view, does this increase the chance of a hard landing from your perspective?
Well, I think when in the volatility that we've seen, and in particular how quickly financial conditions have tightened, if that's sustained, then absolutely chances of a hard landing go up. I mean, I know on prior shows I've come in and talked about our recession probability. We've had a soft landing call for so long. My probability of recession is well higher than my peers. who only just embraced the soft landing. And why is that? Because when you think 12 months out from here, we're not out of danger. I still have a 40% probability of a recession occurring within the next 12 months, even as I've had a strong call on the economy. We are seeing things slowing, and the ugliness under the hood can come out pretty quickly.
Well, I want to go right there. You've got Eric Stein at Morgan Stanley. He's something. He was for years at Eaton Vance up in Boston. He's got some serious academic cred out of the University of Vivaldi up at Boston University. What are you learning from your bond people, like Eric Stein, that you're folding into your economics?
So that we don't think real rates are going to remain this high for this long.
How many basis points on a 10-year yield? How many basis points will they come in? You're looking at 10 beeps, 20 beeps, or a substantial?
Oh, no. Well, Matt Hornbach, Lisa mentioned that I work really closely with, right? They're oversold. It's oversold here, right? And so I would imagine more than 30 basis points.
Bottle that.
Bottle that.
You heard it here. 30 basis
on the bond market.
Zettner to the rescue.
Hornbach.
Zettner to the rescue.
Okay.
Come and save the day.
And then I think you're going to stick with us, hopefully. Alan Zettner of Morgan Stanley. Just to get you up to speed on some of the price action elsewhere, the equity market on the S&P 500 here, positive by about 0.1% on the S&P. In the bond market, shaping up as follows. Yields a little bit higher today, a whole lot higher over the last couple of months. Your 10-year looks like this. Yields up by 3 basis points, 4.7464 in foreign exchange. Lisa, this is the one for you, I think. 105.55. The ECB watching this one closely at 8:30 Eastern Time.
I just think that it really highlights how this has been driven by U.S. strength in addition to European weakness. Honestly, the story really is in the bond market, though. Really, if we do get an upside surprise, how much more of a, I don't want to say disorderly because I think that that will trigger some people, but I think that there is sort of a violent move in yields.
A Wall Street type sensitive. They get triggered.
All the
words,
time.
like disorderly.
Like disorderly, hives. But there is a question of, whether we end up getting a similar type of jump condition upward that really does follow on the heels of this report.
I go back to that note from Michael Hartner this morning of Bank of America. Question, what is no one asking you about? Answer, 2024. Just seems to be this focus, the obsession with the next month.
X-axis
the next
is
4 weeks.
Yep. Absolutely. I just did, because Zettner ordered me to, a 2 standard deviation study of the Zettner call of coming in 30 beeps on 10-year at real yield. It gets you nice through the 50% tendency and right sitting on the long-term average. That's how fast we've come up, that even if we get the Zettner move lower in real rates, we're still sitting nicely on the long-term trend.
If you are just joining us, welcome to the program. Your equity market just a touch firmer here, up by 0.1%. If you want an outlook from elsewhere, this from Citi, Andrew Hollenhorst, saying this: despite the rapid rise in Treasury yields, Fed officials are likely to maintain their higher for longer rhetoric and proceed with a 25 basis point rate hike in November. And then let's build on that a little bit. Do you think it changes much, this move we've seen in the bond market in the last month?
No, I think the bond market's focused on the higher for longer theme, and whether the Fed hikes another 25 basis points, the market has already half of that expectation priced in. I don't think that changes much. I have a very strong view in the other direction. I think they are done here. We've been calling for them being done here for a time, and I think you build on that the longer that financial conditions remain this tight. Right? Again, going back to the market doing some of the Fed's job for it. I'm still chewing on what Mary Daly said yesterday. I mean, she gave us a mouthful, and that is the way policymakers are going to be shifting, right? Financial conditions have tightened. They've tightened in a way that leads to uncertainty. Uncertainty means the prudent step right now is to just remain on hold.
You think she represents the consensus view on the committee?
Well, I don't think that she presents herself as I am the consensus on the committee, but other policymakers are already moving in that direction.
So your disinflationary vector's in place, and it will give the Fed ability to move when? Not November, out a couple meetings.
No, I don't think that I think the next move is a cut. I think that they're on hold from their July meeting when they delivered the last hike until March of next year. And that is well earlier for the start of cuts than the market, but that's an 8-month hold while real rates continue to rise during that time and inflation is still coming down. Again, difference of opinion and forecasts.
Ellen, wonderful to do this every Payrolls Friday with you, as always. Alan Zettner there of Morgan Stanley. Coming up at 8:30, the US jobs report, and former Fed Governor, Randy Kroszner, is going to join us, as he always does. In a moment, Anna Wong of Bloomberg Economics giving us the view of Bloomberg on what to look for from the Payrolls report in about 45 minutes' time.
Steve's ability on the course may not be etched into any record books, but following him around, clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
We've already repriced, not just to the pre-COVID levels, but to the pre-GFC levels. So regime shift has really already happened. In our view, it's actually an overshoot, but it's already happened. I mean, we're at the Fed's target. We're not in the 1970s and the 1980s here in terms of the economic growth environment or the inflation environment. The Fed is telling you, they're telling you, we're not going to stop until it's painfully obvious that the economy can't handle it.
Kelsey Barrow, JP Morgan Asset Management, together with Bob Michael's team, Priya Misra, who we caught up with a little bit earlier, looking for a hard landing in the United States of America, particularly with the additional sell-off we've seen in the bond market. And what a sell-off it's been. Treasuries now priced as follows, going into payrolls, that data point about 45 minutes away. Your jobs market, 170,000 is the estimate. Your data, your bond market looks like this. Your 10-year yield up by a couple of basis points to about 474.43. Your equity market, TK, positive by about 0.1%.
We just saw something there with Ellen Zentner, who I adore, which is the partition of silos on Wall Street. And the economists really don't want to talk about what bond markets are doing. And the bond market people, of course, don't want to second guess their economists and all. We don't have that luxury at 8:31. We're going to have to conflate market reaction to this report. We're going to have to conflate in real time the theme, the what if, the probability that we extend, as Jens Nordvik says, this bond carnage. And they're in their silos, they're really not anticipating that conflation.
Alan Ruskin, Deutsche Bank, a weaker number will be believed. Put out a note yesterday, actually pretty interesting. A weaker number will be believed since it would be consistent with the 3-month NFP average that has been on a steady slowing trend consistent with the sub 100K payrolls by the end of the year. So yes, these numbers can dance around, Tom, but the trend,
the vector, absolutely,
is for a little bit of a slowdown.
And the 3-month annualized, and we talk about it with disinflation and inflation statistics, but you can do the same thing with the jobs report, as Dr. Ruskin does there. I'd go to David Kelly at JP Morgan, who was the first one I really heard within the universe say, what's the vector to a negative non-farm payrolls report? It's out there somewhere.
Well, that would be a shocker, wouldn't it? I can tell you that's not even the low end of expectations today. The low is 90.
No, that would be, no.
Do you know who's the high? Ian Shepherdson, Pantheon Macroeconomics, 250.
Well, but it's because he likes Newcastle.
And he thinks they are
so
statistical quirks. He's still looking for a slowdown. So don't take that as a bullish number from him. He thinks that's flattered by state and local education numbers, something like that.
I mean, I don't do the guess the non-farm payroll thing, but today I'd be baffled. I feel sorry for people that actually have to
blindfold top. Throw a dart. You know how this works.
Yeah, that's the way it works.
Yeah.
And along with this, that's what she does. She has a blindfold and throws it at the dartboard. Out of Chicago, and of course, with Bloomberg Economics, and we know her for one of the great calls of modern market economic history. Guess what? Rates are going up. Anna, did you ever think we would get yield up, price down as we've seen in the last 90 days?
Well, I did warn after the Fitch rating downgrade of U.S. sovereign that the bond vigilantes might come out, given that looking at that the fiscal deficit is going to hit 6% of the GDP at the end of this year. And if the economy does fall into a mild recession, as we predict, it could easily, fiscal deficit could get to 10% of GDP very quickly due to automatic stabilizers. So yeah, I think the U.S. Fiscal trajectory is not looking good, and it's just a matter of time people should recognize.
Anna, I love having you on. 3 people just drove off the Garden State Parkway in New Jersey. Anna Wong, if we get any sense, let's take a midpoint. Forget about 10%. If we go from 6% out to 8%, what does that do to the IS curve? What does it do to the real economy of America?
Well, if rates go to 8%, then there would be first a level adjustment. It is the jump from where we are right now to 8% where the adjustment will happen. But after the economy get used to 8% interest rate, there'd be like, the now baby boomers who survived the 1980s and say, well, my mortgage rate was 12% back then. It's okay.
Lisa, I guarantee you Dr. Wong is never going to get a job at a White House. Doesn't matter who's in charge. Wong is never going to work at CEA.
Well, Anna, on the way to 8% mortgage rates, there is a question of the labor market, which how is it going to hold up through all of this time? Why are war notices important?
Because war notices tell you where the layoffs are coming from and where it will start to show up in the jobless claim. So a big mystery right now is how low the jobless claim is, right? But war notice actually could lead the jobless claims by 60 days to 90 days, 2 to 3 months, because after people are laid off, they still get severance, and so right now what we are seeing is that the notices, war notices in Sun Belt and in Rust Belt have been rising, even as California's AI boom is causing improvement in unemployment. So I think what we're going to see in the next couple of months is more troubles in places like Arizona, Texas, Colorado, Idaho, places that had benefited from the pandemic, migration.
Why is this going to lead to a higher unemployment rate versus just simply the churn that we've seen in the economy moving over to the labor market?
That's a really good point, because I think there is some truth in the idea of rolling regression. We're seeing California, layoffs coming down as Sun Belt layoffs go up. But I think ultimately the unemployment rate in California is not going to fall fast enough to offset the unemployment rate increase in other places.
So right now, as you look for this particular report, do you agree with Ian Shepherdson that we could get a surprise, upside surprise that's just simply distorted by everything and all the technicals? Or are you looking for something to really highlight that weakness that you see in these Warren reports and in some of the shifts that you're seeing in the Sun Belt, in Idaho?
Yeah, absolutely. I'm with Ian Shepherdson on this one. I think the risk is tilted to the upside for this report. We still have a lot of catch-up hiring in healthcare sectors, but there's just so many shocks in the next couple of months that I could see a negative payroll report by the end of the year.
Anna, you've been brilliant on the y-axis. I want to take you to the x-axis right now. If we don't get the Anna Wong movements, the what-ifs, maybe the probability of higher rates, what if we just stay here with a 10-year real rate of 2.4%, that, 5-ish or under 10-year yield as well? What are the ramifications for the jobs market in American GDP?
I think if we stay here, if we don't move lower, then what you're going to see is the consumer's delinquency rate is going to rise, because the denominator, which is income growth, would be softening, but the numerator, which is interest rate compounding their debt, would be growing way faster. And so what you will see is that consumer will have problems, and then firms' profit will fall. You will have that short and mild recession.
Anna Wong, I just got a note from Andrew Honhorst, the city, an update from him, actually responding to Lisa's interview conversation with the San Francisco Fed President, Mary Daly. He said yesterday, President Daly suggested that the rise in 10-year yields might be a substitute for a 25 basis point hike. He says, we think the center of the committee will remain data dependent in determining whether to raise rates on November 1st. He's looking for a hike. Anna, what would you say back to that?
I think there's a substantial risk of a hike in November, and I think the bigger report is actually next week's CPI. We think there's an upside risk for core CPI to be 0.4 due to higher seasonally adjusted used car prices. So yeah, definitely it's on the table.
Looking for a hike potentially in November. Anna, thank you. Anna Wong there of Bloomberg Economics. There you go, Lisa. Start a conversation on the south side here. That conversation you had with Mary Daly yesterday. Looking for a 25 basis point hike still over a city. He does not think it represents the center of this committee.
Although we heard from Ellen Zentner that she thinks it does. So there's a sort of a split idea based on where people shake out in terms of the economic data. I think ultimately it will come down to whether the data does continue in some sort of more accelerated pace. But if that's the case, and if you get some sort of significant increase in longer term yields, does that change the scenario even more with respect to financial tightening?
What we have been through since 2007, the third week of August 2007, is Ellen Zentner said in her note, the uncertainty of this report and its effect on the markets. Can I say we've never seen this? I have a 10 standard deviation move in the inflation-adjusted real yield. Like I said earlier in the week, it was never Tuesday, never ever Tuesday. Hey, guess what? Fridays, we're still going to Never Neverland right now on Friday.
What's the Tang like this morning?
The what?
The Tang.
The Tang is good. Tang Zero helps out. I've had problems with my feet. And the doctor told me...
Had a little bit of an accident.
Yeah, we had a little bit of accident.
Yeah,
I was reaching for the Tang and I spilled
mopping it
over
up
here.
for you.
You know, Farrell helped mop it up. The interns helped as well. Sure. And you know, I've had to cut back on the Tang actually. You know,
that was a full cup, whatever that was.
It was.
It's all on the floor now.
It was. You know.
I cleaned your phone for you. I think I've rescued it.
Is it okay?
Don't worry. I think it's just about okay.
It's a reason to get the new iPhone, right?
Rice.
Nadia Lovell of UBS Global Wealth Management coming up. Your payrolls report 34 minutes away. The estimate 170,000. Equities higher by just 0.1%.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What would be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things. But that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Obviously, we're trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. what that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
The ability for markets to move very quickly is very high.
The economy is still in a good place, not a great place.
I think that there are some places that are going to continue to be vulnerable.
I think we're getting closer to a point where the Fed will have to acknowledge that there's something more significant going on.
They're fighting inflation that I think is already clearly coming down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Yes, it's Jobs Day, but it's a different Jobs Day here on Bloomberg Radio and Bloomberg Television. Lots to talk about. John, I'm going to talk about the seismic shift from the last Jobs Day. Take the old benchmark before your time, 30-year U.S. bond, like 4.30%, and it's 4.90% this morning.
Well, back on the first day of last month, Tom, it was 4.18 on a US 10-year. Right now, 4.75, pushing 4.90 earlier on this week. New cycle highs over the last week.
We're going to conflate what's going on in the markets into this report in 29 minutes. I can honestly say I think it's the first time I've ever done that in all these years, and that's the level of carnage that's still out there.
So let's go through the numbers. 170,000 is the median estimate in our survey. There's a pretty wide range. At the low end, 90. At the high end, 250. 240 is the view from Citi. I keep going back to Andrew Hollenhorst, Tom, who, despite these moves in this bond market, still believes this Fed can go again in November.
Yeah, well, the debate's out there as well, and the debate's also with the Fed, and the lead on that is Lisa Abramowitz's wonderful, delicate conversation with Mary Daly of San Francisco yesterday. You know, I figured, you'd have some rubber chicken, get through lunch, have a good time. And you made some real headlines. What was the distinctive message from Mary Daly within Jen Nordvig's bond carnage?
Well, you heard this from Ellen Zentner, that there is a financial conditions tightening that is going to offset what the Fed might have to do. That basically what we've seen in the bond market might supersede the need to hike rates again. The question is, how sustainable is this? How much does this crimp economic activity if we still see incredible strength that is surprise to the upside the way that Andrew Hollenhorst thinks? Well, then people might think, well, even if we do see that kind of tightening, it's sustainable, and we're looking at an economy with some other intense drivers that have legs.
And John, off this Jobs Day and wage growth, which is sort of the price dynamic of the Jobs Day, the question is, are we super restrictive? Are we fighting the last war?
We're going to find out, aren't we, based on the next couple of reports. Problem for the Federal Reserve, and I think the problem really for bond market investors right now, Tom, trying to work out what this data means for Treasuries after the move we've already seen. Well, it's been a massive move already over the last 5 weeks.
Brilliant. We didn't talk about this, and folks, the conversations, Kelsey Barrow that we had yesterday, Peter Cheer, Priya Misra this morning, and Priya talked about the migration. Lisa, this is your world, migrating out from full faith and credit treasuries, and the bad things that happen there end up migrating out into credit and then into distress.
Well, this is the key issue, right? We don't understand what it means for a company that grew up in zero rate eras to suddenly have to refinance at a 9% era for a high yield company, at a 10% rate? And at what point does this become a fundamental concern that threatens the viability of some of these companies?
That's not a zero coupon bond, John. That's a zombie coupon
It's
bond.
the knives and forks on the plates that I don't like at the Economic Club in New York. As the conversation's going, why can't they eat before the talk? Why do they have to eat during the talk?
Full disclosure, folks, and I sometimes...
It makes it so hard to listen to. It's usually you with the knives and forks on the plates.
No, the tradition on the podium is we don't eat until after the speaking and the Q&A. And I go in there starving because they've been up since 3 a.m. and I want to hit the rubber chicken like nobody on the stage.
Like nobody's business.
Get out of my way.
Well...
are we here? Let's do a data check.
I thought Lisa was going to say something.
Okay, well, I'll just say this, that actually they put the salad out first, and then they serve the meal afterwards. So they actually are trying to cater to some of those concerns.
The salads.
Yes.
Okay. Equities on the S&P. We'll get back on track. Positive by 0.1% on the S&P 500. Yields here, TK, up a couple of basis points. 473.81. The jobs report. 25 minutes away.
Well, that's where the yield is right now. I'm going to look at the VIX, 18.63, and the equity market really okay. What's happened? Not much. Boy, do you not see that away from equities. Briefing us is always, we start strong in this Jobs Day hour with Nadia Lovell, Senior U.S. Equity Strategist, UBS Global Wealth Management. Nadia, talk about the VIX at an 18-19 level. How are equities ignoring the bond carnage?
I don't think equities are ignoring it. I mean, you're seeing valuation adjust to all of that. You've seen the market pull back from its high, down 8 or 9% from the late July high. And so, but we do think that this pullback is healthy. I think what's happening in the market is that we've sort of been in this micro news air pocket, if you will, ahead of the earnings season. And so the earnings season should be able to provide some clarity on the outlook for corporate earnings. We do think that corporate earnings will start to inflect back up in the third quarter, and we should be able to see growth. So that could be actually a potential catalyst for the market.
Are we in a bull market, or with this difficulty, this emotion of the last month, have we reaffirmed some form of bear market trend?
We think that we're still in this bull market trend. I mean, the earnings, again, should start to re-accelerate. And reality is, it's normal to have a pullback. We're not even at, a 10% correction yet. And so I think that we've gotten used to, at least this year, driven by the rally in tech of the market being on this steep upward trend. But a pullback is healthy. It does take a little bit of a valuation fraud out of some areas of the market. And so in our view, the risk reward is actually looking a little bit better for the equity markets from here.
So are you buying?
We are. We will be legged into this, weakness, continuing to dip our toes into it, but be selective in the areas of the market. You sort of want to maintain that balance. And so we have a balance with some defensive exposure along with some cyclical exposure, as well as some exposures to some of the secular trends that are happening in the market.
Are tech stocks defensive or growth?
I would say I would put them in the middle, in terms of yes, there are parts of tech that are quite defensive in terms of the software areas of tech where there's a high level of recurring revenue. So that's by some stability in the earnings. And of course, you have other parts of tech that are more cyclical in nature, whether it be semis or hardware. But we are also seeing some bottoming in trends there. So tech kind of, plays all different areas. But I think overall, how I would categorize the tech sector is high quality.
Well, the high quality there translates to free cash flow. And to me, at the end of the day, and with all the uncertainty described by the bond market, Ellen Zentner of another house, Morgan Stanley, says there's great uncertainty here in 23 minutes. Okay, Nadia, all that's great. But the only thing I can hang my hat on is free cash flow. Do you agree with that? That we're really back
into next. That free cash flow that you were talking about, Tom, exists in the NHS. Free cash flow leaders or 10% strong balance sheets and the likes.
But quickly here, Nadia, I love what you're saying. You know, I want to say good news is good news with you, but I got a 5.49% 3-month T-bill. I mean, I'm sorry, the siren call of money market funds in a short paper is a huge constraint still, isn't it?
It is, but we don't think that these levels of bond yields are sustainable. We do think that bond yields will trend lower from here. I mean, yes, a 10-year bond yield could remain in this 4 to 4.5% range, but the economic momentum that we've seen early in this year, we just don't think that will continue into the fourth quarter and into next year. So we are looking for the 10-year bond yield to come down towards 4% by the end of the year, and then trend towards 3.5% by the time we get to mid next year, as the Fed looks to cut rates.
So given what you expect, is the biggest risk for you a re-acceleration in the economy or a hard landing?
A hard landing is the biggest miss. Equity markets isn't really priced for that. I think most people are in that soft landing camp. And we also know when you do hit a hard landing, that has implications for earnings growth. Earnings tend to pull back, in the mid-teens into that sort of scenario. And so we want to see the continued strength in the consumer. Inflation is coming down. We don't want a re-acceleration in inflation. So we sort of want that Goldilocks scenario to happen over the next 12 months. But, time will tell and the data will determine.
It's what we always want. Not too hot, not too cold. Just right, Nadia. Nadia Lovell, thank you, of UBS on this equity market. Appreciate it as always. Counting you down to the payrolls report. Fantastic lineup for you. Randy Krosner, former Fed governor, joining us going into the number. We'll get some reaction from him at the other side as well. Jeff Rosenberg of BlackRock will give us his perspective too. Mohammed Al-Arian, I can tell you, with us here in New York City in the studio. He's going to catch up with us about 9 a.m. Eastern time to go into the opening bell and break all of this down. And then Secretary Sue, the Labour Secretary, or the nominated Labour Secretary.
I've lost track of that as well.
Hasn't been confirmed just yet.
Yeah, what was that,
I know. Tom, we don't have a speaker either, officially.
Yeah, really.
So,
yeah, exactly.
Step at a time. If you're just tuning in, welcome to the program. We are positive here by 0.1%. Counting you down to that payrolls report, let's call it 20 minutes away. Tom, the number we're looking for, 170K.
170K, and again, you go over the wage dynamic, which, John, you often do there, and to see if that's going to break. But, maybe the worst outcome here is stasis, where we just get another middling report. Nobody's talking about that. We're getting drama here, drama to the right, drama to the left, and what's the damage to the bond market if it's just...
Was it B. Mosey in Lincoln this week who said slightly negative? Was that him, Lisa? I think he said. Someone said this week, one of our guests this week said slightly negative.
It's the best case.
Would be the best outcome for everybody. Slightly negative, not too much on trends, slow down.
Yeah.
Just slows down the bond market, sell off a little bit. But it's good enough, it's decent, that you're not crying about a recession anytime soon.
For everybody to understand, Lisa can remember out about 1 week. I can remember out about 1 minute. Farrah's telling me things we did 4 months ago where he has a crystal clear memory of whatever it was. How do you do that?
I rewatch the program all the time.
My deepest sympathies.
And I take notes from the guests. I've always done that. Go through the transcripts. Done that forever.
Okay, I'm watching.
Which is why I remembered that Saudi America line that you used a long time ago.
How do you do that? I mean, I'm worried about F1 in Qatar this weekend, and I'm Tots Luton. Is it Luton? Is that how you pronounce it?
Is that what you're going to watch?
Tots Luton. Got
We've got Formula One back this weekend.
Formula One, I believe, is this weekend.
Okay.
Maybe next week.
I have to double check that. Is it next week?
I don't know.
All right, we'll get up to speed.
I'm rooting for Orioles Diamondbacks.
Isn't it Vegas?
Really what I
the
Vegas race soon?
Yeah, Vegas race.
Okay, all right. Good to be up to date.
It's a sports report.
We'll do that in the break.
leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing: screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Where we've been wrong is the fact that normally I don't think deficits matter, but investors have been asked to take these bonds when there's a big inversion and there's loads of them. So if you can remove the inversion and change the data backdrop, then the valuation piece will come in as well. So I think slowly the conditions are getting better.
Steve Major of HSBC, just one of the best in fixed income, had a tough year, Tom. Bullish on fixed income. It's not worked out that way with the sell-off continuing, but certainly getting an understanding of where he went wrong. And I think the explanation around it is really, really important. Traditionally, deficits don't matter. In downturns, they really don't, because people will buy treasuries. The point he's making, I think, is really interesting. It's difficult to get people to go out the curve for less yield when the data is still good and you're getting tons of bond supply, which is the point Steve is making.
I think the flow issue here is critical, but it also percolating into this weekend. And you really wonder, we were saying people can't vision out to 2024 right now. I really wonder the fiscal impact of this bond carnage that we've had. I've certainly underestimated it. And, you look at the rates of change in the Chicago, mathematics of what's going on. And to Steve's point, is it about the debt and the deficit?
Ramo's been asking for a real-time ticker of that, haven't you, Lisa?
I want that. I want to have an understanding of how much the interest payments are going up in real time as you get the 10-year yield climbing. And I know this sounds nuts, but at the same time, that's the reality of it. And if it sticks, the fact that the U.S. did not push out their maturities the same way that corporations and individuals did means they are sensitive to those moves in a much more meaningful way than anybody else in the market.
We've got a former Fed governor around the table who was just like, yes, I want that too. I want that too. He's going to join us in just a second. Let's get to the price action on the S&P 500, positive by 0.1%, about 13 minutes away, 12 minutes away now from the payrolls report. Yields a little bit higher by a couple of basis points, 473.60. What an ugly week crude has had. Could close down close to 10% lower on the week, down to 82 on WTI. Worst week, TK, going back to March.
This is our interview of this bond carnage. There's no question about it. I've said for years that out of Brown University, the gentleman from Chicago is our definitive financial economist, and that's saying something at Booth School with Lars Hansen, Austin Goolsbee, and Raghu Rajan darkening the door. He's a former Fed governor. On this jobs day, we're going to rip up the script with Randall Krosner. I am so honored you are here with us today. I'm going to steal from Raghu the fault lines of Randall Krosner right now in this bond carnage linked into our greater economics. This is Booth School 101. Let's steal from Raghu and the fault lines of the great financial crisis. What are the fault lines you see right now in this bond carnage?
So I think that's exactly the important thing to be focusing on, is what are the unintended consequences of this? Because we know that interest rates are going up because people are concerned that the Fed's going to keep rates higher for longer. The markets finally seem to have gotten that message.
Right.
And I think Jay Powell's been pretty consistent on that for a very long time, but the markets are now focused on that. And we have to look at, well, what are the consequences of this? We've seen around the world that when interest rates move up very rapidly, sometimes people who have been hedging properly or been involved in a lot of leverage when they've been trying to hedge get into trouble. And so we're going to sort of see this over time. One of the manifestations, obviously, was Silicon Valley Bank earlier this year.
Yeah, and that's a small bank. Let's talk about the big banks. We've had a constant message that everything's fine with the big banks. I don't buy it for a minute because I heard the same tune in July of 2007. On a tranche basis, everybody's focused, including the media, on the garbage of the tranches. I'm going to go with David Goldman, and I'm worried about price movement in the better quality, middle quality tranches. Do you people at Booth have a conviction that they will sustain and get through this carnage?
So I only speak for myself. As you know, at University of Chicago, every person speaks for themselves. So I can't represent other people's views. But I think it's very interesting to look there, because if you go back to the global financial crisis, it was exactly that it was when markets started to get worried about the top quality.
Tier stuff.
So the bottom quality, that had fallen out much earlier, but it wasn't until really the summer of 2007 that the top parts got in trouble.
I love catching up with former Fed officials, Randy, because they're no longer burdened by the shackles of responsibility.
The shackles.
They can just tell us what they think. Can you tell me what you think they're probably discussing on the committee after the sell-off we've seen in the Treasury market? How do those conversations go?
So you'll have different views around the table. You're going to have some people are going, finally, the markets understand what we're about, and they've got it, and that does our job for us to some extent, because the markets weren't believing them. The markets kept thinking, oh, well, these guys, they say that they're going to hang tough, but most people in the markets have only been there for 10, 20 years. And they don't realize that in the old days, the Fed really would hang tough. They've only seen what's happened really since the global financial crisis. But the traditional approach is that when the party really gets going, the Fed takes the punch bowl away. And they're willing to do that, and the markets are finally getting that. So I think that's the discussion. Are they getting it? And then the question is, are they getting it too much?
As a Fed governor, would you sit there in real time and dial up a colleague on the board of governors and have a conversation about what is developing? How does that work out?
So it's exactly that. So there would be issues that would come up, and we might have a small group meeting, or we might have just a one-on-one on what's going on. How do we understand this? Does this fit with our models, or is there something different here? Then we might have ask for a briefing from the staff about, gee, is there something new here? Should we be using alternative approaches? Most people ended up with the traditional approaches, but it was usually.
Can you think of an occasion where things did really change for you, where you had to pick up the phone and say, this isn't right?
Oh, certainly in the starting in probably August, September of 2008. That was really when things were not moving by the playbook, and we knew something was terribly wrong. It's like, we really got to work through this.
Do you feel like at this point you would change your view? If you were on the Fed, all things being equal, based on the pace of the move, do you agree with the Mary Daly view of things, that if yields do stay at this level, that will remove the need to raise rates again?
So there's the short run interest rate and the longer run interest rate. And obviously, we've been focusing more on the 10-year rate, which has moved up very dramatically because people have finally gotten the message that the Fed's going to keep interest rates high for a while. I think it really would depend on how the data evolve. I mean, we're going to get a very important number in just a few minutes. We're also going to get some more inflation numbers. And so you might want to move a little bit more if the economy continued to seem very strong, if the labor market continues to be strong, if we're getting a lot of wage pressure, because the 10-year rate does a lot, but it doesn't do everything.
This is a difficult time, isn't it? It's very uncertain, and all of the data points that people say matter so much are really pocked with a lot of uncertainty and revisions backwards that are perhaps not necessarily that accurate. So which data point is the most important? Which do you watch the most closely?
So I'd say, I'd go to two. One is the data points that we're going to be getting today, and the other are on inflation itself. And in particular, the core personal consumption expenditure index, not the CPI, because the CPI is too focused on housing. The PCE has a little bit less of the housing in it, a little bit more of sort of general services. And so that tends to tell you a little bit more about where inflation is going. So labor market and the inflation numbers.
I talked to the president last night, and I said if Michael Barr has to step aside, Krosner would be perfect as a vice chairman for regulation. And I don't want to keep you busy here. Michael Barr's got to be worrying today through October about mark-to-market. Now, maybe it's a little bit away from your remit, but the answer is we've got this confidence, which Michael Spence has written about. OMG, we fixed it in 08, 09. We fixed mark-to-market. We have great transparency with our major banks. I don't buy it for a minute. Do you have confidence that the Fed has knowledge of the opaqueness between mark-to-market and the free-for-all of this bond market?
So they know there's an opacity there. Do they know the exact numbers? No one knows that. Precisely because
can they measure the opacity?
You can get a feeling for how much you don't know, but it's like you can say, well, gee, we know that these are not being priced to market too quickly. You can't say, I know what that market price would be.
I got goosebumps. That was Grossman Stiglitz from a million years ago. What he said that's so important is you know what you don't know. That doesn't help you if your bond's moving from 82 down to 78.
We don't know the jobs report. We know that. It comes out in about 5 minutes. We'll find out what it is in just a moment. Mike McKee's standing by. He's going to break that down for you in just a moment. Off the other side of that, we're going to catch up with Jeff Rosenberg of BlackRock. In your equity market going into all of this, on the S&P 500, we're positive by 0.1%. In the bond market, we look a little something like this in the Treasury market. Yields, Tom, higher this morning by about 3 basis points on a 10-year, 4.7485. Mike McKee, can you give us the tease for 5 minutes' time?
I think what we're going to see today is a bond market that's like a coiled spring for this. When you look at the whisper number, it's 189 right now, and the forecast is for 170. You noted that the 10-year yield is up about 3 basis points. Everything's kind of coiled to go higher if we get an upside surprise. And so that'll be the real story, not so much what the number is today, but how the bond market interprets it. We also expect the unemployment rate to go down a bit. So if that doesn't happen, there'll probably be some confusion for a few minutes till we figure out why, whether it was more people in the labor force or whether people are starting to get laid off. So it's going to be interesting to watch the reaction to this, even more so than the numbers themselves.
Mike, to steal from Randall Krosner of Booth School Chicago, you know what you don't know. What's your biggest mystery in this jobs report?
I don't know what I don't know, Tom. Actually, I think the one thing we don't know that could matter is the number of people who come into the labor force. It was over 700,000 last month, and that's what pushed the unemployment rate up. That's considered a good kind of move, but if we get a much smaller number, that could help the unemployment rate go back down again. We don't know what that number is going to be. Probably we have an interestingly wide range for the jobs report itself. Steve Stanley up there at 250,000. So I don't know either. That'll be interesting to find out.
Randy, your final thought before we get this figure in terms of what you're looking for in the granular data, what you're trying to understand.
So really the key will come down to wage growth, because that's one of the key things. It's, if you think about what the costs of production are, even for manufacturing, wages and labor costs are a very significant fraction of that. And of course, in services, it's almost everything. And so if you think about where the cost driver is going to be going forward, it's in the labor market, and in particular, the wages that we'll be getting just in a few minutes.
What did you think of the forecast from the Fed a couple of weeks ago? Aspirational?
So as you know, people talk about hard, soft landing. Jay Powell's talking about softish landing. I've been talking about hardish landing.
Hardish, what's that?
That means that I really think that we can't get out of this without a substantial slowdown, possibly recession, not off the cliff. But I really don't think we're going to get out of this without a substantial slowdown. And I didn't really see that as much in the data or in their forecasts as I would have been forecasting.
Randy, stick with us. We're going to break this down in a moment. TK, the estimate, as you know, well by now, 170,000.
Halloween 2009, a 10% unemployment rate. This jobs report is important is the angst we felt at 10%. Completely different. It's about finance and bonds, not about the real economy. But I got to go back to Halloween of 2009.
Elisa, what are you looking for? Headline number, 170, that's the estimate. Unemployment, looking for that to come down to about 3.7 from 3.8. Wage growth, average hourly earnings, month on month, looking for 0.3 up from 0.2.
Honestly, I'm watching the bond market and its response, to quote McKee. I mean, honestly, to me, that's going to be the most interesting thing. If we get an upside surprise, does it get revised downward next month? We shall see.
Well, let's go through the price action for you, how we're set up ahead of all of this. I've gone through the numbers that we're looking for. 170,000 is the median estimate in our survey. Let's start with equities on the S&P 500, positive here by 0.1%, heading potentially towards a fifth week of losses on the S&P 500. I've said it a few times already this morning, but the fate of this market today, very much to some extent, to a greater extent, in the hands of the data you'll see in about 20 seconds' time. In the bond market, yields look like
this on a 2-year, a 10-year, a 30-year. Earlier in the week, a 30-year through 5% this morning, 4.9034. Yields up on a 10-year maturity, up by a couple of basis points. New cycle highs earlier this week. The yield right now on a 10-year maturity in America, 473.81. With the labor market data, let's get to Mike McKee. Hey, Mike.
Good morning, guys. And the numbers are just coming out now. Unemployment unchanged at 3.8%. That's the first number we get this morning. Payrolls, though, wow, 336,000. Let me repeat that. 336,000. Change in private payrolls, 263,000. Remember, ADP said 89. The change in manufacturing payrolls up 17,000. And for the months of July and August, we've got a revision of plus 119,000. So the labor market considerably stronger than people thought. Average hourly earnings, Randy was worried about that, just up 0.2%. That's much lower than anticipated, same as last month, which pushes the average hourly earnings on a year-over-year basis to 4.2%. Labor force participation still at 62.8, so not a major concern there. And in terms of the establishment data, leisure and hospitality still the leader, 96,000 jobs during the month. Government employment increased by 73,000. Now, there were questions about the seasonal adjustment for teachers in August, and so that may be a bit of a payback there. And I'll have to look up, well, here we go. Transportation and warehousing up 9,000. Truck transportation adding 9,000 jobs. Remember, we lost 37,000 in August when Yellow went out of business. Looks like about 9,000 of those reabsorbed. I'll go through this. You guys check out what the bond market is doing, because this is sort of the mother of all upside surprises.
I don't need to check, Mike. You can already guess. Mike, thank you. The sell-off resumes. Slow down. What slowed down? Major upside surprise on the headline number. This is a knee-jerk reaction. It always is. Let's see if it sticks, but I'll give you the price action right now. Equities down hard by about 0.7% on the S&P 500. Let's slice and dice the bond market for you. 2-year, 10-year, 30-year, 2-year up by 6 or 7 basis points to just short of 5.1%. 10-year high by 7 basis points to 4.79. 30-year had a look at 5% earlier this week. We're heading back towards it, up about 6 basis points right now to 4.95. Once you've guessed where the bond market's going, you can assume where foreign exchange is. The euro breaking down against the dollar, just about holding on to 105. 105.20 on the euro against the dollar. TK we're negative by a third of 1%. I'm going to say it, Tom. It's early days. I know it can change, but good news was just bad news maybe for this market, Tom, at least for now.
I'm not going to insult Randy Krosner with the good news, bad news silliness. What I'm going to look at is a 2 standard deviation move up in the inflation-adjusted rate. And, John, I just can't say this enough. I go to a real rate analysis. We'll do that with our great team of people. Commercial-free for you in the next 28 minutes. Michael McKee takes a second look at the impossibility of 18 pages of data. Mike, what do you see?
Well, I'm looking through where we found jobs. Construction's still adding 11,000 during the month, so the builders are still putting homes in the ground, and they're still looking to find people. The manufacturing jobs I mentioned earlier, 17,000. There have been questions about what would happen, but the ISM number earlier this week suggested we would see an increase, and we do. Retail adds 19,700. I don't need to the point there. And professional and business services adds 21,000. That was a big category of gain in some of the earlier numbers this week. So it's interesting that we see that follow through. It's an area where if you're adding jobs, it's a suggestion that maybe companies are still looking for more. So it looks at this point like the overall number is solid, and it comes from a lot of different categories, not just hiring in one or the other.
If you were hoping to get away for the weekend, stick around. I guess you've got no choice now. Stick around for the next hour on Bloomberg TV as well. Coming up at the Open, Bloomberg's opinion columnist, Mohammed Al-Erin, and president of Queen's College, Cambridge, Mike Collins of PGIM Fixed Income, Victoria Fernandez of Crossmark, plus reaction from the administration in Washington at 9:45 Eastern Time. We'll hear from the acting U.S. Labor Secretary. Judy Sue. TK, this market down by about 1% on the S&P.
Let me do a data check here as we get to Governor Krosner here in a moment, and that is I'm going to give you a 5% 30-year bond in moments, 4.99% right now, 10-year. We've got a new initiative here to a higher yield, lower price as people consider Michael McKee saying that this job report was across many, many different sectors. It was not a dysfunction or singular or that. Randy Krosner with the Booth School, Chicago. Randy, I'm going to go from a nominal to a real rate analysis. Let's go back to first principles. I never framed a 2.50 10-year real yield. Why does the real yield matter, and how will that new high real yield change our listeners' and viewers' lives?
Because ultimately it is the inflation-adjusted rate. It's the real rate, you said, that matters for thinking about what investments firms are going to be willing to make. Because if prices are going up and they can input prices are going up, that's one thing. But if you adjust for the inflation, so you take out that change in cost and change prices on both sides, you've got the real yield. And if that's going up very significantly, that means that firms are going to be less willing to invest. Are they less willing to hire? We've also started to see real wages grow, which is great for workers, but that's probably at some point going to mean a little bit less demand. Obviously not right now.
Well, that's where I wanted to go. What's your reaction as a former Fed governor to this report that is not only a massive upside surprise, almost twice as much as what the expectation was, but also with an upside revision to the prior month? What would you, if you were still on the Fed, do with this?
So I think look at two pieces. One, obviously, the incredible strength of the labor market continuing to be there. But the silver lining is that we didn't see a lot of kick up in wages. So I'd want to get into that a little bit more detail, because that's really ultimately what is going to affect costs and what's going to drive inflation. Maybe I was being too harsh in saying there'd be a hardish landing. Maybe we've got something that's perfect Goldilocks. I find it hard to believe. It's possible. After being at the Fed during the global financial crisis, I never say never about anything. But we've never seen something so perfectly Goldilocks before. But if you can have a strong labor market, but not have real wage growth being too high, that would be ideal for the Fed.
One thing that I'm seeing is the underemployment rate coming in a little bit, 7% from 7.1%. It goes to the Priya-Misra question, which would lead to a higher neutral rate longer term if we get an increase in productivity, if we see some sort of just general growth that means a higher inflation, higher growth kind of era. Are you hearing anything, seeing anything in this data that suggests that has a greater likelihood than you previously thought imaginable?
Well, not in the data today, but we have been seeing some pretty good numbers related to productivity growth. And ultimately, that's what we want to see. Higher productivity growth is great for economic growth and great for real wage increases for workers. Now, whether that's just sort of a one-off thing, it's going to take a lot more data to figure that out.
Tell me at the Booth School, is you people own the high ground on the analysis of our finance and to say one emotional thing, commercial real estate. The fact is, in the carnage that we're in right now, 30-year bond, 4.98%, we're going to have a normal American failure of restructuring, failure of businesses, new fresh money will come in and, at a lower distressed price than that. Will we just survive this event, or can there be lasting damage here like there was in 07, 08, 09?
So I think we really need to rethink the business model of how this is financed, because a lot of small and medium-sized banks have a lot of exposure in this area. The chickens are going to come home to roost because interest rates are a lot higher, so refinancing rates will be higher. There are a lot fewer people going into the office, so a lot of the commercial real estate values are going down. And I think a lot of the small and medium-sized banks are going to be stepping away from this. So I think the question is going to be, who will be financing this going forward? The big banks don't seem to have any appetite to do that. Maybe it'll be new players like private credit coming in, but that's very new. We will have to see.
But the heart of the matter here, Professor Krosner, is for the fossils like me, the collective memory of our youth of continental Illinois, out of nowhere. What are the shadows right now that you see of a continental Illinois, of portfolio insurance in 87, the leverage of 98? What's the Krosner shadow right now you're most focused on?
So I do think trying to understand what's going on with commercial real estate, how that's going to affect small and medium-sized banks is very important. And then also trying to look through into the areas we don't know about. This gets back to what we were talking about before, into the non-bank financial sector. So we've got a lot of data about banks, but just as I was describing, there are a lot of non-banks who are doing traditional bank functions. We don't have as much insight into that. So that's something that we know we don't know, and we have to find out a lot more information
That's
about
another one-hour conversation with Professor Krasner. We'll do that at another time. We are honored you're with us today. For all of us at Bloomberg, thank you so much. Randall Krasner of the Booth School, Chicago. We're also honored that Jeffrey Rosenberg could dart in the door. He was just looking at his Bloomberg terminal. Jeff Rosenberg, let's take this all-in non-farm payrolls. I have the number here, 455,000 with revision. Take that shock into your shock of working at BlackRock this week in fixed income. How do you dovetail the two?
Well, you know, I think I'm gonna talk about something that we usually don't talk about on Payroll Friday, and that's third quarter earnings, which begin to kick off. And what this payroll report really, I think, starts to reconcile is a disconnect that we've been hearing between kind of the bond market consensus, soft landing, inflation, slowing labor markets, and at the same time, a very positive corporate profits, margins holding up. And here's the problem with those two stories is that how do you get the slowing in labor? How do you get layoffs if corporations are doing just fine with pass-through and with margins? And so the reconciliation of those two inconsistencies is on display right now. This is a much stronger labor market, clearly. That's what we see in the report today across the board. And so the challenge is, and what you were relating to with Randy Krasner, is that this is an environment where rates are going to have to stay higher for longer, potentially even go higher. And the longer that occurs, the more those cracks and that vulnerability has time to eventually show up. But this is really telling you something that the equity markets have been telling you, that it's good for corporations, good profit margins, good earnings, isn't a good story for labor market normalization and for the inflation story.
Jeff Rosenberg, Mr. Fink's office called me this morning as I was coming in, and they said, don't ask Jeff Rosenberg anything about inside baseball at BlackRock. I will not. But I will ask you about the functioning of our fixed income market off this shock report. Are there instabilities visible outside of BlackRock that you see? Can we get transactions done as we get ever higher yields?
You know, it's been a remarkably orderly move higher in terms of market functioning.
Agreed.
In terms of liquidity. I think the issue that you, again, just went through with Randy about where are the cracks, where are the vulnerabilities, and Randy highlighted, you know, the change in intermediation. The financial system is much more disintermediated today and in different ways that we haven't seen before. And so the story and the history is that as you have these shocks in terms of interest rates, there are vulnerabilities. The challenge is this time will be different in terms of where those vulnerabilities show up, and that will be surprising. I think the key here is that coming off of over a decade of zero interest rates, we established a lot of expectation for the persistence of low interest rates. And yes, there's a lot of liquidity still left over, private credit, dry powder. The issue isn't the liquidity, it's now the cost of that liquidity and whether or not you can afford those much higher interest rates. I think the thing to be aware of, however, is that in the private credit market environment, you don't have the same kind of liquidity triggers that you have in the banking sector. You mentioned continental Illinois. You don't have deposit runs. So you have a lot more flexibility to extend the time period, a lot more flexibility to limit any kind of spillover shock risk. So it functions in a different way, but it doesn't mean that there isn't still eventually the cost to be paid for a much higher interest rate environment.
Right now, as you talk, we are seeing the markets break down in a pretty significant way. We're seeing that 30-year yield climb back up toward that 5% mark, 4.98%. You could see 10-year yields climbing back up near the highs that we saw earlier in the week. Yeah, really just a moonshot, 4.82%. It's coming in, it's going up. It's definitely a volatile morning. The euro going down to 1.051. So you could see it just flirting with that 105 level. Jeff Rosenberg of BlackRock, I am curious from your vantage point why you would buy bonds here if you see this kind of strength in the labor market persisting.
Well, I think when you say why would you buy bonds, I think one of the key things about the fixed income markets is there's a very different level of opportunity set across the yield curve. And so the front end of the yield curve is really pricing in a lot of the forward path. The movement today basically pricing in now 100% of the final increase in interest rates. You know, if inflation and the kind of one silver lining in today's report is average hourly earnings, you know, if that picture still maintains, then the Fed can hold rates at high levels, but doesn't necessarily have to go further. That's already in the price. And when you look at the back end of the curve, yes, there's more vulnerability. Yes, we still think there's more term premium steepening to go, but you're starting now just finally to get to levels where you're getting back to normal. And that movement from abnormal to normal is very painful, but where you're getting closer, and that's interest rates that approximate nominal GDP. That's the history of where the long-term interest rate should be, and you're getting closer to that. You may overshoot, and you may have more term premium risk because of the deficits and QT, so we're a little bit cautious on the back end, but why would you buy bonds? You may not want to buy bonds like 30-year bonds, but the front end of the curve is really starting to get to levels that are much more attractive.
For 2007 and on, this is one of the historic days we've had on Bloomberg Surveillance. We welcome all of you commercial-free here through the hour. Michael McKee with us, Jeffrey Rosenberg of BlackRock, Ira Jersey scheduled to be with us as well. On the data check front, equity markets somewhat quiescent. We're at a stick on the VIX, 19.46, and basically a 1% move in the Dow. The NASDAQ, SPX just fractionally better. SPX is down 0.8% as well. I can't say enough about the moves in the bond market. If I keep talking, Lisa, we're going to get a 5% print on a 30-year bond. I can round it up right now. We need to get a reassessment of this historic jobs report, 455,000 with revisions. Michael McKee with one more insight.
Well, it's a fascinating number, Tom, because nobody expected it that high. Steve Stanley was by far the highest on Wall Street at 250,000. So it does show that people are still looking for workers. Now, the question is, when you have a number like this, how much of a drop-off are you going to get the next month? Or are we going to keep this sort of thing going? Some of this may be payback for numbers that were a little odd last time, like the yellow trucking went out of business and subtracted 37,000 jobs, 9,000 of them came back, so we don't get that effect again. And there obviously was a seasonal adjustment issue with education because we got 40,000 additional folks in education during the month. But it's still a very, very strong number. Now, the interesting thing I take away from this is that with the 10-year note yield headed to wherever Tom drives it, does this mean that the strong number pushes Wall Street to reprice for yet another Fed move, or is this the Fed move? When you go back to Mary Daly yesterday saying that the market yields rising had the equivalent effect of another 25 basis point increase. Does this mean the Fed has to move or not? And I think a lot of that probably comes down to next week, the CPI numbers that we get. If the inflation rate is still going down and we didn't see a big wage increase here, then it's okay to have this kind of job growth.
Right now, definitely the bond market is speaking, and they are doing a lot of work in terms of tightening financial conditions. I'm also watching the euro breaking down below 105 now, 104.99. Jeff Rosenberg of BlackRock still with us, and from your vantage point, is this the one hedge that has worked in this period of turmoil? Buy the dollar.
Yeah, it's been pretty much rate driven, and I think as you're highlighting this morning, that rate move is reflective of the move in the dollar is reflective of that rate move. I want to go back to what Mike McKee was just saying in terms of the Fed, and I think that is what you're seeing in terms of pricing in the last hike. And I think also as well, they will recognize that the market is doing a lot of the work for them, and we're going to get the tightening in financial conditions, and they were hoping to avoid an easing of financial conditions, which is what they've gotten here. So I think that helps to kind of move us off of the Fed tightening path. The real issue in terms of the bond market pricing into next year is we've priced out about half after the the FOMC, half of the cuts that were priced into next year. And I think that's the next move that you could start to see, is really pricing out the cuts as you get more of this higher restrictive for longer kind of perspective.
And we did see that 30-year Treasury yield across that 5% mark just briefly, but flirting once again with that level. Jeff, how much is this a sustainable rate? You said pricing out cuts going beyond 2024. Is this sustainable economically and from a risk asset perspective?
Well, a lot of that depends on this projection in terms of the inflation trajectory, right? So the reason for the cuts priced in, or one of the reasons for the cuts priced in by the bond market, is the expectation that inflation starts to fall, and the Fed wants to cut rates so that, you were talking about it earlier, Tom, not having real rates go up as inflation goes down. So is it sustainable? Yes, but a lot of that's going to go, and Mike McKee, you hit it on the head, next week in the CPI report. It's a very strong jobs report. A big component of the inflation expectations declining is that core services ex housing, which is really related to the jobs market. So good news here so far is AHE, average hourly earnings, not ticking up. As long as you see that inflation trajectory go down, then I think you can get that pricing in the second half of next year.
Jeff Rosenberg,
it's very much dependent on that inflation.
Jeff, I want to go to you with one more important question. Stay with us, and we're going to bring in Ira Jersey right now, Bloomberg Intelligence. Moments ago, folks, we have a 30-year bond of 5.01%. Lisa will tell you what the bank rate 30-year mortgage is going to set at on Monday. Who knows? So we have Ira Jersey and Jeffrey Rosenberg to get us to the next hour. Dr. Alarian will join Mr. Farrow here in the hour. I'm thrilled to tell you Paul Sankey will join us on Exxon Pioneer on Bloomberg Radio here in a bit. Jeff Rosenberg, I want to cut to the chase. I've got a multi-standard deviation move in price in a blended bond index like the Bloomberg Total Return Index from the peak of the market in January in 2021. How do you frame out, Jeff Rosenberg, that institutions, retail, and retired America will somehow get back to the pricing of the Great Moderation? You must be looking at in years.
Yeah, and I'm not sure if, Tom, the framing is that we're getting back to the pricing of the Great Moderation. And I think that's part of the adjustment here, is that you may not have that bond market that you were used to in terms of an upwardly sloped yield curve, falling interest rates, a high positive total return, and most importantly, a reliable ballast to your stocks. It's a very different bond market, and this is the transition period, and I think investors have to really recognize that. And so the opportunities are really changing how you hold your bonds in your portfolio. It's much more in the front end. It's much more about flight to quality. Insurance is no longer the 30-year. It's the front end of the curve. It's a steepening when you have a crisis because you've got that rate possibility priced back into the curve. So a lot of changes in thinking about how we build portfolios.
Jeff Rosenberg, thank you so much for taking the time on a day that truly is historic, as Tom was saying. Just looking at the 30-year yield right now, we are seeing on an intraday level the highest rates going back to August of 2007, solidly through 5%, 5.02%. Ira Jersey, Chief U.S. Interest Rate Strategist of Bloomberg Intelligence, joining us. And I've got to say, what a moment. Is this being driven by sellers or by a complete lack of buyers who have no conviction at a time when the U.S. economy seems to be running hot?
Well, today has to be sellers, just because you wouldn't expect a lack of buying to generate a 10 basis point move in the long end of the yield curve. I agree with a lot of what Jeffrey said. I think the thing that we have to think about here is who's going to be the incremental buyer going forward. And when you have the global rate environment changing so significantly with positive yields in jurisdictions like Germany and Japan that had more than a decade of negative interest rates, now there's alternatives to just people buying treasuries. So I do think that we have shifted the demand dynamics and we need more domestic involvement. And we've seen that over the last year, but that's also come with yields rising pretty significantly.
I got to say, Ira, I'm looking at something close to a 20 basis point move in a 10-year yield as it pushes up toward 4.9%. Is this healthy? Is this okay?
Well, liquidity in the bond market has gone down very significantly as you have new regulatory environment that's changed the way that the bond market trades on a day-to-day basis. So I think when you get moves that seem pretty large like this, One, are they fundamentally driven? The answer to today's move, I think, is yes. But then they just get pushed out even further than you would expect on if liquidity was decent. You don't have the leverage in the system you used to have, so you don't have levered investors who might say, hey, I'll take a punt, and if we sell off 20 basis points, I'll try to clip 5 basis points going the other way when the market gets oversold. You don't have those people anymore.
Ira Jersey, you have so much perspective on this. Just thrilled to have you. And folks, I can't tell you enough about our team putting together Krosner, then Rosenberg, and now Ira Jersey. The market's walking away, Ira Jersey. There's no other way to put it. While you're talking, we're out to a 503, even 504 10-year. I've got a 30-year, rather. I've got a 10-year yield back to the summer, pre-August, third week of August of 2007. And if I look away and have some tang, I got the 10-year real yield out to 2.56%. Ira Jersey, you and I know, as Chris Whalen talks about, there's a point where there isn't somebody on the other side of the phone. Price down, you need to get rid of it, and you can't sell it. Are we anywhere near that analog?
Well, I think we're close depending on who you're talking about. And, I think your real yield point, Tom, is really interesting because with TIPS yields heading back, it seems, toward maybe 3%, at some point there's going to be value seekers in the markets. And we're just not quite at that kind of level yet, particularly with the repricing of how long the Federal Reserve is going to maintain rates at the peak. November almost doesn't matter. Even if the Fed hikes in November or doesn't hike in November, it's really, do they not then cut until 2025 or maybe even 2026?
Right.
So that's been one of the keys, I think, for the market here in the adjustment is, does it make sense to buy a 10-year yield when you can buy a 2-year note or a one-year T-bill well above 5%, and you think that you're going to be able to get that for the next 18 months. So it doesn't make sense to buy the long end if you get a better risk-adjusted return in the front end.
To the idea of the never of this October, Lisa, he just said it. I've never framed a 3% real yield. That was something from another, I don't think I had gray hair. It's from another time and place. What Mr. Jersey just said there, a 3% real yield. You tell me how Business America operates.
They are going to have to grapple with that. We're looking at right now close to 2.6% in terms of a real yield on a 10-year. So it's really moving in real time. Ira, I want to go back to something that Priya Misra said earlier in the show, talking about how banks are one of the biggest buyers that have stepped back, that basically are no longer hoovering up U.S. government debt. How much is this one of the main features, aside from China, aside from Japan, that really is one of the big drivers at a time when they used to reliably be a base for the U.S. government?
Well, so really, banks are not massive holders of all of the outstanding Treasury securities in the country, but they are one of the incremental buyers, right? So banks will step in, and they have a choice of whether or not to make a loan or buy mortgage-backed securities or buy Treasuries. And owning some Treasuries is something that they have to do now because of the regulatory changes that went in about a decade ago. So banks are always going to be regular buyers. I think that at this point, banks have alternatives to what how they can manage their portfolios and manage their regulatory risk. So they can own a lot of reserves, right? So the Federal Reserve has kind of created this dynamic where banks don't need to buy as many Treasuries yet because of what's going on with their reserve balances.
Ira, a busy day of publishing for you and Bloomberg Intelligence. Thank you so much. Ian Ling and BMO Capital Markets looking for 5% 10-year yields on the horizon and does speak to the instabilities it will bring to the real economy. Our instability is to ask one final question of Michael McKee, who actually knows what he's talking about.
Oh, I wish I did, because somebody asked me, why did economists get this wrong? I said, I don't have a good answer right now. I'll have to look into that. We've just underestimated all along the strength of the U.S. economy. And when I say we, I'm including the Fed in that. And so it does change the game a little bit if we continue to see this kind of strength. 266,000 average each month for the past 3 months. That is not an economy that is going into recession. Takes that off the table. But the good news is average hourly earnings did not rise very much. So if CPI comes in soft, then how do you position the bonds?
Our final guest for the morning is Lisa Abramowitz, because this is her wheelhouse, the heart of the matter of Lincoln's note. of Rosenberg, of Jersey, of Krosner is your world. How do we move from a full faith and credit analysis out into credit, into stress? What do you think will be the ramifications?
What we already have seen is the worst period of time, the worst sell-off in credit going back to March when everybody was worried about a banking system collapse. At this point, this is where we start to see people worry about refinancing risk 1 year out, 2 years out for some of these high-yield companies. When does this become a sort of self-killing cycle where these yields have to come down because something breaks? I don't know the answer, and I don't think anybody does.
An historic moment for the financial markets. Please stay with Bloomberg Television and Bloomberg Radio through this morning. El Arian with John Farrow next.
Well, apparently good news is bad news, and really, really good news is really, really bad news. Live from New York City this morning. Good morning for our audience worldwide. Yields absolutely surging. Equities taking a dive. We're down by more than 1% on the NASDAQ. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, the jobs report delivers a major upside surprise. Detroit's Big Three bracing for a UAW update, and Exxon closing in on its biggest deal since '99. We begin with the big issue, payrolls in America.
Look at what's happening with labor.
Today's data on jobs.
Non-farm payrolls. You do need to fold that into some of the other data we've seen.
That consumer and that labor market is something that we are very focused on.
Our economy is really being well supported by two things.
A very tight labor market.
Resilience within the labor market.
And the consumer.
Consumers are still out there spending away.
Until that stops, I think we're in higher for longer.
The Fed wants the labor market to slow.
This slowdown is coming with the economy.
Only do you see the yields start to come down once you see visible signs of economic slowdown.
We will be watching, though, the unemployment rate and labor force indicators beyond just the payrolls print.
It's all about the consumer, and it's all about the labor market.
It's all about the labor market right now. With us to break it down, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, let's get straight to it. Your thoughts on that one from 31 minutes ago?
I had three reactions, John, two of which you covered in your introduction. One, this is good news for the economy right now. The fact that we can deliver over 400,000 jobs, if you include revisions, without earnings pressure is good news. It is, secondly, bad news for markets and for the Fed. The Fed is not going to welcome this report, which leads to my third issue, which is over the long term, this may end up being bad news for the economy as well.
Well, let's break that down piece by piece and jump to the Fed piece of it. From your perspective, Mohammed, as you look at the move in Treasuries this morning, and let's break it down together, 2-year yield higher by more than 10 basis points, 10-year up another 15 basis points, and briefly at cycle highs, fresh cycle highs just moments ago. Is that the market doing the Fed's work for it, or are you expecting more from the Fed because of these numbers?
So if this were not a data-dependent Fed, and how often have we heard this, we are data-dependent, which is always strange to me, because you are acting with tools that have an impact with a lag. But given how often they've said this is a data-dependent Fed, yes, it puts back on the table a hike for the 1st of November, which means that market now are not just having to internalize high for long, but higher for longer. And that is the problem. When you fall behind right at the beginning of an inflation cycle, you pay the price when you get to the last mile. And that's what we're doing right now.
A three-part story for you then, Mohammed. First of all, the data's good for the economy. Secondly, it's bad for the market, but ultimately that could be bad for the economy further down the road. You wrote for the FT earlier this week, the US may no longer avoid recession. How do these numbers play into a call like that?
Unfortunately, they are consistent with that call. Look, John, this is an economy that got used to ridiculously low interest rates and got used to liquidity injection. The change in the regime is happening really fast. So something is likely to break, probably in the financial markets, but that will have spill back into the economy. Then there's a second issue, which is just as important. this economy has to deal with a whole host of other things, the most important of which being that it is the supply side that's the problem, not the demand side. And unfortunately, that realization is not fully yet comprehended by the policymakers and by the markets.
Jason Furman weighing in this morning and on Twitter. I'll share that view with you all. First reaction to jobs numbers, shock. Second reaction, nervousness. Further reflection, this could be quite good. Went on to say 336,000 jobs, participation's high, wage growth's moderated. We could be in the middle of a sustainable increase in labour supply. That's the hope and the dream, Mohammed. Is that the reality?
So Jason is right. I mean, if we didn't have the financial markets and if we didn't have a data-dependent Fed, then Jason would be absolutely right. The concern is the spillback from the financial markets and policy onto the economy. This on its own is really good news and will be welcomed by the White House. It will not be welcomed by the Fed.
It's not welcomed by the market right now. Equity futures down by 0.9% on the S&P. The jobs data looking really strong. I think we've all forgotten about that ADP report a little bit earlier this week. Yields up at the front end, up at the long end on a 30-year. Early this week, briefly through 5%. Back through it right now. The 30-year, 5.02%. Yields higher by 13 basis points and change. Mike McKee breaking down this jobs report. Mike McKee, I think you and I both just said wow when that one dropped.
Absolutely. I think the word that you'd use over in London is gobsmacked by this number. It really was a shocker. Nobody had anything close to this in the Bloomberg Economic Survey, and nor did the people on Wall Street trading desks. 336,000 jobs created, and then add in 119,000 revisions higher to July and August. The unemployment rate stays the same at 3.8%. Nothing really remarkable there. More people got jobs than lost jobs, but the labor market only grew by 90,000 during the month, unlike 700,000 the month before. The jobs numbers, the best part of it here is the average hourly earnings, just 0.2%, up 4.2% on the year. And the interesting thing about that is that this was a longer period of time, which is why some analysts thought we would get a high compensation number because more people would have gotten jobs during that period at higher rates. We didn't see that. Service industries, 234,000 jobs. And the interesting thing there, wages up only 1.7%. Leisure and hospitality continues its run, 96,000. Public education, this could be a seasonal adjustment problem with August numbers, up 40,000. And I threw trucking in there because we lost 37,000 jobs last month because of the Yellow company going out of business. 9,000 of them absorbed back. So a turnaround there that helps boost the numbers overall. Here's the good news for the Fed. The payrolls numbers go up so dramatically, and yet we see a decline in average hourly earnings on a year-over-year basis. To my mind, guys, this makes next Thursday's CPI report even more important because I'm not sure the Fed will look at this badly if the CPI continues to decline because the Fed doesn't necessarily want to see employment go bad. They just want inflation to come down.
So, Mike, is it possible to bring inflation down with such a hot labor market?
It's possible, depending on whether we see people spend more than they normally do. Spending's come down to about the point we were at pre-pandemic. The savings is gone. People are spending out of their salaries. So it is possible you can get back into alignment. And we've seen supply come into better balance. Doesn't look like there's any kind of wage price spiral, though. So, yeah, it's possible.
Let's keep digging in. Treasury curve steepening, selling off at the long end. So yields are higher on a 10-year, on a 30-year relative to the price move today on a 2-year. The 2-year's up by 8 basis points. The 30-year is up by more than 12. So the curve is steeper. 2s out to 10s by about 5. 2s out to 30 by about 5 basis points also. Mohammed, let's talk about the character of that steepness. We thought if we were going to get a steepening of this yield curve, it would be driven by the front end. The jargon, of course, is the bull steepener. You get a rally at the front end, yields drop because you're pricing in a rate cutting cycle from the Fed, who has to confront a slowdown in the economy. We're not seeing that. In your experience, Mohammed, how rare is it to see a prolonged sell-off at the long end of the curve, to see the steepness come from a so-called bear steepener?
You had Priya Mishra on earlier today, and she summed it up very well. This is very unusual. But there's a reason why this is so unusual, and that's because the characterization of the economy has changed in my mind. What we're seeing here, John, is just a massive reaction to not rates going higher. That was last year. That was the understanding last year. Rates are going higher, but if you remember, there was a hope that was priced in that the Fed would be cutting pretty soon. This year is about high rates staying there for longer. And that is a fundamental change of how you think about the yield curve, and that's what we're seeing playing out in the markets.
One phrase I've heard, Mohammed, a few times this week is buyer's strike. Let's put some meat on those bones. Is this the investor basically saying, I'm not going out along the curve so long as it is inverted to take on a 10-year maturity for less yield when I'm seeing an expansion in economic data like that?
Yeah, and I also think, John, it's simply, I'm not going to catch a falling knife. That's what it is. I am going to wait on the sideline, see how things settle down. These moves are historic. They're absolutely historic. We're going to look back on this as, did we really move by that much every single day? And then the second thing to remember is that we don't know what the retail sector is going to do. There are very big losses right now in bond funds that are going to have to be somehow gotten used to. And then the last thing, John, I would say is, a lot of people are saying the markets have functioned well. Yes, they have functioned well, but the extent of the moves suggests that there is something else going on. And people are asking the question right now, where is the pain? And today, the pain is going to be increased. So there's going to be a lot of people interested in seeing how the technicals evolve from here.
You and I have got a lot to talk about through the next hour. I'm pleased to say Mohammed's going to be sticking with us to break down some of the stuff we need to unpack, particularly at the end there. The prospect of things breaking, maybe even forced selling, with all that unrealized losses sitting on some books somewhere out there in the Treasury market. Equities lower by about 0.8% on the S&P, with some movers going into the open. Here's Abby.
John, let's keep it macro and on this hot jobs report and yield steepening in the way that you all were talking about in the re-steepening of the yield curve. Let's take a look at technology, because of course as yields shoot higher, this makes valuation look less attractive. Microsoft down 1%, Tesla down 2.7%. Also weighing on Tesla perhaps are some of the Model 3 and Y price cuts here in the U.S. And then the banks not really getting a bid from yields going higher or the re-steepening in the yield curve. You can see JP Morgan Chase, it's down 0.6% right now, John. The S&P 500 E-mini futures heading to a fifth down week in a row, the longest losing streak since May of 2022. So this idea of longer or higher for longer, it is certainly weighing on stocks.
Abby, there are some big moves out there, that's for sure. Abby's going to break them down for you in about 20 minutes' time around the opening bell. Coming up, much more on a monster upside surprise.
The incredible strength of the labor market continuing to be there. But the silver lining is that we didn't see a lot of kick up in wages. So I'd want to get into that in a little bit more detail, because that's really ultimately what is going to affect costs and what's going to drive inflation. Maybe I was being too harsh in saying there'd be a hardish landing. Maybe we've got something that's perfect Goldilocks.
Perfect Goldilocks? We'll question that next. The conversation continues with Mohammed Al-Erin, Victoria Fernandez, and PGIM's Michael Collins.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field, because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can
spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The president went to Michigan very recently, just last week, a week ago actually, to show his support and to stand in solidarity with union workers. And he did that because he believes that unions have the collective bargaining rights to ask for fair pay and fair benefits. He believes, as it relates to UAW, record profits should lead to a record contract. The president is always going to be proud of being the most pro-union president ever.
The labour market in America at the epicentre of conversations this morning. The White House pushing the president's pro-union agenda as the UAW strike continues. And if a deal isn't reached soon, the impact could be wide-ranging. A full strike involving all 150,000 UAW members could impact 760,000 jobs and show up in October's payroll report. September payrolls coming in much hotter than expected. Katie Lyons joins us now for more. Hey, Katie.
Hey, John, way hotter than expected. And that 336,000 print on payrolls for the month of September is certainly something that here in Washington, the Biden administration is going to be touting as a sign that Bidenomics is working. We'll hear more from President Biden later on this morning at 11:30 a.m. Eastern time. The difficulty, though, for President Biden is on the one hand, yes, he wants and frankly needs a strong economy and labor market as he campaigns for re-election in 2024. But he also wants to be the most pro-union president in history, as he is often dubbed him, and that is where potentially you see things running in conflict. Our team here at Bloomberg Economics says a prolonged UAW strike, because of its secondary effects, could mean that every striking worker leads to the loss of 5 jobs in total. And when you add it all up, that is where the number of north of 700,000 layoffs comes from in the worst case scenario. And our team says if this strike lasts for 2 months, you could see 0.4 percentage point knocked off of fourth quarter GDP. We'll, of course, get more information as to whether or not the strike is expanding later today, 2 p.m. Eastern time, another Facebook Live from Sean Fain. And we know leading up to today's announcement, we have seen GM making a 6th contract offer to the UAW. Reportedly, it is a sign of progress, but not necessarily enough to stop the strike because it still comes up short of the latest offers from Stellantis and Ford. Ford, of course, made its 7th offer to the union this week, including pay raises of more than 20%, some sweetened contributions to the 401k as well. We'll see if any of it is enough to spare any of the big three, an escalation later today, John.
The longer this labour market stays hot, the more leverage they get, that's for sure. Kayleigh, thank you for the update. Joining us now to weigh in, PGIM's Mike Collins, Crossmark's Victoria Fernandez, still with us, Mohammed Al-Erin. Victoria, first to you. Your reaction, please, to a blowout headline number.
Yeah, Jonathan, it was a much higher number than we were expecting. We did think that we were going to continue to see growth in the job market. We know that we're not at the point where we're going to get a negative number. What we were really focusing on was average hourly earnings. You're just talking about all of the wage strikes, how that's going to feed into any kind of wage spiral that we see and what that means for the CPI report coming next week. We saw that go to around a 4.2% year over year. You combine that with a participation rate that didn't seem to go much higher, then I think that's where the elements are going to lie on how strong exactly is this labor market. You know, we had the JOLTS report earlier this week, and the one thing we have to look at is the quits rate is actually slowing, and I think some of that is because the wage difference that a lot of people were getting when they were changing jobs was up around 16, 17% higher. That's come down to single digits. So I think you're starting to see people level off a little bit in the rate of change for their jobs. We still obviously have a very strong labor market out there, and I think that's going to be difficult for the Federal Reserve. I know higher rates. Mary Daly was saying that that's like a rate hike, that takes the place of a rate hike. But when you have numbers this strong, and if we get a CPI number that does not show the level of disinflation that people are looking for, I think the Fed is back in the hot seat of needing to hike another 25 basis points.
Mike Collins, Francis Donald of Manulife this morning saying this: a soft landing negates the probability of a soft landing. A soft landing is not bullish for any asset class. Mike, what are your thoughts this morning?
Yeah, Jonathan, we've certainly been in, I don't know if I'd call it the soft landing camp, but, you know, a resilient economy camp, right? And you've seen it in so many ways, and this is certainly reflecting that. And we've also been in this, you know, higher for longer rate view, but I have to admit, I really didn't expect the extent of the job growth to continue. And maybe this is one number, maybe it's a flash in the pan, but the real surprise to me in the markets, and I think where maybe the markets are mispricing, is the extrapolation of the Fed's higher for longer narrative that has happened has reached pretty extreme levels, right? I mean, the markets are now pricing in. So bond geeks look at five-year interest rates, meaning what's priced into the market, what the market's crystal ball is telling us for the next 10 years. And right now, the markets are pricing in a Fed funds rate that only goes down to about 4.4% and stays there forever. And a 5-year Treasury that only goes down to 4.80, meaning it barely moves from here and stays there for 10 years, right? And it's really hard for someone who's been in the bond market this long to really grasp the idea of a funds rate that's in the fours, the mid fours, for 10 years, right? At some point in the next 10 years, it's probably going to be lower than that. So that's really what's happened in the bond market, and it's really shocking.
So, Mike, I'm trying to understand where you're going with this. There's two possibilities. One is that the market simply is wrong, or two is that it's hard to reconcile the market's interpretation of higher for longer with your hope for a soft landing. So which is it?
Yeah, the markets, these long-term forwards, Mohammed, as you know, they are wrong all the time, right? They overshoot, and investor behavior drives that, right? And what you've been talking about, Jonathan, this morning is the investor psychology out there, what they're thinking, and they're terrified of stepping in front of this rate sell-off. So they're all piling into cash. I've been speaking with a lot of investors over the last few weeks, and they are really hunkering down in the front end of the yield curve, holding on to cash. They've kind of given up on owning these longer term bonds, and people obviously are selling this morning. People are shorting treasuries through futures. So you do get these big kind of extreme moves, Mohammed, typically, in the deep parts of the recession and at the peaks in growth and at the peaks in Fed funds rate hike expectations. And it feels like we're kind of, bouncing around one of those peak periods and one of those extreme periods in terms of the permanence of what's priced into the market.
So, Victoria, if this migration to cash from both public equity markets and public fixed income markets continues, how does it impact your outlook?
Well, obviously, we want to see people be invested in the market fully. And even though we have had a negative outlook all year, I mean, we have been in that camp that said the soft landing probably wasn't going to be our outcome. We've actually been investing on some of the parts of the longer end of the curve for our clients. We don't want to just sit completely in cash or completely in a 3-month or a 6-month T-bill and have reinvestment risk coming. So the fear would be that if everyone is sitting in cash and they're waiting to try to time the market, they're either going to miss that, which is probably what's going to happen, or you're going to have a huge influx at one time and cause a lot of volatility. We would suggest, and what we're doing with our clients on the fixed income side, is you really need to barbell that. You need to have some exposure to cash or cash equivalents or short-term treasuries. But look, we're at a 490 on the 10-year treasury. I'm not sure how much higher many people anticipate it will go. Technicals tell you maybe around a 510 or a 520. If you're buying individual bonds, you're buying at a discount right now, collecting your coupon, and you can hold that bond till maturity and receive par for it. So I think there's something to locking in these higher rates on the longer end while still having some flexibility and some liquidity on the short end, especially as we see liquidity coming out of the market. In the reverse repo market, we're seeing it with foreign treasury buyers going away. I think there's some liquidity components that we need to address as well.
Victoria, we'll talk about that. Mike Collins, Victoria Mohammed sticking with us. Your 10-year this morning, a cycle high briefly, 488, right now 482. Coming up the morning calls and later, Acting Labour Secretary Julie Su with the latest on the jobs report.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Four minutes from the opening bell. Equities trying to recover here. Let's get you some morning calls. Your first one from Oppenheimer, downgrading O'Reilly to market perform, expecting limited upside as pandemic-related tailwinds continue fading. Bernstein initiating coverage on Netflix with a market perform rating, seeing a mixed outlook due to mounting competition and slowing growth. And finally, Jefferies upgrading Elf Beauty to buy, seeing an attractive buying opportunity after recent declines. Coming up, the opening bell with more from Mohammed Al-Erin and Victoria Fernandez alongside Michael Collins, and later Acting Labour Secretary Julie Su weighing in on the latest payrolls report. Your opening bell just around the corner.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Seconds away from the opening bell this morning. Good morning to you all. We pull back on the S&P. Off-session lows just on the NASDAQ. We're down by 0.8%. On the S&P 500, down by 0.6. 5 is not the magic number. We're heading towards a fifth week of losses on the S&P. Unless that changes. There's your opening bell. Switch to the board and get to the bond market. Heading towards a fifth week of yields climbing on a 10-year maturity. Your 10-year this morning higher by 12 basis points to 484. Yields up, dollar stronger, euro lower, 105.12. The euro poised for a 12th consecutive week of euro weakness against dollar strength. The dollar absolutely dominant in G10. That currency pair pulls back by a third of 1%. And crude, look out below all week, heading towards the biggest weekly loss potentially going all the way back to March. Crude right now positive by 0.6%, 82.83. About 30 seconds into the session, this looks better than it did about an hour ago. On the S&P, we're down about a half of 1%. On the NASDAQ, down by about 0.7. One stock to watch at the open is Exxon, the energy giant in talks to acquire Pioneer Natural Resources, nearing its largest takeover since 1999. Citi saying the following: the logic of consolidation in the highly fragmented Permian shale remains compelling, with significant gains to be achieved. Abby has more. Hey, Abby.
Hey, John. And yes, this is a big one. So sources are saying that ExxonMobil is very close in advanced talks to acquire Pioneer Natural Resources. It could value Pioneer at $60 billion. Yesterday, Pioneer had been worth $50 billion. They, of course, are one of the premier producers from the Permian Basin, which is basically runs from parts of Texas and New Mexico. It's one of the most lucrative parts of the oil patch in the U.S. because it's much more easy to extract the oil. So what this would give Exxon essentially is, rather than buying a company where they would potentially have to develop unproven acreage, almost like a faucet where they can turn it on and off. So when oil is lower and volatile and it's been weighing a little bit, ExxonMobil into today had been down about 1%, and Pioneer into today down about 5% on the oil volatility, plus concerns that there could be a global slowdown and that would weigh on oil. But if there was a resurgence, they basically just have to bring out this oil. It's not quite as simple as that, but that's one way to look at it. Now, sources are saying that this deal could close in coming days, but it might not be super easy, John, because there could be some solid political and regulatory issues, scrutiny, given the fact that earlier this year in February, the White House did accuse Exxon of achieving what are called bumper profits at the expense of consumers. Stay tuned, but right now we do have Pioneer up about 8%, Exxon down 3%, suggesting that many do think that the deal could actually go through.
Stay tuned. Abby, thanks for that. Let's turn to the autos. GM presenting its 6th contract offer to the UAW, writing in an email that they're ready and willing to negotiate in good faith 24/7 to reach an agreement. This coming as Union President Sean Fain prepares to deliver an update on social media at 2 p.m. this afternoon. Simone Foxman on top of this story. Hey, Simone.
Hey, John. Yeah, all eyes are on that announcements, which will be Facebook Live, YouTube, etc. in this day 22 of the United Auto Workers strike. We could hear plans to expand the strike today. Right now, 25,000 United Auto Workers are striking of the 145,000 total population. And so far, the strikes haven't impacted the plants that produce the full-size pickup trucks, the large SUVs that are the most profitable for these companies. So we're very much focused on where we see those potential strikes expand, because they could have more of a hit than we've currently seen on their bottom line. And we'll also be looking for whether or not the union is going to reward progress on some of the talks, including perhaps with GM, where it does seem both sides have made some progress, a little bit on retirement benefits, even though GM very much focusing on strengthening 401ks. However, despite that announcement from GM that there was this offer submitted, we saw shares close at their lowest since September 2020. Ford has also been under pressure, really lowest since August. Stellantis is holding up better a little bit because of its global operations, and shares of all those companies are down, or Stellantis unchanged today.
Simone, thank you. More on this story with the Acting Labour Secretary, Julie Su. We'll cover this in about 10 minutes' time. Let's check out shares of Tesla right now. Tesla cutting prices on its top-selling models in the US again after Q3 deliveries fell short of estimates. CEO Elon Musk taking to X to challenge his critics, writing this: "Sometimes they question if I should even run Tesla. My response is simply, watch other CEO. Would you prefer?" Isabel Lee has more. Hey, Isabel.
Hey, John. Lots of markdowns across the board. The company slashing the starting price of its base Model 3 by $1,250. It's slashing the long-range version of the sedan by the same amount. And the Tesla also shaved some $2,000 off the price of the performance version of the Model 3, as well as the performance versions of the Model Y sports utility vehicle. So what do these discounts mean? Two things. It will dampen the company's profit margins, but it will help stoke demand. And we have the CEO, Elon Musk, downplaying the trend so far. He said that, the company could sacrifice earnings up front, but it could make it up by software upgrades. Tesla shares are now dropping by some 2.5%. The stock has more than doubled this year, John. It's up by 111%. Tesla has delivered some 435 vehicles in the last 3 months, but is still short some 20,000 of what analysts were expecting, John.
What a move on that name this year. Isabel, thank you. 254 in early trading. Let's finish on consumers. Levi's wholesale concerns persist after reporting third-quarter results. The CFO saying this: "Given the ongoing uncertainty in the macro environment, we're taking a cautious approach to our outlook for the fourth quarter." Katie, that stock down 3%.
Yeah, it is a down day for denim. Quarterly revenue came in light, and that led the company to take a, quote, more cautious approach to its projections. Levi now sees EPS at the lower end of its previously stated range while scaling back its revenue outlook as well. Now, if you take a look at the last few quarters, Levi actually either met or beat its estimates, which makes, of course, this latest round of earnings even bleaker. And, of course, they're the first major U.S. apparel retailer to report, and their results are closely watched for that reason. Levi's CEO told Bloomberg News in an interview that, quote, "middle-income consumers and below are definitely being impacted, especially here in Europe, but that's also true in parts of Europe as well." Now, the sell side not too impressed. While the direct-to-consumer business was a bright spot, it was the wholesale business that remains a concern in some of the reports coming out this morning. And you can see that in the shares. Levi currently down about 2.7%.
Katie, thank you for the update. Allow me to give you the update for the broader market. If you're just joining us, where have you been? You missed it all in the last hour. The jobs report, a blowout number, 336,000. The estimate, 170K. The previous number, 187. The move you might expect. About 16 or 17 minutes in, or rather 6 or 7 minutes in, equities are down by about 0.5% on the S&P. The NASDAQ's down about 0.5%. Major moves in this bond market. Yields up another 12 basis points to about 484 on a 10-year. On a 2-year, back to 5.1%. On a 30-year, we're back at 5%. We're back now with PGIM's Mike Collins, Crossmark's Victoria Fernandez, Mohammed Al-Arian. Mohammed, I want to come straight to you and ask you about the financials, the banks. Typically, we talk about good data, higher yields, good for financials. That's not happening. Why not?
I think the markets are concerned about two things. One is the impact of higher NIMs, potentially. Higher net interest margins are being offset by deposit outflows out of banks into money market funds. The second issue, which is of more concern to the market, is that there's a worry that if interest rate risk continues to be in play like this, it will translate into credit risk and liquidity risk. And I think that is what's being captured by yet more pressure on the financials.
Victoria, is that something you're worried about?
Yeah, I mentioned a few minutes ago that we were concerned about the liquidity issues that we're seeing in the market, and I think that's part of what you are seeing in the financials, along with the fact that you're seeing like Citi say that charges on credit cards was actually down over the last few few weeks. So the consumer is getting hit a little bit harder. That has to be concerns growing then around lending, around delinquencies on credit cards. All of that feeds in to what these financials are doing. And when you tighten those financial conditions and when you squeeze the liquidity that's in the market, financials are not going to do well, even with the re-steepening of the curve. I do think, however, we'll see financials start to come back because their balance sheets are strong. So even with all the macro data that's going on, the balance sheets themselves should be able to hold through the volatility. So I think you want some exposure to them for longer term holdings in your portfolio.
Mike Collins, I want to talk about these unrealized losses in this Treasury market. The price destruction in Treasuries, particularly at the long end, since we peaked back in spring 2020, has been absolutely phenomenal. The team here at Bloomberg broke down the numbers earlier in the week, and at the time that story was published, the numbers looked like this. Bonds maturing in 10 years or more, they've dropped 46% since peaking in March 2020. 30-year bonds, even worse, tumbling 53%. These are monster moves, Mike. They're getting even worse this morning. Mike Collins, who owns that? Where's that pain right now? Where's it sitting?
Yeah, Jonathan, that's exactly where I wanted to go. And that's kind of the third leg of Mohammed's stool that could hit not only financials, but broadly the whole economy, right? And who owns those bonds? Fortunately, you know, the Treasury or the Fed owns about 8 trillion of them, right? So that actually does cushion the blow to the private sector. But insurance companies own them, pension plans own them, individuals own them. And it's not just bonds being marked down, Jonathan. It's all asset prices. I just came from a real estate conference, and people are really worried about the potential for a lot of forced selling. A lot of people bought real estate at high prices over the last couple of years, and those marks are moving down, and they still have a long way to go down from where they are today. And the financing cost, if you didn't lock in your rate, is going in the opposite direction. So a lot of these are now underwater, right? So it's really across the whole economy. You see it in stock prices every day, but it's really the slow-moving prices. It's the private debt. It's the commercial real estate. That's another shoe that hasn't dropped yet.
So, Mike, I want to push you a little bit more on this, if I may. Because it's not just domestic, it's global. People are also worried about the spillback from the Japanese reaction. So is this a slow-moving process that the market can accommodate and the economy can accommodate? Or is this something we should be worrying about tipping points?
You know, I think it is a slow-moving process. Our base case, Mohammed, is that there isn't as much leverage in the system generally. Like a lot of this real estate hasn't been overbuilt. It hasn't been levered. Certainly the housing market is not levered at all. The banking system, as Victoria pointed out, is not a levered system anymore, right? So that's really good. But as the realization of these lower asset prices, and you do get liquidity events and flows where people have to realize those losses at some point. And so maybe it takes quarters or even years to get realized, not days and weeks, but that is something that does nag at us over the intermediate term and make us certainly more cautious on the global credit markets in general.
Mike, we've heard a lot of Wall Street phrases, cliches through the week, catching falling knives, buyer strikes, all of that bad stuff. Mike, your colleague, Dalip Singh, talked about the loss of predictable demand in the Treasury market, China, the Federal Reserve. Mike, that's not coming back potentially. How does that change things? That change of character in the sources of demand, what does that mean for this Treasury market, this Treasury curve?
Yeah, I mean, part of that, believe it or not, Jonathan, again, this is kind of wonky stuff. Some of that is priced in. If you look at long-term Treasury yields versus long-term expectations of the funds rate or other derivatives on that interest rate, it's about a 70 basis point yield premium that the Treasury is actually paying every time they go to the auction block to issue Treasury. So there is a supply premium already built in. You could call it a credit premium in some cases on the Treasury market, built in already, and that's one of the reasons that yields are at these higher levels. And whether that persists or not is anybody's guess. But it's a little encouraging that a lot of that is priced in.
Mike Collins, thank you. Mike Collins alongside Victoria Fernandez, together with Mohammed Al-Erin. I'm pleased to say Mohammed's going to stick with us. Stocks pulling back by about 0.6% on the S&P 500. Up next, the September payrolls report coming in hot.
This is a much stronger labor market. Clearly, that's what we see in the report today across the board.
Acting Labour Secretary Julie Su up next.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing: screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at BloombergLive.com/screentime.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on a dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City on Bloomberg TV and on Bloomberg Radio, I'm Jonathan Ferro. Joining us now from Washington is Julie Su, the acting U.S. Secretary of Labor. Julie Su, wonderful to catch up with you. A hot labor market report at a time where the unions seem to have a lot of leverage, so let's go straight there. What's your latest read on the UAW negotiations?
Well, the parties are at the table. They're continuing to negotiate. The president has made very clear, something I believe in too, that when there are record corporate profits, there should be record contracts for working people, and that's what workers are fighting for. So the negotiations continue, and I believe that the parties will get there.
Are you getting access to both parties to help negotiate a settlement?
Yeah, we're talking to both parties. I mean, again, the collective bargaining process is about the parties themselves coming together, working through their issues, finding common ground and win-win solutions. We support that in every way that we can, and we are continuing to talk to the parties in that particular situation.
What have you heard recently about current demands from UAW? We understand that wage demands have come down from 40 closer to 30. Is that your read on things?
I mean, a negotiation is always about movement on both sides. At this point, I think it's always hard to know exactly where something will land. I think as long as they're talking to each other, that is positive, and that is what is happening.
You're sensing the gap is closing. The spread has narrowed.
I'll say it this way. I've seen this a lot. I think that the parties always seem like they're far apart until they're not. So that always requires movement. And I think the continued engagement is a positive thing. And it's part of the reflection of President Biden and this administration's commitment to workers getting their fair share in an economy that is doing really well.
We also have healthcare strikes as well. I understand you've met leadership from both sides. Julie, how different is that particular strike? What do you think is going on there?
I mean, every strike has its unique issues, right? The industries are different, the specific demands are different, but I think the bottom line is that we are seeing a resurgence in worker power, in support for unions in the economy, and for working people demanding their fair share, saying, enough of the disparities between what frontline workers make and what CEOs make, making sure that there is an opportunity for workers to improve their working conditions and live stable lives. This is not just an accident in a Biden-Harris administration. It is very much a deliberate part of how we think a strong economy and a strong country works.
Madam Secretary, as you rightly said, we are seeing a shift back in bargaining power towards labor after decades where it went the other way. That's being reflected in a spike higher in number of days of strikes throughout the economy. Should we expect that number to go even higher?
I think it also reflects really record contract results, right? So we've seen from the ports on the West Coast to the Teamsters and UPS, really results that demonstrate workers getting more in wages, ending forced overtime, dealing with other specific issues within certain industries, or automation and the like, addressing conditions like heat and other kinds of health and safety issues. So I think those are the big results. And some of them we're talking about, we don't talk about them as much, but there are, graduate workers who have gone on strike for brief periods and gotten contracts that they want. So I don't know what the average number of days is, but I do know that workers coming to the table, being able to have the right to demand their fair share is something that has been positive for workers and is very much part of the strong economy that we've been talking about, and the jobs report reflects this.
And yet we have not seen that in the numbers on earnings. So is it just a lag effect? Are we going to see it going forward? Or is there something else going on in the economy that's offsetting those gains that you talked about for workers?
Yeah, so earnings are up a bit. We definitely especially see that among lower wage workers, which is part of this idea that, the president has said, we're going to build an economy that leaves no one behind. That starts by looking at who's been left behind in the past. And to the extent that those lower wage workers are seeing average gains that are growing and also that are higher than inflation, means that workers have more money in their pockets, more to spend in their local economies. That's also partly fueling the other effects of the jobs report, which is, more job growth in leisure and hospitality, for example. All of these taken together, along with the historically low unemployment rate, still under 4% for over a year and a half, the longest stretch of the 1960s, are all signs that this economy is a place that, is doing well because of good economic policies and workers having a seat at the table.
Well, let's talk about those policies. There is something really peculiar going on at the moment. If you think about what's happening at the picket line, they have serious concerns about the EV transition and their participation in it. A transition that you are subsidizing. Something really odd from my perspective, and I'd love some clarity from you on it. Why is the government offering rich people credits to buy expensive cars?
So a couple of things. There is widespread support in the country for tax credits that will help to bring manufacturing jobs to the United States. That's part of what we're trying to do. The other is that we do have a climate crisis, right? We saw record heat across the entire country.
Without a doubt. Can I just jump in? Without a doubt. I totally agree with you, but I just think we're conflating solving a climate crisis with driving really heavy SUVs that run on electricity. Are those two things part of the same story? Because I don't get it. If I'm driving an electrified F-150, am I really saving the planet?
Right. Well, so we could probably have a conversation now about personal choices relating to cars. I do think as a policy matter, the more that we can invest in industries, in manufacturing, including in transportation, that transitions us to a place where we're not continue to pollute the planet, right? We have a method by which we can both bring down emissions and also create good jobs. And the president has always said that solving our climate crisis, when he looks at that, it's also about creating good jobs and good union jobs in communities that need them the most. And we are really focused on making sure that that transition does not leave workers behind, and that what's good for the climate can be good for workers as well.
Julie, appreciate the update. Julie Su, Acting US Secretary of Labor. Equities down, your trading diary up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Mohammed Al-Arian, you get a final word this morning. What a morning so far.
It is a morning, John, and it's one that should remind us, whether it's the job reports, the UAW, that it is about the supply side. We should get used to the fact that the supply side is a constraint, and that means difficult decisions across the board. And unless we make these difficult decisions quickly, including at the Fed, we may mishandle this last mile in the fight against inflation.
Mohammed, thank you, sir. Fantastic to catch up this morning. Live from New York, this is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, October 6th. We made it. Here are the top market stories we're following for you at this hour. Landing? What landing? September jobs number blows the lights out, pushes back Fed cuts, raises the odds of another increase this year. We're going to talk to Sophia Drosos, .72 economist and strategist. And bond bears in control. You got yields jumping 10 basis points plus pretty much all across the curve. Stock sinks and the dollar rallies. And a big deal for big oil. Exxon nears a takeover for shale giant, Pioneer Natural Resources, potentially for $60 billion in a blockbuster tie-up. This would be Exxon's biggest acquisition since 1999. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. So this is a way to end the week, Guy.
Yeah, we always talk about the fact that the payroll number is an important number. I think it just kind of proved just how important it can be. I am, though, struggling to figure out what you think is the most important story of the day.
Please.
Is it the payroll number or is it the Pioneer number?
Hello, it's Exxon and Pioneer for me. I've been in this tunnel since last night. This would be a humongous deal and have big implications for the industry and for DC and policy, but, we'll get to that.
Yep. Could be peak Permian. You pointed that out to me a little bit earlier on.
I did.
Maybe that's the question we should be asking. Are we at peak rates? Well, maybe today's number, Alex, pushes back on that idea. You're seeing a big rally, of course, obviously, in yields today. Bond prices pushing lower. Equities down pretty sharply. That was an incredible number. And it was the revisions, and it was the breadth, and it was everything about this that just convinces us that this is a solid number. I wonder what this market would look like if we got a solid CPI print next week as well.
Yeah, or are we starting to price that? I don't know. Although the wage number it came back a little bit. Ben Emmons was the only one who kind of nailed this number. He was like, if you add up ISM manufacturing, ADP, and you have claims, if you put all the numbers together and you just do a regression analysis, you got this number. So maybe all that data actually makes sense and works.
Yeah, though people are pushing back a little bit, maybe more firmly today on that ADP print and questioning what value it has. Anyway, our question of the day, you laid it out pretty well at the top. What landing? This is an economy that still feels like it's going from strength to strength to strength. Obviously, yields, though, continue to climb. And over here in Europe, we don't have the benefits of that strong labor markets. Let's talk about where we go from here. Are we seeing a landing in the U.S. economy? Mike McKee joins us, of course. Denitsa Tevkova joins us in New York as well. She's there now, which is fantastic. All in one place. Denitsa, let me start with you. What landing?
I think we still have a really good chance of soft landing. Obviously, today data is changing a lot of things for the Fed. We've been talking about higher for longer. And if we look at the print today, this is obviously something that we hear a lot stronger. We can see what's priced into the swaps today. We were expecting a reg cut in July, and now it's priced in September. So a really big difference. But also, the other side of this is financial conditions, and they've been tightening at a very fast pace.
And we know numerous Fed officials have actually been talking that this has been doing the Fed job. Stocks and bonds have been selling off, and financial conditions per the Goldman Sachs index are actually the tightest in a year. So, of course, that adds another piece to the pie. And even though today the reaction is very negative, some of it it's coming down. Long term, there are some catalysts that still can help that soft landing.
Yeah, I mean, you heard Mary Daly talk about that yesterday in terms of the move in yields. Okay, Mike, now if it was my question to be like, dude, where's my landing? So,
I like
dude,
the way
where's
you put
my
that.
landing?
That's why we don't let her set the question. Well, after the show, when we can speak and not get the FCC involved, I'll tell you what my question would have been.
Guy had one very similar to yours. Yes.
But landing, I don't know. I'm struggling to come up with a good metaphor for what we saw today because job creation was so strong, particularly in the service industries, and yet we saw average hourly earnings start to slow down or continue to slow down, especially for service industries, up only 1.7%. So no real wage pressure coming from this enormous jobs number. So that's good news for the Fed. And I suspect that what will really be important is the CPI now. If CPI comes in as forecast, which is at about half the level it was on a month-over-month basis the prior month, then we will see the Fed maybe stay on hold because they don't have to fight inflation and they can still have this strong economy. And you know that Mary Daly yesterday told Bloomberg that essentially the markets have already priced in a move for the Fed. So I'm not as sure as some people are that this is going to lead to a market reaction or to a Fed reaction rather and force them to raise rates.
Okay, let's talk about let's put the rate rise to one side. Let's talk about the higher for longer bit though. This is an economy that doesn't in any way, shape or form feel like it needs rate cuts right now. Isn't that where the debate really should be here? Yes, maybe we get 25 in November, maybe we don't. But it's really about this is an economy that's not slowing down sufficiently, back to the no landing kind of idea, to justify any kind of a rate cut.
Well, on a historic basis, you'd be absolutely right. The problem is this is not the economy. It's not the monetary policy that we have seen in the past. The models don't work, and it's hard to figure it all out. If you were just looking at the economic data at this point, you would be saying the Fed may have to do something because the economy is running very hot. But with inflation coming down, that story doesn't completely hang together. And then you throw in the idea of real rates as inflation falls, getting even tighter. And so therefore, the Fed maybe does want to bring rates down because they want to keep the same amount of pressure on the economy, but they don't want it to get any tighter than it is. So it's going to be really hard to figure this out, and I'm glad I don't trade Fed funds futures.
Yeah.
No, I don't. Neither am I. Denitza, talk about then, put those two together, because Guy was talking about if we get a hot CPI print next week, and we have a 10-year that feels really reluctant to get to 5%, but like it kind of wants to, but then the market seems to back off. Do we get there next week if we get a hot CPI?
Yeah, I think it's obviously like markets have been very sensitive towards very positive data, and any type of good economic news have been very bad for markets. And we have seen some of those reactions have been very sharp. So how far can we go? That's kind of a question that's been here for a while, and a lot of people are saying we can go much higher than this. But the other thing is today and actually in the last few days we saw some of those losses really retracting. We saw bond yields falling earlier in the week. So are we going to see the same speed of increasing bond yields? Are they going to be that scary to markets? That's something we're going to see, and maybe risk assets won't be as reactive as they were in the last few weeks after that big shocking increase in yields.
Alex, the problem with all of this is we're looking at it through the prism of the United States. The US economy clearly is strong right now, certainly if you judge it by the labor market. Over here in Europe, it feels like a very different picture. The UK economy is struggling, the European economy is struggling. Look at what is happening in Germany. We seem to be back to, and you can apply this to the dollar, but I think you can apply this to rates as well. Our rate, your problem. Our dollar, your problem. Our currency, your problem. The rest of the world is looking at this with its mouth on the floor, wondering what on earth is coming next.
Yeah, and it's really interesting because I feel like the narrative just a few weeks ago is that the U.S. economy is super strong and that's why yields are higher and that's okay. Like then we can all kind of make peace with that. But now that narrative seems to have shifted and then you get this jobs number. So it does get really confusing on that. Denitza, you just moved here, you were residing in the UK. I mean, are our rates everyone else's problem?
Well, rates is problems for everyone, for sure. And you can see the reaction of every small economic data print trickling down to other rates as well, because everyone is looking at the Fed and what they're doing. Obviously, we're seeing kind of a big disparity of what central banks are doing at the moment and different paths over there. But the data prints here are very important for everyone. And of course, things are changing a lot in terms of what we're seeing for rate cuts this year. Like last year, we were pricing in nearly 100 basis points, and now that number has fallen so sharply. So that makes a ton of difference for everyone.
Mike, the rate of change is important. And today's number is such a big blowout number. You have to think back to kind of the rate at which we are changing, have changed, maybe are going to change. So far, Mary Daly, talking to Lisa yesterday, talked about the fact that maybe 25 basis points of hikes effectively have been done by the market. But is the Fed comfortable with what we're seeing here? If this continues, at what point do we see more Fed speak coming out and maybe trying to slow things down? Do you think there is going to be an effort maybe to slow things down at the moment? It probably is comfortable now. When does the Fed become uncomfortable?
Well, if you were to see inflation expectations or wages start to rise significantly, then yes, the Fed would become more uncomfortable. I wouldn't even say...
No, but what about the yield story, Mike? With what's happening in the bond market, when would the Fed start to become uncomfortable?
Well, that's a tough question to answer because at this point, the markets are basically catching up to where the Fed is. So if you go beyond that, if we start to get well above 5% in the 10, for example, then the Fed might become uncomfortable with that. But at this point, the Fed is just looking at this and saying, well, they're doing what we wanted them to do 6-8 months ago, and they're finally catching up. And we do see this reluctance in the 10 to breach the 5% level. So given where we are, again, I go back to the CPI report next week. With oil prices going down, with wages growth slowing, there doesn't necessarily have to be a big rise in the markets from here if people think that they are fairly priced.
Disorderly. I think the word we came to yesterday, Guy, was disorderly. And it doesn't feel like then we're still there yet. All right, guys, thanks a lot. Really appreciate it. Bloomberg's Denitza Zakova and Michael McKee. Thank you both very much. So coming up, more insight into the question of the day. What landing? Dude, where's my landing? Rebecca Patterson, a former chief investment strategist at Bridgewater, joins us next. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
this is very unusual. But there's a reason why this is so unusual, and that's because the characterization of the economy has changed in my mind. What we're seeing here, John, is just a massive reaction to not rates going higher. That was last year. This year is about high rates staying there for longer. And that is a fundamental change of how you think about the yield curve, and that's what we're seeing playing out in the markets.
That was Bloomberg opinion columnist Mohamed Al-Arian earlier today on Bloomberg TV on the reaction to the jobs data. And that brings us to the question of the day, what landing? Joining us now for her take, Rebecca Patterson, a former chief investment strategist at Bridgewater. Rebecca, that's just our starting point. But what landing? Is the economy going to land?
I think we're still likely to see a mild recession at some point next year, probably going into mid-year, maybe first half. And I think that because we are going to see the Fed, as it's been trying to get the market to believe for a year, now they finally believe it, they're going to have to hold rates higher for longer. And so this tightening pressure is going to remain and feed through to the economy, consumers and businesses. I also think there's a super important feedback loop that you all touched on in the previous segment. I was very jealous because I wanted to use that line. Our bonds, your problem. Because when our bond yields rise, the bond markets are so interconnected today, it feeds through to other countries that are getting hit a lot harder by those higher interest rates. Their economies slow further. Germany already in a recession, Europe probably going in a recession. When inflation's still high, their central bank can't bail them out. So I think that's going to feed back into the U.S. economy, exacerbate our downturn, and likely make us avoid a soft landing next year. I say likely. It's not a super high conviction view, but I think that's my base case.
It's tough to have a high conviction on anything at the moment, isn't it, Rebecca? If you are, though, looking at how much longer the move that we've got currently underway has to go, are we at the point where the markets are kind of in line with the Fed in terms of kind of the 10-year yield? Are we going beyond where the Fed is? How much further do you think yields can rise from here?
Yeah, no, I think that's a great point. At this point, I believe if you look at the Fed funds futures, what the market is discounting for short-term rates going into the next couple of years, we're probably close to what seems right, in my opinion. And that means now we have to focus more on the consumer and the labor market. If we can have better data next week, right? We have inflation coming out. If that's a little bit softer, then people might say, okay, never mind, we're all good, we're still good, take a deep breath. If we get a CPI print that's in line or slightly higher, that's going to keep that nervousness going. And of course, what we've seen with the 10-year, with bonds in general, is that a big part of this recent rise in yields is risk premium. It's the term premium. And that is a little bit distressing because that could be a lot of factors. One could be worries about our fiscal situation, worries about our dysfunctional government. I don't know if those go away anytime soon. So I think bond yields can stay up here for a while, maybe not rise a lot more, although, look, a breakthrough 5% at this point for the 10-year, it's not far away. And anyone who says, oh, we're going to see 5, well, big deal. Like, that's not a bold forecast at this point.
Right.
The problem is if it's disorderly, right? If we get a fast move and it's unsettling for other markets.
I mean, Torsten Slog talked about that, about cost of capitals, that's permanently higher for reasons that don't have to do with the business cycle.
Right.
It doesn't have to then do with inflation.
And I love Torsten, so anything he says I take seriously. I do think there's a good chance that we settle higher, both on inflation and on interest rates. The question is how much higher, and then how does that feed through not only to our U.S. economy, but also the global economy? I think the degree is going to matter a lot. I can't imagine the Fed's going to let inflation settle much above its target because it's going to worry about credibility. Now, 2025, when it reviews policy, then we're in a whole different conversation.
Okay, so what do you do right now? You're looking at asset classes, you're trying to figure out exactly where you're going to allocate money. The bond market move may have further to go. Am I safe to dip my toe in the water and buy some duration at this point? Has the move fed through sufficiently into equities? Are we starting to see cracks forming in the credit markets? What are you seeing in front of you in terms of what priced correctly and what still isn't?
Yeah, I mean, certainly when you can get 5% on cash effectively, having some dry powder there to me makes a lot of sense just because this coming 6-12 months is going to be pretty uncertain. So I would like to have a little dry powder. I also think in the equity market, we had a nice run for cyclical stocks going through the July through recent period. I prefer having some more defensive sectors in my portfolio, things like healthcare. I also think defense is interesting right now. We're focusing on the budget, on what we can cut. That is one area we have bipartisan agreement. No cuts are coming. The government money, regardless of the cycle, is going to keep going into that space, not only in the U.S., but globally. On the longer-term bonds, to answer your question, I would be tiptoeing in. We could break 5. We might get a little above 5. But at this point, your risk of loss, in my mind, is a lot smaller than your risk of gain if we're taking a 6 to 12-month view. If we have a slowdown in the economy, it is very likely, in my mind, that longer-term bonds are going to find a ceiling and the yields are going to start coming down. Even if they don't come down a lot, you're still going to be gaining from that.
So does that mean that the 60-40 portfolio is just toast? Like, does it need to be, how would you be allocating then from that perspective?
Actually, I don't think it's toast. Look, I know there's a lot of very smart investors out there saying you need to rethink it, you need to have a bigger allocation to alternatives,
Private
absolute
credit,
returns. Right. And I think there's a very good rationale to be considering bigger allocations to that. But having some bonds in your portfolio, I think, still makes sense. The relationships, it's not the correlation, right? Bonds and stocks sold off together last year. It's not the correlation you want to focus on. It's the causation. What caused bond yields to rise last year? Do you think that's going to continue to happen over the coming years? Maybe in the very short term, but over the next 2-3 years, I don't think bond yields are just going to keep going straight up. Again, they might settle at slightly higher levels, but if they can settle in any sense, you're going to be making money off bonds. So I do think you want that allocation strategically.
That's such a good point, and sort of the why and then how that relates to how you view the stock market. Rebecca, such a pleasure. We love seeing you. Thank you for coming in.
Thank you.
Rebecca Patterson, former Chief Investment Strategist at Bridgewater Associates. All right, still ahead, one market mover is Tesla. Guess what? It's cutting prices again. Automaker trying to juice up demand for EVs. We're going to break down all the details next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It is 23, sure, past 7 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond. Silicon Valley starts its morning. Joining us now in the studio in New York, Bloomberg Technology co-host Caroline Hyde. Tesla cutting prices again. Seriously, again?
Again. They keep on rinse-repeating, and I'm rinse-repeating your outfit, so thank you for letting me be color coordinated today. It's interesting, isn't it, that we're seeing in this fight versus inflation, in this fight against a consumer that we're concerned about slowing down purchases, once again, Elon Musk just signals he is not worried about taking profitability down to keep the sales being buoyed. And basically it's because they're able to produce more. There's less of a supply chain angst around the chips. They're able to, having slowed down production in the third quarter that caused everyone by surprise, only pumping out, 435,000 cars. They're now managing to ramp up, manage to dial down the price, and what we're seeing about $1,250 taken off some of the lower range Model 3s and Model Ys.
Yep.
Higher range, you're seeing about $2,250 knocked off.
Caroline, is this a reaction to higher rates? I imagine that a lot of people buy these cars on credit, and the cost of that credit is going up. I'm wondering if the price cut is commensurate with the increase in the cost of financing.
Well, Elon Musk definitely has warned that the macro environment, he's not afraid to go out there and say, look, if you keep on hiking up rates, this is going to be a significant impact on corporate America. So maybe that is him signaling that he has to keep on taking down the price point. This is also, though, a competitive space. We've just seen BYD over in China almost neck and neck in terms of the amount of cars that they're producing now. I think they produced 430,000 in the third quarter, and Elon managed to pump out 435,000. So I think this is also just a competitive landscape for EVs, and he's having to show, look, that I can actually beat you when it comes to the amount that I produce, and therefore the amount of profit that I'm able to just siphon off. It's also interesting, Guy, that of course Elon Musk will come out and say, look, the way that I can prop up my profitability going forward is when you get your software upgrades. I can charge you more for that. But of course that all comes down to some autonomous driving as well.
Yeah, you know what's so interesting is that on first blush, you're like, ooh, maybe it's a demand problem. But I think you're totally right. He can do it. Like, he can undercut the competitors, and particularly the ones in the U.S. He can do it. It also shows that he can also change the price on Monday and actually raise prices. But the idea that, like, I can just make these cars cheaper and I can deliver them, therefore, thus, this is the new model.
And in such an incremental manner. I mean, it feels like every week, if not every day. I think it was only a couple of days ago, he stripped down some of the price point on the new extended range Model Y. So we're already seeing that he sort of just does it on a daily whim, as you say. Notably, we'll have to see how it responds to demand.
It's so interesting. So many people are talking to me now about the fact that AI is going to allow dynamic pricing in so many different areas. And you do wonder whether or not this is effectively dynamic pricing. We're not getting demand, we'll drop the price. Demand comes up, we'll raise the price. I wonder how dynamic this pricing model ultimately could become.
And how frustrated it makes people who've just bought the car. I mean, we know how much he antagonized Chinese consumers because people had just put their money in, got the car, and then suddenly we see big price cuts. So, yeah, you've got to see how it impacts some of those loyal followings that he's already convinced to purchase.
And Guy, also I want to add what it does to the auto workers. Look at the strike. This is a great example of like fighting for pay.
Well, he doesn't have that issue, right?
Exactly. He doesn't have that problem.
Well, he doesn't for now. We'll see, obviously, if they get a good deal, maybe that changes. They're doing dynamic pricing for beer in London as well.
Are they?
If the guy before me gets a cheaper, a cheaper beer than me, maybe I'm going to be a little bit annoyed as well.
Berlin's always been
everybody's behind me, maybe pushing the price up. Caroline's going to be,
We're back
for another season of AI IRL.
My opinions sometimes elicit unfriendly responses from my peers, but let me try to explain my thought on it.
So to start, Twitter and X are two totally different companies in my head. Companies are driven by the culture of the people who are there. They're two totally different places.
Not to ask people about their bosses, but Mark Zuckerberg, how is it changing his priorities?
A lot of time and thought is invested into how you can innovate.
It turns out that the popular chatbots, ChatGPT, Bard, and others, are so easily hackable to actually drive a different agenda from what is bounded as a response mechanism.
There's a tipping point here where the images have become so good that really smart people who are by design critical are falling for it. That was number one. But here's the other one that really scared me.
Do you think that there's potential to see kind of an AI rust belt of sorts?
My personal opinion is no. That might be somewhat contrary to what others are thinking.
Do you think that it can replicate the solace and comfort some people feel with religion?
What I have seen is that it really varies depending on how people think about the way that, higher powers or the divine might move through the material world.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
We're about an hour into U.S. trading session. I gotta be honest, the sell-off in stocks is not as bad as I would have thought after the move we've seen in the bond market. Abigail's tracking the moves. But that said, Abigail, it's been a pretty tough week.
I would agree with you on that. On both points, actually. The sell-off's not as bad as I would have thought. But yes, take a look at this week. And it's a little bit of a roller coaster. The real sell-off was on Tuesday at one point down about 1.7% that day. Had that happened on the close, it would have been the worst day since March 7th. Here's today's decline on the hot jobs report coming off of the lows. It wouldn't almost be surprising to me if maybe we finish in the green. I know that's probably a little bit out there, but it doesn't feel as though this selling, there's a ton of conviction. Maybe the seller's growing a little bit tired, but this is the 5th down week in a row. If the loss holds, it seems like it probably will right now, down 1%, the longest weekly losing streak going back to May of 2022. Why? Well, that hot jobs report, a piece of it, the eco data, yields going higher on the week as investors really contend with the idea that higher for longer. If you take a look at what's happening on the week yield-wise, so the 2-year yield, the front end, not really doing all that much, already above 5%. But take a look at the 10-year and the 30-year. Not so long ago, the 30-year was also back above 5%. So the 2-year, this upside-down world, pulling the rest of the curve higher as the curve re-steepens. Some saying that is a sure sign of a recession ahead. But this move in yields higher, it of course takes liquidity out of the system, makes valuation look less attractive. So net, we do have stocks, again, down for a 5th week in a row. As for one of the worst sectors on the week, funny enough, well, in an inverse way, it's related to yields, but I would argue that New York crude right now down 9.4%. Some people are probably going long crude as a way to go short bonds. Now we have crude coming off of those lows, but nonetheless, a bad week, and you can see the S&P 500 energy index along with some of the individual movers down sharply. Well, but most sectors are down this week, including utilities, real estate, and of course, those dividends look less attractive as yields go higher. Let's put it together. I opened this chart for the first time in maybe 3 weeks. We've been looking at it over the last couple of months. I was a little bit surprised because we do have a breakdown on our hands. So the fan lines here, that tells you that there was a reversal of last year's bear market, then this uptrend, but this convergence makes it bearish because the buyers are getting less and less excited. We are now below the bottom of this trend line. The RSI is continuing to go down. This suggests, Alex, that we may see more selling ahead. In fact, I can make the case easily for 4,000, an equal and opposite move of the congestion that we had this summer. So stay tuned. And I think the biggest piece is probably the Fed and now the idea that maybe they are in fact going to have to hike in November.
Yeah, I'm hanging with Bank of America, talking about how you want to be selling the rallies to that level on the high end in particular. Abigail, thanks a lot. Really appreciate it, Abigail Doolittle. All right, let's get a deeper dive into that payrolls blowout number. Julie Su is acting labor secretary. She joined Bloomberg TV last hour, highlighting the strength of the labor market and the shifting balance of power when it comes to labor unions.
We are seeing a resurgence in worker power, in support for unions in the economy, and for working people demanding their fair share, saying, enough of the disparities between what frontline workers make and what CEOs make.
Well, for more insight, we are now joined by Sophia Drosos, Point72 economist and strategist. She just upgraded her 4th quarter growth forecast yesterday to 4%, very prescient when it comes to what we just saw. Sophia, great to see you. Thank you for joining.
Oh, it's great to be here. Good morning.
Good morning. So our question of the day is what landing? And I think it's appropriate, particularly as you upgrade your 4th quarter growth forecast to 4%. What landing?
Well, we haven't seen much of a landing yet. There's been a lot of dynamism in the U.S. economy, spurred on, I think, by the continued reopening effects, which I think we see a little bit of that in the labor market data, in the sense that we're seeing leisure and hospitality continuing to lead the job gains. So there's a lot of dynamism. Real incomes are higher as inflation falls. Consumers have more spending power, so they've been taking advantage of that. And the third quarter in particular saw a lot of one-off effects. So we talk a little bit about the concerts and the movies that help to bolster consumption in the third quarter. And so those are factors that I think have led us to the point we are now.
So what happens next, Sophia? Great to see you, by the way, and thank you for joining us. So what does the fourth quarter look like off that really solid third quarter?
Well, the growth that we've seen in the third quarter is going to be hard to sustain. So we're looking at 4% GDP annualized in the third quarter. A lot of that is because of consumption. Consumption's running at double its trend pace in the third quarter. As you might imagine, it's hard for consumers to keep up that pace. So we look for a bit of a give back in the fourth quarter. The economy's going to hit a little bit of a speed bump, if you will. But we think that there's enough forward momentum that we'll get to the other side without a recession.
So does that mean we're at peak yields for the Fed, or are we at peak yields for the bond market? Like, is that my inference?
So the way we look at it, inflation is starting to make a lot more downward progress. And I think another important aspect from the jobs report today is that we're seeing wages moderate, and we're also seeing supply come back into the labor market. The unemployment rate held at 3.8%. So you're seeing some better balance in some of the wages and price metrics. So our sense is that this will keep the Fed on the sidelines. Policy is quite restrictive already, and the bond market's doing a little bit of the work for the Fed. So it will give the Fed an opportunity maybe to stay on the sidelines and see how things develop. Because once you start getting to 1% growth, which we project in the fourth quarter, you're at stall speed, and any kind of unexpected risk, any unexpected development can push you a bit lower. So there are some heightened risks to slowing growth.
Yep. Sophia, from the Fed's perspective, where is too far for the bond market? Feels like the bond market's caught up to the Fed, and there's a danger now that the bond market goes further than the Fed, and that will worry the Fed, to your point about what is happening in the fourth quarter and the potential for sort of hitting stall speed. When do you think the Fed will be worried that the bond market is doing too much?
Well, I think we're starting to get some sense that for at least some FOMC members that we're at that point already. So the comments yesterday from San Francisco Fed President Mary Daly were quite interesting, talking about how we've seen tighter financial market conditions amplify the Fed's tight monetary policy. And so I look back on it and think that, the Fed raised rates in July, and since then they have not raised short-term rates. But since the end of July, we've seen long-end yields rise 100 basis points.
Yeah.
So that's a significant amount of tightening, and the Fed, I think, has the luxury to wait and see how things develop. There's no urgency, I think, for them.
One of the results of today's blowout number, though, is pushing out cuts in 2024. We've already sort of priced out 2. That sort of goes with what the dot plot was saying. We'll see 2 cuts next year. What do you think?
So I think that that's fair, because we are coming in with a stronger growth momentum than maybe many people anticipated. So if your starting point is stronger, you probably have to reduce the probability of expected rate cuts over the horizon. But we also need to see the trajectory for inflation. And next week is going to be very important as well with the CPI data. And what we've continued to see is downward trend in CPI. That is much more in line with the Fed's target of price stability. So a lot depends not just on growth, but also on inflation, and we just have to wait for more pieces of the puzzle to come in.
The degree of uncertainty at the moment, Sophia, must be absolutely enormous if you're an economist. Trying to figure out what is happening here, very difficult. The speed of the move has been very fast. But there's all kinds of other factors we've got to throw in as well. We've got strikes. We've got uncertainty in Washington, D.C. about what's going to be happening with the government. How easy at the moment is it to get a handle on what is happening and to make an accurate call on what that fourth quarter number is going to look like, given all this uncertainty? What's the kind of, if you were to do a fan chart for your calls in the fourth quarter, how wide do you think it would be?
So if that fan chart probably has a little bit more of a downward skew as far as I see it. And I think part of that is the potential for a government shutdown when the current funding runs out on November 17. That's the Friday before Thanksgiving. Congress sometimes has a hard time motivating and doing things around the holidays. And an extended shutdown, I think, could be a downside risk for the economy, not just through activity, but also through sentiment, because it reinforces this concern about dysfunction on Capitol Hill. So there are downside risks, and we need to be very aware of them. As an economist, you kind of keep a scorecard, you watch the data as they come in, and you try to think as best you can about what today's situation means for tomorrow and the next day.
Yeah, and that's what some people are talking about, that you're just going to have a higher for longer level of yields because you have to bake in things like a deficit and term premium and all of that. When you take a look at the market, and when the market moves, right, stronger dollar, dollar yen, you're looking at a mixed equity market now, you're looking at the rise in yields. What makes the least sense to you right now?
That's a difficult question. What makes the least sense? Look, I think that the markets are contending with this idea that the Fed is going to be higher for longer. And while the Fed told us higher for longer in the past, they were not so specific on what they meant. So in July, higher for longer meant they could still cut interest rates 100 basis points in 2024. And at the September meeting, higher for longer meant higher for longer on a 5% handle. So I think that these are some of the things that are creating bond market volatility and raising some uncertainty about how the pass-through from higher rates will be to the real economy.
In terms of kind of what comes next, do you think the focus should be in the United States, or do you think it should be elsewhere? The global economy is interlinked, and what is happening in the US is having a big impact elsewhere. Over here in Europe, the economic outlook doesn't look as rosy as it does in the United States. The labor market certainly doesn't look as strong, yet Europe is being impacted by the higher rates that we're seeing in the United States. How are you thinking about the global feedback loop? If Europe has these higher rates and slows down dramatically, how does that work back into the US economy?
So there are feedback loops through our financial markets. And what's been interesting to me is that the backup in yields in the United States has been mirrored in global economies. And as you say, perhaps the outlook in Europe doesn't justify the rise in interest rates that we're seeing, but they're getting dragged along by the US. Same thing for emerging markets. Many of these central banks are already on interest rate cutting cycles. And the move we've seen in US rates has been spilling over there and pushing up expectations for higher rates. So what we're seeing really is that the financial conditions in the US, be it through higher interest rates or a stronger dollar, are starting to impact other economies. And if it's persistent, it could be a factor that slows global growth.
Yeah, this is all for Guy to say that he was right. It's our yields, his problem. I get it, Guy, I get it. All right, Sophia, thanks a lot. We really appreciate it. Sophia Drossos of Point 72. Thank you so much. We appreciate it. Definitely come back. Coming up, all right, let's get excited. It is a huge, huge deal in big oil. Exxon is in talks to buy Pioneer Natural Resources. This will be the oil giant's biggest takeover in 20 years. We're going to get the details with Paul Sankey, lead analyst at Sankey Research. He's always got opinions. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The top names in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So you're not selling the Patriots, you're not selling the packaging company. I guess you don't like to sell things, right?
I really don't. We try to create a family environment in everything we're involved in. People want to be part of something that's bigger than themselves.
All right, time now for ETF Friday. We've been focused on the extreme pressure facing bond markets, right? You get the 30-year yield surging nearly 70 basis points since the end of August, and that sends ETF investors into a frenzy trying to trade this new rate environment guide. Check this out. As a result, the TLT, that's a fund that tracks bonds on the long end of the curve, has seen volume surge. Trading activity apparently hit a record last week and is on pace to top that level again this week. I don't know. No surprise on my end.
The TLT's been boring for years. This has been the most boring product out there for very good reason. Basically, since the GFC, nothing has happened. Now everything has happened. This is like the epicenter of the action.
Yeah.
And it's amazing. The amount of money that's been pulled out of this thing is eye-watering.
Yeah, no, exactly. And you have to wonder, too, if this helps pick up volatility as well, and if that volatility kind of moves to other areas of the market. Here's one area I'm looking at when it comes to volatility: oil. Energy space. But that's not, they had a huge drop for barely a lot of reason on a headline level for oil over the last couple days. And then we get possible news today that Exxon could be buying Pioneer Natural Resources, the largest takeover for Exxon in over 2 decades. It would be something along the lines of about $60 billion. Joining us now with some insight is Paul Sankey, Sankey Research lead analyst. Hey, Paul, always good to see you. So this is what I think the first time I see this headline. Back in 2010, Exxon buys XTO Energy. That was basically the top in natural gas. Gas prices sank after that, and it has literally been labeled, this is how you don't do M&A. Then you get 13 years later, you get this deal. That tells me, are we at peak Permian? What do you think?
Well, there's definitely a risk. I mean, I thought, the old question, which it was, when ConocoPhillips bought Burlington the day before the all-time high in U.S. natural gas prices, the question was, why didn't you wait until March? Wait until after winter, because obviously if winter comes in warm, we could be looking at a lot lower oil prices by March. And yeah, I think that the driver of the deal is clearly that Scott Sheffield, CEO of Pioneer, is retiring, and therefore they put the hurry-up offense on. As you mentioned with volatility, I would think they were negotiating this deal when oil was 75. It went to 95, and now it's at 85. I mean, that's the problem. We assume for that reason it's an all-stock deal for Exxon.
So this is just an exit strategy. Is that the right way of thinking about it?
Yep.
Yep, no,
okay.
Good answer.
If that's the case, no, fairly straightforward. If that's the case, what is the danger that Exxon is going to overpay? And what would overpaying look like, do you think, in this kind of market?
Yeah, well, it's, normally we take Wall Street Journal stories to the bank. We assume that that due diligence means that the deal will happen, but we don't have any details. I mean, we know it's a $60 billion, we assume EV deal, but we don't know where the debt lies. I said it's for sure a stock deal. We actually don't know that for sure. So there's a number of major uncertainties here. And as I said, the story actually hedges itself by saying this might not happen.
Of course,
but it's been widely anticipated, and we know that with Scott Sheffield retiring, there's a good chance it will. What does it mean for the sector? It might be negative for a couple of stocks like Oxy, where there was a hope they would be taken out perhaps by Exxon. But broadly speaking, we're not seeing deals here at huge premiums, and if it's an EV deal, this is only a 7% or so premium to a stock price that's been under a lot of pressure. It's been part of a pattern here, which is sort of depressing for oil investors, which is you're not getting the blowout. Exxon's lost its mind, it's paying a 25% premium. It doesn't look like it'll be that deal.
Well, that's such a good point, Paul, because if you look at, say, the XOP versus Pioneer's underperformed, and part of what's really worried analysts was lack of productivity. So basically, the super cool, awesome stuff in the Permian's been drilled, and so productivity goes down. Then you have to drill longer laterals, so we're now at like 3 miles in order to get more oil out. That comes with risk. Is this a sign that like Permian has peaked, and now it's going to be that much harder and more expensive to get the other stuff out?
That's debatable. It depends on your oil price assumption.
Fair enough.
The Permian's a zero if oil's 20. But the potential for us to have sustained higher oil prices because the Permian is peaking is very real, because as you know, this has been the marginal growth driver of global oil supply for the past decade. So it's hugely important when it rolls. And the oil rig count suggests that it will. The other thing that obviously is hugely important is you're consolidating the sector. Look at the refining sector. You consolidated it, and you ended up short U.S. refining capacity. You consolidate U.S. E&P, eventually you're going to stop all the model, which is you grow, and then you sell it to Exxon. As that plays out, you have a highly consolidated sector, and you have much higher returns. That's what happened with refining over the past decade. I think it's what will happen with big E&P in the US over the next 10 years too, is that now that you're consolidated, they'll drive very high returns.
Paul, why is oil down so much over the last week, and will it continue to fall?
Well, we always think of Saudi cuts as bearish. It's a bad sign if Saudi's cutting, so they can crank the oil price up. But why are they cutting? We want Saudi at max with strong demand. For Saudi to be cutting into weak demand is fundamentally bearish. So they took a market where speculative interest was low. They drove it to 95. You saw a pretty direct response in US gasoline consumption, which also fell seasonally. And the gasoline crack just collapsed because you pushed up the crude price, and you're seeing weak gasoline markets. And as a result, essentially, you're going to shut down refining, which is going to be bad news for the Saudis. So my view on the cut was that it might work for 6 months, but it might cause you a major problem in mid-2024 when the market's very weak and you have to decide whether you're going to really seriously cut more or you're going to crank up and go for oil market share.
Hey, Paul, can you make money right now investing in oil stocks? How hard is it?
Well, you can on the short side.
Okay, fair enough.
You've had some stocks hitting 52-week lows, which is normally a very bad sign. I think that the market will stay fairly lively just because of distillate tightness globally into winter. You're seeing natural gas acting well, so we like U.S. natural gas plays. We think that's a long term. There's things that we love secularly long term. One actually, funnily enough, is U.S. refining, but another is obviously these Marcellus plays, our EQT, our Range, are great long term stories. And the consolidated remnant, that is the Exxons and the Chevrons, I think will do very, very well over the next decade. So it depends on your timing. If you want to make money now, I'd basically be on the short side. But we're always looking over time to actually view this sector as fundamentally undervalued by the market because of the importance of oil to the global economy, and I think that'll remain the case for the next 10 years.
If you were thinking about that was quite the answer. No, I will go away and watch that back and figure out all the little bits and pieces that I need to take away from that. There is definitely some positives in there. Paul, but if you think more broadly about what is happening here, are we setting ourselves up for a fight between the market and the Saudis? How low do we go before the Saudis react again? Is the market prepared to go toe-to-toe with the Saudis here? And if they do, if the traders do, what does that look like?
Well, I think the first thing is the administration, despite their rhetoric about the green agenda, clearly want lower oil prices. Particularly, it becomes a bigger and bigger issue as we hit election year next year. So they're fighting for lower oil prices. What did they do? Last year, they downloaded 1 million barrels a day of the SPR. Basically sold it direct to China, which built inventory, by the way, but whatever. This year, they can't really redo the SPR. It would be, I think, a little bit dangerous at this point. But what they are doing is they're turning a blind eye to Venezuela or actively encouraging a democratic process in Venezuela to be positive. You've got them selling turning a blind eye to Iranian oil coming out, which is really upsetting to the Saudis in terms of market share, obviously. And then, of course, you're turning a blind eye to Russia. So the administration has basically looked away at all the additional incremental supply, and all of that is taking Saudi market share. So I think that Saudi's between a rock and a hard place here, and I think they might end up having to go for market share and crash the market. I really do.
Yeesh.
Wow, okay. That will be something to watch. That would certainly have an impact on all the other data in a fairly big way as well. Paul, great to see you, great to catch up. Thanks for the insight as ever. Paul Sankey of Sankey Research. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Quick look at the price action. European stocks bouncing around all over the place since the close, into the close, out of the payrolls. Up, down, up, down. On the week, we are lower in terms of today's price action. Actually, reasonably resilient, you could argue. Euro dollar is down, but it's been down more this week. I think that's a really interesting point. Similar story with what's been happening with gilts as well. Yeah, we're seeing yields higher, but again, in some ways, a much more muted reaction than you would have anticipated to the payroll number. Jerry Fowler's going to join us from UBS. He's going to try and answer all these questions. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Friday the 6th of October, stocks are higher, and they're not convincingly higher, but they are higher. And given the blowout payroll number, I find that in some ways a little bit surprising. This is a very strong economy in the United States, which in theory should move to higher yield, which should in theory be bad for stocks. Doesn't feel like it's working out that way. Yes, we're down on the week. Maybe that's what we should be talking about. Anyway, that's the picture. Countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Okay, look at this board and tell me if we just got a massive, almighty blowout payroll number. Because you look at these numbers and you're thinking, nah, end of the week, nothing really to see here. We can move along until next week. We just got a huge, huge print out of the United States. This is a big piece of data, and it was massive. And the market in so many ways has shrugged its shoulders. Maybe we've already had the move. That's what we're seeing here. Maybe we're going into the weekend. Maybe we're thinking about the CPI data next week. But the stock 600 is up by 0.5%. We're trading 443. The pound is barely budging, 121.89 against the dollar. German yields are a little higher, but we've been north of 3 this week. We're not there yet. We're at 2.909. So you look at this board, and I don't see, Alex, a big blowout payroll number. But that's what we got.
I mean, same deal here in the U.S. with the exception of the bond market. So just look at this one, 10-year yield up 9 basis points. The 30-year made a run for 5%. All of that feels very dramatic. But then nothing else at the same time. Like in the middle of the week, the S&P, we were talking about the 200-day moving average. I mean, like 26 points away from that. We are well off that level now. We're just down by 0.1%. Now, part of the reason why that index is actually doing well is Pioneer Natural Resources. The stock is up 10%. The best performing stock within the S&P. That's on takeover rumors between Exxon and Pioneer. Now, even the Bloomberg Dollar Index, we got an initial pop higher for the Bloomberg Dollar Index, dollar yen again making a run for 150, and then we kind of paired some of that. Now the currency is a little bit mixed, just up 0.2%, Guy.
Yeah, but it's not. This was the number we've been waiting for a week. This was going to be the huge moment. And I'm not entirely convinced that the market is taking it that way, which is a little disappointing on a Friday. We were expecting kind of fireworks this afternoon. We're not in some ways guessing them. We are, after all, in the volatility business. German 10-year, here you go. Here's the 5-day. Wednesday, we get to 3%. We go through 3%. We fade that pretty quickly. And as you can see, we have seen that's the pickup there on the payroll number. That's Wednesday. Now, there's all kinds of other things going on earlier in the week, but that's the pickup off what I can only say was a massive move on the data that we've seen, Alex. but maybe the market's already kind of through that and is already thinking that it's priced this. I don't know. I'm a little confused.
Yep. I don't know either, and that's why we're not the experts. Good sign. Sophia Drosos is Point72 economist and strategist. We talked to her earlier about the hot payrolls number and what it means for the Fed and what it means for growth.
Inflation is starting to make a lot more downward progress. And I think another important aspect from the jobs report today is that we're seeing wages moderate, and we're also seeing supply come back into the labor market. So it will give the Fed an opportunity maybe to stay on the sidelines and see how things develop.
Yeah. Wait, watch, see what happens. But at the moment, this is an economy that feels like it's riding pretty high. She's just upgraded her third quarter GDP forecast really quite significantly, Sophia. Fourth quarter, yeah, we're going to hit a bit of a speed bump, but maybe we get through that, maybe we don't get a significant recession. And that takes us to our question of the day. What landing? Joining us now to discuss, Eddie van der Volt from our MLive team, Ira Jersey of Bloomberg Intelligence. Eddie, you're standing next to me. What landing?
Well, I have to say, to me, this is what a soft landing looks like, right?
Okay.
This is what we're seeing here, what we got from the jobs number, first of all. We got a hot reading saying, the economy is growing strong. At the same time, you've got inflation coming off, wage inflation coming off a little bit, and you've still got some room in the participation rate for more workers coming back. Therefore, what do you see? You see yields having to build in a steeper yield curve via the back end. You see bears steepening, and you see the stock market saying, well, we can cope with that because the economy is strong. People are going to keep buying, people are in jobs. To me, this is the perfect reaction. I think the initial reaction was what you would expect: hot reading, high inflation, maybe, or Fed that's going to hike, and therefore you see the equity market pull back. But I think people are looking at it now and saying, no, this is actually really exactly what the Fed is aiming for.
Hey, Ira, I mean, the bond market's still selling off. Do you agree with what Eddie was just saying?
Yeah, Alex, we've talked about this. If the Federal Reserve doesn't cut interest rates in 2024, which is actually our base case scenario here at the Bloomberg Intelligence Rates team, then the bond market needs to be much flatter. And in particular, what is the interesting trade to me that's not happening is that you don't really see the 5-year sector selling off more than the rest of the curve, because that's really the adjustment that has to take place if the Fed's on hold for even longer than we think, which you keep on getting data like this, and you have to keep on pushing out when you think the Fed might actually have to cut rates, and that's no time soon, at least based on this data.
It was interesting, actually. I think the kind of the biggest moves initially did come in the 5-year, but as you say, that has since subsequently, that move has retreated. Are we at the point where the Fed and the market are now aligned? Have rates come up far enough to kind of align themselves with what the Fed is thinking? And if rates go further from here, do you think the Fed will be worried?
Well, I think we were at what the Fed was thinking if you just take the dot plot as gospel, which of course you can't, but if it were, then 10-year yields should be probably about 40 basis points lower. So basically where we were 2 weeks ago is about fair value based on what the Fed thought. So the market's basically saying that, hey, the Fed's going to have to shift their opinion, in particular because the data has been much stronger than just about everyone has suspected. I mean, you look at the jobs numbers today. You guys have pointed this out on Bloomberg TV all morning, that almost 100,000 above even the most optimistic estimate, right? So I think as the economy changes, the market is going to instantaneously shift what it thinks the Fed's ultimately going to do.
Eddie, Citi overnight, before the number, upgraded their call on global stocks to a buy, saying like, look, we have balanced macroeconomic risks, like buying dips, like cyclicals. Does this data make sense to you with that call?
Look, I think so. I think unless you are seeing some sort of major correction brought on by a higher yields, which triggers then, which triggers an event in which the Fed has to cut, which is then a bull steepening and a very different scenario. And that's the sort of steepening that markets are used to trading. So it's not a surprise that people are pivoting that way. But, in this environment, as long as the economy remains strong, then it makes sense. Why not go for the NASDAQ? Why not go for the speculative stocks? I will say, though, that we're inverted on the 2s, 10s by about 27 basis points at the moment, right? The next 27 seems easy. It's what comes after that.
Yeah.
How much of curve uninversion do we get beyond that? Because it could be significant, and if that goes much, much further, that could start to, I think not a lot of people know just how much higher 10-year yields have to go.
And over here in Europe, we're looking at this, scratching our heads, wondering what's going to happen next. The Fed in the past has had to react to global events. It is theoretically the central bank of the United States, but in the past, events have come in and forced the Fed to react from outside of the United States. Are we setting ourselves up for that scenario again? We're sitting here in Europe. The economic data is not very good. Many parts of the emerging markets are already seeing cuts coming through, yet yields are going higher. We talked about this earlier. They are their yields over there in the United States, but is it our problem? And is that where the problem is going to start?
And then exported back to the US, and this circular. It's possible, right? The PMIs in Europe still look like a stagflationary economy, right? It looks like the PMI numbers are still very, very weak. It shows that there isn't growth, but they do appear to be bottoming out.
But that was before this kind of that's before this kind of big rise in the cost of capital came through once again, exported by the United States.
Yeah, and it is a problem for Europe, and I think that will remain a problem for Europe. I think the US is fairly immune to contagion risk unless there's some sort of banking crisis again, right? And we had that earlier in the year, but I don't see that with higher, steeper yield curves. I just don't think that's a problem for the banks.
Hey, Ira, game this out for me on the short term. What if we get a hot CPI on Friday? What happens?
Yeah, then I do think that we could have even more of a flat yield curve. So I do think that there's a limit. Just talking about the curve discussion a little bit, I think there's a limit to how steep the curve can get in a bear market. So with 5.1% is more or less the yield on the 2-year note. If the Fed is on hold for the next 18 months, then it's going to be difficult for 10-year yields probably to get above that level. So you could have a pancaked yield curve. But eventually the next big steepening of the curve probably has to come more from a significant bull steepening, so 2-year yields being much lower in anticipation that the Fed's going to cut. But a hot CPI number, we can get to a pancaked yield curve in a hurry. That could be one trade right after we get a pretty hot, like a 0.4, 0.5 on CPI next week.
Yeah. Very gappy markets, as you say, you could move very quickly to that. And as you've said to me already this week, then you maybe stabilize. Ira, what's the relationship with oil going to look like over the next few weeks? Oil has come down really sharply this week. And I'm wondering if that sticks and persists, what impact that's going to have back into bonds.
Well, it has some effect because of the expectation, again, of inflation and how it affects inflation expectations. But keep in mind, most of this move, in fact, all of this move, has not come from the inflation expectation side of the rates markets. It's really come from real yields going up, people thinking the economy is going to be a little bit hotter. That means that things like R-star that we always talk about is probably even a little bit higher than we had suspected it was just a few weeks ago. So it's really the real yield move here that is quite dramatic. And we're talking about 5-year real yields potentially hitting 3%, which we have not seen since it's been almost 20 years since we've seen that type of level on short-term real yields.
Yeah, it's such a good point. We keep forgetting that it's not inflation break-evens that are moving it higher. Hey, Ira, thank you so much. Ira Jersey of Bloomberg Intelligence, and Eddie Vandervalt, always a pleasure to see you as well from our MLive team. Coming up, we're going to get more insight into the question of the day, what landing? Jerry Fowler, UBS head of European Equity Strategy, joins us next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at BloombergLive.com/screentime.
I think we're still likely to see a mild recession at some point next year, probably going into mid-year, maybe first half. And I think that because we are going to see the Fed, as it's been trying to get the market to believe for a year, now they finally believe it, they're going to have to hold rates higher for longer. And so this tightening pressure is going to remain and feed through to the economy, consumers and businesses.
Fantastic. Rebecca Patterson, Bridgewater's former chief investment strategist, speaking to Alex and I in the last hour, taking us back to our question of the day. After that payroll data, do we need to be asking what landing? Joining us now, Jerry Fowler, UBS head of European equity strategy. If you're a European equity strategist and you're looking at the United States and you're looking at the data that's coming out of the United States, how do you answer the question about kind of the US having no landing and the European economy maybe having a landing? How does that kind of manifest itself in your world, Jerry?
So there's definitely been some divergences. It's been a little bit of a surprise how weak the European economy has been, both in terms of the economic surprise through the second quarter, some of the retail sales data we've seen with the August data just coming out and surprising to the downside, but also just very much in the surveys, the PMIs, and we're not just talking about the headline PMI for manufacturing and services. The new orders are disastrous. And probably the most interesting thing at the moment is that the backlog of work, particularly in industrial sectors, seems to be deteriorating pretty rapidly in Europe. So it is surprising that Europe is looking remarkably weak in contrast to the, I wouldn't necessarily say acceleration in the US, but the resilience that we're seeing in the US. It's certainly a marked contrast.
Jerry, we were talking to Max Kettner of HSBC earlier in the week, and he was just saying, yeah, I get all the bad news, but that means that growth expectations are so low, earnings estimates are so low, that the bar to beat is really low. Does that hold any water for you?
Not really, because if we're talking about Europe, it does feel a lot like the expectations are actually still pretty inflated. I mean, you've still got earnings expectations and particularly margin expectations that are near record highs. And we've got a very good chart that looks at nominal GDP and its growth rate through time. And it's very clear that when you get decelerations in growth, and that applies whether it's a demand-driven weakness in growth, weakness, or whether it's disinflation, which is more the driver at the moment, in both cases you get margin contraction. And so why we aren't seeing more analysts take an axe to their margin expectations is a bit of a surprise to me. And margins are going to be far more important in 2024 if they normalize versus what's happening to revenue. Very easy to have a soft landing in revenue, especially when you've still got elevated inflation. But it's also very easy if margins come down for that to still be a very hard landing in earnings. Our macro model would actually suggest that 2024 earnings for the European market are going to be minus 17% if we're right on our margin view.
Wow.
Okay, so walk me through what that's going to look like in the upcoming earnings season. How out of touch do you think most of the street is?
So it's all pretty imminent, I think, and we're starting to see it play out in that Q1 was a bit of a surprise in Europe. Lots of companies beating. About 80% of companies beat expectations because winter wasn't as bad. Q2 was roughly the same number of beats versus misses, and that was in a in an economy where economic surprise was significantly negative, but that was from inflated expectations. But all through Q3, the data in Europe has looked weak, and importantly, big sectors like the mining sector, the auto sector, and particularly the capital goods sector, are starting to report in their PMIs that they're running out of work. The new orders have been weak for a long time, and now they're reporting that their backlog of work is also weakening. And Alstom is a great example of this. You get a big share price reaction when a company comes out and says, we aren't doing as much work as we thought, our cash flows significantly deteriorated, and whack, the shares will get hit. I expect that in this season we will see more of that from more of the cyclical sectors in Europe, just by the way they're reporting in their PMIs and what we've seen in some of the economic data that will really, not necessarily hurt their revenues to any great extent, but potentially be quite consequential for their pricing power and their margins.
Jerry, what gets hit the hardest? And I know you mentioned cyclicals and Alstom, and that's a great example, but are there other sectors that are going to get hit just as hard, or is it really this manufacturing cyclical story that worries you the most?
Yeah, it definitely still is. So if you look across the services sectors, they have been weakening, but nonetheless, they're weakening from a very high level, and they're starting to look like they're troughing at more normal levels. They don't look like they're continuing to decelerate and weaken dramatically down in the same way that manufacturing and goods have. But nonetheless, I think the broad market will suffer in various ways because there are three things we're worried about. One is yields. And so far, that's the dominant factor driving markets in Europe. In fact, pretty much all of European performance between sectors and stocks can be put down to the significant shift in the yield environment. That's really impacted valuations, probably hasn't impacted them enough yet. We actually think the European market is now 5 to 10% overvalued because it hasn't reacted enough to yields. But after yields, you then need to think about margins. So we've been talking about that. Obviously, cyclicals are going to be hurt most on that front. But then also, because we're getting more correlation between stocks, volatility is going to have a consequence as well. And high valuations don't like volatility. So things like consumer durables, the luxury sector that is, semiconductor equipment, some of these higher valuation sectors that are suffering from crowding as well as some earnings risks are still the most vulnerable to us alongside those industrial cyclicals in the capex space.
Jerry, I'm now looking for a place to hide. Given what you just told me, where is there such a place?
Well, I must admit, we didn't predict this yield move to be as dramatic and as quick as it's been. So we did think it was going to be defensives along the lines of utilities, cheap defensives that are just quite resilient both to volatility. That's been a very tough call this week, mainly because we were mostly focused on profits and volatility being the key drivers, but actually yield so far has been the dominant driver. But nonetheless, I think you need to look for defensive value. It's just that within defensive value, it's reasonably hard to also avoid duration. This yield sensitivity has been consequential. Now, we view yields as likely peaking at this point because we have a negative outlook for profits. We think that weakness in employment will follow. So we think we are heading into a fairly normal business cycle, and the yield move we've seen is actually more technical, relating to the Fed basically saying they're going to keep real yields higher for longer. A real technicality is that there's more risk premia in long-term bonds now. The term premia has risen, and that has consequences for equities and equity valuations that are reasonably permanent. But to some extent, if the move has happened, it could be a one-off. That term premium is now back to its 20-year average, so it could go higher. But at least we've washed out what has been a historically low level of term premium in interest rates.
Okay, Jerry, with a not very happy, optimistic short-term view on equities. Thanks for that. Jerry Fowler of UBS, thanks a lot. This is Bloomberg.
enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
All right, here's one story that I'm watching. Okay, you got Walmart. Shares are down the most in more than 7 weeks, guide. So yesterday, the company said Ozempic is hitting shopping demand, and you can see it reflected in Europe also. You got chocolate and booze manufacturers are saying that they're suffering. You got Danone, for example, Lindt, Anheuser-Busch, InBev, Unilever, that makes Ben & Jerry's ice cream. They're all sliding today as well. So we know the story, right? I mean, if you take this drug and it suppresses your appetite and your thirst for alcohol, but I don't know. Are we getting like way ahead of ourselves as to like the long-term impact of this?
I think maybe, but it's a fun exercise to work your way through what impact it could have. And in some ways, you look at Nestle today. Nestle under significant pressure. Nestle has been trying to move away from the unhealthy to the healthier stuff, so maybe it doesn't get hit quite as hard. But yeah, you could see a reaction in all of this. I guess the market is meant to be a forward discounting mechanism. Maybe it's meant to do exactly what it's doing right now and think about the impact that potentially all of this could have. But in some ways as well, this is a yield move. In some ways, this is an area where you would have thought you'd see some more sort of defensive strategies coming in and buying some of these stocks. But I think it's fascinating. Lindt & Sprungli down as much as it is right now. That's high-end chocolate. If you're going to eat chocolate, maybe you want to eat high-end chocolate. That would be my strategy.
Well, also, we talk about it as like junk food is what's going to be cut, but I mean that might not be true. You're also just eating smaller portions in general, so it could hit sort of all the main players. But to your point too, like inflation's still high. That's still going to bite into the bottom line for these guys and the top line. So maybe that's there too. I don't know.
Yeah. And in some ways, they're yield proxies. These are big cash generative companies, and in some ways therefore they compete with the bond market. You've seen what's happening in the bond market. Right. But it's interesting as well, maybe you eat better, maybe you make more discerning choices. I don't know. I don't know how this is going to play out, but it's quite a fun exercise to work your way through it. Is that Lindt & Sprungli
No,
chocolate?
it's Nestle, but I still want it.
Is that Nestle?
Yeah.
Verve. Not Bahnhofstrasse. I can't remember where it is on Bahnhofstrasse in Zurich. Some very nice chocolate to be had. Quick look at European equities. We're coming into the close. Let's show you what is happening here as the camera follows me around. Here are some of those names. There's Remy. There's Nestle. These are 52-week lows that we're seeing. There's the utilities that Jerry Fowler was just mentioning. RVA down by 1.21%. There's Alstom that Jerry Fowler was just mentioning. That is the worst performing stock this week. I think it's down circa 40%. It's been a brutal week for European equities. We'll deal with the close next. This is Bloomberg.
almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
If you'd have told me 20 seconds after the payroll number dropped that we would see a positive equity market today, I may have questioned that. But that's what we're getting. It's fascinating to see how things have turned around quite so quickly. In some ways, you could argue a solid consumer in the United States bodes well for corporate stocks. And maybe that's what we're seeing ultimately being priced here. It's fascinating, though. We are still down on the week. Let's not kind of make bones about that. This is the picture we have today. But the week, let me show you the week. It's been a fairly bumpy ride. And actually, the losses came fairly early on. And we've been kind of bumping along the bottom since then. So this is the 5-day picture. We're down by around 1.2% on the stock 600. But as I say, the losses came early on. And since then, we've been kind of cruising sideways, waiting for the catalyst. I thought that may be today. I thought that may be the payroll number. It's proved not to be. Maybe it's the CPI number next week out of the United States. The yield story is interesting as well today. This has been a story this week of higher and higher yields being generated out of the United States and then exported to the rest of the world. You can see that in Germany, where we earlier on this week hit 3%, but we've backed off it. Today, we go up, but not that much. Similar story with gilts. 458. As you can see, yields higher, but not massively today. The moves came earlier on in the week. Euro dollar is now back to being positive. The dollar is down. We're at 105.90. We're up by 0.4%. Honestly, if you looked at this board and said, have we just had a blowout number in terms of the payroll number, I think you'd be maybe questioning that. Single stocks are fascinating again. Novo Nordisk is a continuing theme running through this market. Ozempic, these weight loss drugs, having a big effect on some big stocks. Nestle, 52-week low. That stock is down by 2.5%. You can see it across the packaged goods stocks. We've just been talking about it. The big loser this week, though, has been the utility sector, which has been absolutely smashed lower. But that's a more direct bond proxy. Kind of makes more sense in some ways. Novo Nordisk, though, up by 1.5%. Can they keep up with demand? What's pricing going to look like? So many questions surrounding that story. But the big loser this week, today it's down by 0.6%, has been Alstom. But Jerry Fowler was mentioning it from UBS. This is a industrial company out of Europe that has had to come through this week and kind of admit to the challenges that it is facing, and they are significant. And the stock has been brutalized by the market. Will others follow? Is that going to be the narrative coming out of this earnings season? Okay, that's this week. Let's talk about next week. The Labour Party conference is going to be absolutely fascinating. This is in some ways a government in waiting. If you look at the polls right now, the Labour Party looks like it could form the next government, but we're still a year out from the election. Are we actually going to see some details being added to the policy mix that we've been seeing unveiled? This week as well, next week as well, we're going to get some fascinating numbers. Tuesday, LVMH, sales and revenue. What is happening there? These are stocks that have been battered. partly on the slowdown in the United States, partly now the slowdown in Europe, but of course the story out of China as well. German CPI, I think that's the final number, and then we're going to get some great coverage out of the IMF 2023 annual meeting. That picks up Wednesday, goes through to Friday. But Alex, from a UK perspective, I think getting some more detail, getting a bit of a greater sense of certainty surrounding the policy formulation that the Labour Party is going to push forward, if it were to become the next government, I think will be a really crucial moment for the UK and for international investors and their perspective of the UK.
Sure. I mean, it feels like we're inching towards a Labour Party government, right? So if that's the case, what does that mean? So going to look at the conference, I want to set the scene on this because this morning the Labour Party won by a by-election in Scotland, a large swing from the ruling Scottish National Party, a major boost for the opposition party that could be on track to win that next general election, which could be next year. Joining us now is Harry Quilter-Pinner, a director of research and engagement at IPPR, a left-of-center think tank. All right, Harry, I'm sitting here in the middle of New York City. I'm obsessed with politics here in the U.S. Tell me what I should care about next week, the Labour Party conference.
Well, I think you're right to say that the Labour Party will be going into the conference in a buoyant mood. They are well ahead in the polls. As you say, they've just won this seat back in Scotland, which is a real sign that they could get a majority. It's very hard to get a majority without Scotland. And so they're going to feel very optimistic. But I think there's still quite a big challenge facing them. I think the country are definitely fed up with the government. I think there's a mood for change, but I think the electorate are yet to fall in love with the Labour Party. So I think there's a lot of work to do to set out a vision that really excites people and shows that there's a more positive future.
Harry, when does that moment come? We're a year out potentially from an election. Is it still too early for the Labour Party to start detailing policy that the rest of the world wants to know about, but maybe it's a little too early to start kind of laying out? Because the Conservative Party's got a recent history of picking up on some of those policies and making them theirs.
Yeah, so I think what you'll see is the Labour Party being quite risk-averse, quite concerned about putting out policy detail that, as you say, they might get attacked on. But they've also got to put enough out there, both to convince voters, but also to convince businesses, industry, that they've got a plan for growth and a plan for the future of the country. So what I think you're starting to see is the outlines of policy. Mm-hmm. So they've set, for example, fiscal rules. They've set ambitions on climate investment, very much looking over the pond at the US and the Inflation Reduction Act. They've set out the kind of parameters of a policy platform. I think we might see some of the details start to filter through in this conference. But then they're not going to want to tie themselves in knots with policies that risk damage ahead of an expected election next year.
I mean, clearly at the Tory party conference, Rishi Sunak was very worried about inflation and not cutting taxes because inflation is high. Like that is definitely the priority. Like growth is there, but it's about inflation. How does the Labour Party tackle inflation if they're going to outlining growth plans and something to compete with the IRA here in the U.S.? That feels all inflationary.
So I think what you're seeing is certainly fiscal prudence being put ahead of that investment. So I think Rachel Reeves has been absolutely clear that investment will only happen if it fits within the fiscal rules that she's set, which is about getting debt and borrowing falling. So certainly they're putting that front and centre. But I think what you'll also see is that investment going into what's called supply-side measures, things that will expand the capacity of the economy on the supply side, which shouldn't in the long run be inflationary, should in fact be deflationary, given that we've got so many supply constraints in our economy. But they're going to be very careful about making sure that they are seen to be economically credible, because we know that historically, one of the things that has prevented the Labour Party winning elections has been the view of the public and of businesses on their economic credibility.
How worried do you think the Labour Party is about the market reaction that they will get? In some ways, we've all learned a lesson from what happened with Liz Truss. What lessons do you think the Labour Party learns from that scenario?
I think the Labour Party have taken the message very strongly that everything needs to be really fiscally credible. There was an intervention a couple of weeks ago where the Labour Party set out plans to really strengthen the remit of the Office for Budget Responsibility, the OBR, which is the kind of fiscal watchdog in the UK. And they were doing that to show that they would take external accountability on their economic plans really seriously. And they were doing that because they know that when the OBR said that Liz Truss's plans weren't credible, the markets took that very seriously. So I think they'll make sure that they are setting out clear plans, that they're creating stability in the financial and fiscal environment, and that they are being held accountable externally to that. But I think we should say really clearly that there is a big difference between an unfunded tax cut, which is what Liz Truss was proposing, and investment in the supply side of the economy, in the green transition, which should in the long run be growth inducing. Yeah. Those are two very different things, and I think the markets get the distinction between the two things.
Right. Sometimes. Sometimes. Maybe it depends on the sector. Hey, Harry, what is Europe going to be watching? How is Europe going to take this? It feels like there have been some movement post-Brexit to establish relationships, right? So what's Europe looking at?
So I think Europe, I think the most important thing here is how big the majority is, if there is a majority. So, I mean, and just to be clear, to get to a majority, even of one, we need a swing bigger than Tony Blair got in 1997 in this country to get a Labour government. So it's a big task for the Labour Party. So that's not at all guaranteed. I think if there's a reasonably big Labour majority, I think Europe will look more positively on the idea that they can do deals with Keir Starmer and the Labour Party on Europe that have some chance of being sustained into the long term. I think if it's a minority government or a very small majority, they'll be very nervous because they will rightly look at it and think, well, we could have a Conservative government or a different government back in power pretty quickly. And at the moment, the Conservatives are still very much anti any moves towards kind of, closer integration. Yep. And so there'll be a lot of nerves if there isn't a Labour majority, which is, as I say, is a massive task and still seems potentially unlikely, I think.
Yeah, big swing in Scotland, though. That was certainly the takeaway from the by-election, but maybe some one-off factors coming into play there. Harry, great stuff. Thank you very much indeed. That was really useful. Harry Coulter-Pinner, Director of Research and Engagement at IPPR. OK, let's check where European equity markets are finished. Who'd have thought it? There you go. Really positive picture emerging after a day when we've seen a blowout payroll number coming out of the United States. The US labour market is strong and continues to be strong. How does that change the narrative for the UAW? Its President Sean Fain will deliver an update on the union strikes that we're seeing against the big three automakers stateside this afternoon. We're going to have the latest on that story. This is Bloomberg.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together? and have those models working for you that you own.
Right.
These models like really talented graduates that occasionally went a bit weird, called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet.
Mm-hmm.
But you can train them yourself, or you can just show them some examples, and they learn very quickly.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
So workers at a Chevron LNG facility down in Australia are planning now to resume the strikes that we've seen on, off. That, of course, threatens to disrupt global supplies. This as the Northern Hemisphere approaches its winter season, Alex. This is not a direct effect. This basically kind of ripples through. This is Asian buyers that largely buy from this facility, but it has a global impact because Europe increasingly relies on shipborne gas. It's interesting. You look at what is happening here. Labour certainly feels like it's got more power. You were listening to the Labour Secretary talking to John Ferrer earlier on, mentioning this very fact. You look at the Labour data we've seen, that must give Labour the view that, increase the Labour view that it can act with relative impunity at the moment. The UAW strike, it's going to be interesting to see what happens a little bit later on.
I also am quite interested as to the industries in which this is happening too, and I appreciate I can't paint it with a broad stroke, but take a look at autos and you take a look at energy, and those are two that are under huge transitions, right? For autos going to EVs, and for big energy, it's going to alternative energy in the future. And so how to allocate capital, how to deal with your workforce, I think is quite interesting.
What about the healthcare sector?
Yeah, that has nothing to do with energy transition. That's just pure labor. I said it wasn't a through line. I just said I think it is interesting. And we were talking earlier about the Labour Party conference that you can have growth and you can have, green energy policies, but they do come at interesting costs that it doesn't feel like anyone was expecting.
Yeah, and the sense seems to be that this can go on much longer.
Yeah.
There was a view maybe, and it's been interesting, the UK government in some ways is falling victim to this as well, that there was an expectation that the labour market would soften, inflation would come down, and that would make it easier to negotiate with the unions. But you're certainly not seeing that in the United States.
Nope. Speaking of, UAW President Sean Fain is speaking right now. He's giving some remarks. We're going to see what happens with talks with Ford, GM, and Stellantis. So for more, let's get into this with Bloomberg Detroit Bureau Chief David Welch. Okay, David, I don't see any headlines. He's speaking right now. We're going to keep you updated on the headlines. But what are you expecting from him today?
Look, I think he will expand the strike or at least maintain it at each of the three companies. You recall back the last couple of weeks, he let Ford off the hook initially, and then he let Stellantis off the hook last time he expanded it. GM has not gotten any reprieve from adding plants to the strike. There are big issues at all three companies. We had Ford CEO Jim Farley publicly saying that he thought the union was using economic issues and dragging their feet on them to get some sort of framework for workers at future battery plants, that is, workers who haven't been hired or organized by the union yet. GM has been bargaining over cost of living and pensions. They don't want to add too much to their costs with that. And Stellantis has this open plant in Belvidere, Illinois, where they haven't allocated any work, and the union's worried about that. So in addition to the pay and the other things that are being bargained, each one has their own separate issue that is a little different from the other companies. And I think they're going to need to probably make progress on those individual issues to avoid having more plants walk out on them.
David, do you think a strong payroll number which we're all talking about today, has any impact, any bearing on how this strike is likely to develop? Because the data are telling us that the labour market is still tight and there is still huge demand for jobs.
Look, I think a tight labor market always gives workers themselves more leverage. This is a case, though, workers in these union jobs, even though they're complaining about pay, they are paid pretty well compared to manufacturing workers in other sectors. So UAW workers aren't getting bad pay, they just don't feel like they've been able to share in the record profits of the companies. But they still would have a difficult time finding that kind of pay if they were to go out and look for other jobs. So, look, it is a tight labor market. I think as we make the transition to electric vehicles and you're hiring workers at battery plants and they make less, it's tougher to keep those workers, so there's going to be pressure on the companies to keep those wages high. GM's already raised wages at its Lordstown, Ohio battery plant by $3 or $4 an hour because they were losing workers. So there is more leverage to the union here, but it's not a make or break thing in this set of negotiations.
We heard from Acting Labor Secretary Julie Sue earlier in the day at Bloomberg Television. She was saying, look, the spread between the companies and the unions is coming down. This is normal. This is kind of what happens. She was speaking at it in sort of like this is a rote process. Is that really true when it comes to what's happening on the ground?
Look, it is getting closer, but there's still existential issues here for the union. And those battery workers, that looms pretty large. These are battery plants the companies plan to build. They've announced, at least 2, 3 of them at each company. GM has 4 of them coming. And I think Ford has an equal number. That's a lot of workers they'll be hiring. Most of those plants are owned by joint ventures with an Asian battery partner, so they're not part of this agreement. And that really irritates the union. They believe that those joint ventures are an end run around the labor contract, and they want to solve that. But legally, they can't bargain on behalf of workers who haven't yet been hired and aren't part of the union. They can get side letters from the companies that set up a framework for how battery workers will be compensated over the next decade. But it's a touchy legal issue. It's a touchy labor issue. Both sides have a strong viewpoint on that. And I think that's one issue that's really going to hold things up here. And pensions is another. The union wants defined pensions back. I don't think they'll get it. I think they will get some nice 401ks. But those are still expensive for the companies if they're going to have a big match or big contributions. So the size of that's another one that's going to be a touchy subject as well.
All right, David, we are watching the headlines. Thanks a lot, David Welch, Bloomberg Detroit Bureau Chief, joining us. And if you want to watch and listen to Sean Payne speak, you can check it out on Live Go. That feed running to you will also bring you those headlines. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Stocks are up, something I didn't think I'd be saying to you at noon when we had that blowout jobs number, and yields are still pushing higher. Abigail is tracking the moves for us. Abigail?
Yeah, this is quite a chart, and I wish I had an explanation for it, but you can see into that jobs report basically flatlining and then down sharply on that hot jobs report that sent yields flying higher, as Alex just mentioned. That, of course, puts valuation into question, liquidity out of the system, nerves that maybe the Fed will have to raise again, and that some sort of a recession could come as a result of the consumer slowing down. All kinds of scenarios, but now take a look at this, up 0.8%. Now, earlier, to be fair, it did feel as though a reversal would be possible, just because it didn't feel like there was so much conviction for the selling. Kind of a brief reprieve, maybe positioning into the weekend. The longer chart suggests that the selling will return, but right now it clearly is not. Now, on the week, though, this is interesting because there is the possibility that we could actually see an up week for the S&P 500. If so, it would be the first up week in 5. The NASDAQ 100 clearly higher on the week, and I think that's actually a second up week for the NASDAQ, or the NASDAQ has been doing better than the S&P 500. And then here are those yields Alex was talking about. I mean, this is incredible. On the week, the 10-year yield up 20 basis points at a 476. The 2-year yield still above 5. When will this selling in bonds abate? Well, it might not be anytime soon. If we take a look at CFTC short positioning on the part of speculators, but we're just thinking about the trends. So this is back in the global financial crisis, way long as folks are really seeking safety. This is in that 2018 sell-off. This is pretty interesting, actually, because a lot of this had to do with when Fed Chair Jay Powell made his first pivot from hiking to then pivoting, and then this bond short came off. Well, right now we are clearly at a record short, and I would make the case that it's going to take a while for it to come off, Guy. But this is a great chart, a way to figure out when, in fact, we may actually see yields back off. But I think right now it's not saying anytime all that soon.
Absolutely. And we're all now anticipating what's going to happen next week with the CPI number. How could that change things? Could it exacerbate the move that we've seen thus far? Abigail, thank you very much indeed. Wow, what a week we have seen. What else are we still watching? Amazon apparently going to launch prototype satellites today on a very big rocket for 2 relatively small satellites. They're kind of keen to make sure these things get into space. President Biden meeting with the space. What did I say?
No, just space. Just I'm saying space.
Oh, space. Oh, yeah, sorry. Space. Space is important. Yep.
Keep going.
Alex knows all about space.
Keep going.
She did a whole special on space.
I actually did.
The German president, Frank-Walter Steinmeier, is going to be meeting the president. And Alex, I assume you have a ticket. How big's the Powerball now?
It is.
I am fascinated by this.
Okay. What about? Oh, okay, it's 1.4 billion.
You guys pay tax on. You guys pay tax on that, and that number's not real, is it? If you want the money, you don't get the 1.4 billion.
No, it's not. It's not real. Like the lump sum, I think the cash value is like 643 million or something like that. But I mean, I'll take it, no problem. I don't buy a lot of tickets, but my husband has like a threshold for like when it hits a certain amount, he like goes all in. He has his own system. So you know, maybe I'll see you Monday. Maybe I won't.
Okay, but you have to pay tax on it. If you win, you have to pay. Over here, no tax. No tax.
How is that possible?
If you win the lottery, the numbers are smaller, but there's no tax. It's yeah.
Okay, so what does it get to? Like, what's the biggest one it's ever been?
You can get over 100 million, and that's a euro million, sort of north of 100 million, 120, 130 million. You get those. It doesn't tend to go much further. But I think the billion number associated with the Powerball is misleading because you have to take that over a number of years, don't you?
To get you can do either. You can do the lump sum, or you can take it pay out every year. A lot of people wind up taking the lump sum. I just can't get over like no taxes, like anything. We love the taxing here. That's crazy. Anyway,
which is ironic because everybody thinks about you as a low tax environment, but maybe not so much.
I don't know. Maybe this is me talking my own book. Okay, well maybe if I win the Powerball, I won't see you Monday. Joy Mack, Chicago Blend CEO, joins Bloomberg Tech. This is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Slice through the noise.
Forget the noise.
Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York. Ed, he's off today. This is Bloomberg Technology. Coming up, look, we're going to talk the state of hiring in Silicon Valley after yet another blowout U.S. payrolls report. And we'll bring you the latest information from the trial of Sam Bankman-Fried as the FTX co-founder Gary Wang testifies that he and Bankman-Fried committed a multi-billion-dollar fraud with customer funds. Plus, we'll wrap up the latest from Google's antitrust trial and bring you a new report that shows the US is warning the EU on its AI regulation and competition. First, though, let's check in on these markets because, look, blowout jobs number. We see the ramifications in the bond market, but actually tech manages to push on through after initial knee-jerk reaction to that 336,000 jobs report. We actually see the NASDAQ managing to push on higher, 1.2% higher as we close out the week. US 10-year, though, selling off or up some 4 basis points. Once again, we're hitting like multi-decade highs here since 2007. 4.76 is where we trade. Bitcoin actually on the higher side, so a little bit of a desire to get into the risk assets on the back of some of these numbers. But let's have a little look at what's happening in terms of micro, the individual stock movers in the world of technology. PDD just on a tear. Is this Temu that's calling? Is this the fact that everyone's getting their Halloween outfits for a cheaper price point? We are seeing it outperform over the last few, months and weeks, and currently on the day up 8.8%, best performer on the NASDAQ 100. ADM as well, also helping really offset the NASDAQ initial falter on the jobs data. We're up some 4%, so a lot of the chip makers managing to push on the higher side. NVIDIA also helping on the points perspective. And I'm looking at Tesla, though, on the downside. It had been off more than 2% at one point. We're now off by 0.8%. This is they once again cut prices, particularly to the Model Y, the Model 3, up to 2.25 100, so 2,250 being pulled down in terms of a price point, just keeping on pushing that. Maybe as we see the bond market sell off. Let's have a little look at what's happening, though, more broadly in the macro data, because maybe Elon's reacting to that. Jobs, hiring, specifically in the tech sector. We're going to be bringing in Daniel Zhao, of course, who's lead economist, senior manager at Glassdoor. And ultimately, Daniel, we are seeing what has been a focus on, of course, an issue of hiring within the technology space. And I'm interested as to whether or not that's really being borne out from a macro perspective. I think we're still waiting for our guest to be brought on, so we'll give him a moment to be sat. But we have been seeing, of course, what has been pretty buoyant numbers overall. We're seeing the fact that we're unemployment rate holding at 3.8% after a surge of unemployed re-entered this jobs market. Participation remaining unchanged at 62.8%. We want to dig into some of the areas that have seen some growth. I'm looking at hospitality and leisure, education, healthcare sectors, which have really been leading some of these rebounds. But for us in the technology sector, we've just been talking about, well, letting go of people, and now more broadly, Daniel, we're seeing, well, a focus on maybe people starting to rehire in very specific spaces like AI. What do you see in your sectors?
Well, we definitely are seeing that the tech sector, the way that softness is manifested has shifted over the year, because at the start of this year, we saw this big wave of layoffs at companies large and small in the tech sector. But now it's more about that softness in hiring, the difficulty in some of those laid off workers from finding new jobs. And in fact, this is something we see reflected in how employees are talking about the tech sector. We've seen that employee confidence in the tech sector, as measured on Glassdoor, is actually below 50%. That means that under 50% of tech employees actually have a positive business outlook for their employers.
Wow.
That's not really a great situation to be in for the industry.
Can you give demographics on that, regions on that, the kinds of people who are nervous here?
Well, generally speaking, entry-level workers tend to be a little bit less confident than, say, executives. And when you think about that, that totally makes sense. But I think one interesting cut of that is actually middle managers have seen a pretty dramatic decline in their business confidence as well. I think part of that might be because you look at companies that are cutting costs. Well, a lot of that pressure falls on middle managers who have to enact these cost-cutting measures at the same time doing more with less as they try to get those costs under control.
How much is flexibility or a lack thereof bearing weight at the moment? It's interesting that we're worried about participation rates in women. We've actually seen that recover, now perhaps pull back a little bit. There's a lot of talk within the tech sector in particular that we want you back in the office, and that impacts certain people more than others.
Well, definitely we know that flexibility is a really appealing feature for jobs beyond the tech sector for really everybody. And of course, it manifests in different ways. It might be flexible work arrangements in terms of location or in terms of hours, but it is absolutely something that we see employees care a lot about, job seekers care a lot about, but we are also seeing that a lot of employers are pulling back on those options as they really try to get costs under control and try to be as productive as possible. But on the flip side, you know, the evidence, I think, is mixed there. There are a lot of employers who are getting by just fine in those flexible work arrangements. So it's really up to employers to figure out what the best way is to manage their workforce.
Now, we have seen really the oxygen within technology space just been sucked out of the room by artificial intelligence. What is happening from a training perspective? What is happening from job openings and whether or not companies can fill those job openings for AI within their own labor force as it exists, or are they having to reshuffle the benches a little bit here?
I think that's a great question. I think it's a little bit early to say because all of these new generative AI tools are pretty new, and a lot of companies still haven't figured out exactly how to use them. They haven't figured out what their strategy should be for using and experimenting with these tools. So I think right now we're just seeing a lot of experimentation, and there aren't really a lot of firm plans in place. But I think that training is a really great way that employers can reward the loyal employees that they have by giving them opportunities for career growth and skill development, and really get access to a pool of talent that offers them a lot.
Wage growth slowing from a macro perspective in the jobs data, 4.2% year over year. What are wages looking like in the tech sector?
Well, in the tech sector, we are seeing that wages aren't necessarily falling, but they're more stagnant year over year. And I think that also it's important to keep in mind that compensation is not just about your base salary, right? It includes, especially in the tech sector, it includes bonuses, it includes equity, and that is a place where we have seen a little bit of a pullback. So it's not necessarily that people are getting their bonuses cut or their equity packages cut, but when they're looking for a new job, well, maybe the size of the package that they can actually demand is not as large as it might have been a year or two ago.
What signals now do you look to? Like, you're measuring sentiment, which seems to be on the downside. Where do you look next? Because many in the macro perspective are thinking that this jobs market has to eventually start to cool, even though it defies that every single month, it feels like.
Well, I think it is important to see that marriage of hard and soft data together, because we do see that the hard data is looking really healthy for the job market. In fact, almost shockingly healthy compared to what we were thinking coming into the year. But I think it is really important to look at that sentiment data, especially as we look at how employees feel, because who knows businesses better than their employees who are on the front lines every day.
working-age Americans in the workforce in 20 years. And it's no accident. It's Bidenomics. We're growing the economy from the middle out, the bottom up, not the top down. And inflation is coming down at the same time. It's down 60% since last summer. Core inflation was just 2.2% over the past 3 months. And now we have the lowest inflation of any major economy in the world. Today, we're celebrating National Manufacturing Day. We didn't name it that. It was already National Manufacturing Day, but it seems appropriate. I can think of no better way to mark the occasion than to thank the 13 million Americans who are in manufacturing jobs as we speak. They're restoring our pride, making things in America. And today I want to highlight that of those 13 million manufacturing jobs, 815,000 of those jobs were created since I took office, twice as many as the previous administration. And report what we learned earlier this week, that spending on construction for new factories being built to generate more economic growth and jobs hit an all-time high last month. Folks, Bidenomics is about investing in America and investing in American workers. And businesses are investing more in manufacturing than ever before. We're bringing the supply chains home. Before the pandemic, supply chains was a phrase most people didn't even associate with, didn't think much about. But today, after a few delays in availability of parts and products everyone has known about, they know why it's so important. My economic plan is bringing supply chains home and investing in industries of the future so we can make things in America again with American workers. We're creating good jobs in communities all across the country, including in places that have been left behind for the last, in some cases, 20 years. Because the factories they used to work at for years and years shut down, leaving them with no options, no jobs in that community, all over the Midwest and all over the Northeast. That under Bidenomics, you won't have to leave home now to get a good job. I don't know how many times I heard and out on the road people saying, my kid came up to me, got a decent education in the state, came up to me and said, Mom, I got to leave. No jobs. No jobs. Well, you're going to be able to find a good job close to home more and more all across America. We're also making sure the jobs we're creating offer workers a free and fair right, if they choose, to join a union, to form a union. Bidenomics is leading the surge in unionized workers exercising their collective bargaining rights. For example, our clean school bus program under the bipartisan infrastructure law is replacing dirty diesel buses with clean electric buses so children getting on and off those buses can breathe clean air, not diesel fuel. We're encouraging the companies building those buses to allow their employees to unionize if the employees choose. And it's working. We saw in Georgia when workers at Bluebird, the electric school bus manufacturing company that's receiving federal funds, voted to unionize because that was their choice. The Treasury Department laid out recently in a major report that unions and collective bargaining are good for the economy overall. They help raise wages not only for the workers in that factory, but for everyone, whether or not they're a union, whether or not you belong to a union. And they also increase, corporate growth. And today's job report is just another example of what it looks like when we focus on building an economy from the middle out and the bottom up, not the top down, while bringing deficits down at the same time. You know, just this summer, I signed a strong bipartisan law where I shook hands with the former speaker, and we passed in the House and the Senate as well, to cut spending by $1 trillion over the next 10 years. Unfortunately, last weekend, Republican House members decided they were going to put that progress in jeopardy. Instead of honoring that commitment they made, they once again brought us to the brink of a government shutdown, creating unnecessary instability and risk in order to secure more extreme cuts in programs that help working Americans and seniors. Cuts that would have hurt everyone from hurt U.S. manufacturing, that would have stymied the pay of military people, a whole range of things. They tried cutting funding by 30% for small businesses, which are growing under our administration, for local manufacturers, for Manufacturing Extension Partnership Program that helps small and medium-sized manufacturers attract and train workers and grow their businesses. But we stopped them. Quite frankly, I'm sick and tired of Republicans in the House saying they want to cut the deficit when all they really want to do is once again cut taxes for the very wealthy and big corporations, which will only add to the deficit. When I was able to cut the federal debt by $1.7 trillion over that first 2 years, well, remember what we were talking about. Those 50 corporations that made $40 billion weren't paying a penny in taxes. Well, guess what? We made them pay 30%, 15% in taxes, 15%. Nowhere near what they should pay. And guess what? We're able to pay for everything, and we end up with an actual surplus. You know, it's not what the economy needs right now, more tax cuts for the wealthy. I've said it before and I'll say it again. We've cut the deficit by over $1 trillion since we've taken office. Laws that I sign will cut it by another $1 trillion over the next 10 years. And my budget would cut it by another $2.5 trillion over 10 years. Here's the deal. The federal debt went up by 50% under my predecessor, in part because he passed a $2 trillion tax cut overwhelmingly skewed to the very wealthy and large corporations. I believe we should be reducing the deficit by making sure that the wealthy and large corporations can just pay their fair share. I'm not going to pay 90%. Just pay their fair share. By cutting wasteful spending on special interests like big oil, all the money they made and paid so little in taxes. Big pharma, same thing. You know, we just gave the American public a real gift in terms of, not a gift, but fairness in terms of what they have to pay for insulin and what they're going to have to pay for other things. Well, guess what? That also cut the federal debt.
President Biden making comments on the jobs data. Of course, a blowout number of 336,000 jobs being added. Notable that participation rates perhaps varying between men and women. So we keep an eye on what President Biden is saying, and of course he's turning his attention to tax rates as well, particularly for corporates. Let's turn our attention now to the trial of Sam Bankman-Fried. FTX co-founder Gary Wang said he and Bankman-Fried committed a multi-billion-dollar fraud with customer funds that led to the cryptocurrency exchange's collapse when he took the stand to testify. Pleased to say that Bloomberg's Hannah Miller has been, well, across this story for the last several years, but also now as we see this, what's going to be a 6-week trial come to bear here in New York. What did you make of Gary Wang in particular? I mean, they certainly didn't make eye contact.
It's very damning testimony. Gary Wang has laid out multiple times that Sam Bankman-Fried was a guiding force in terms of setting up special privileges for Alameda Research as an FTX customer. I mean, the advantages Alameda had are absolutely stunning.
Billions that they had basically as a credit line is the accusation here, and ultimately that really the defense argument that Sam Bankman-Fried couldn't be across everything in Alameda Research, that was the role of the CEO, seemed to be being undermined here.
That's correct. Yeah, Alameda Research had a $65 billion line of credit. No other customer had a line of credit over $1 billion. So this is pretty insane. They were also allowed to have a negative balance on their accounts. They were allowed to withdraw. Their accounts wouldn't be liquidated if their crypto bets went sour. And it seems like Sam Bankman-Fried, according to Gary Wang's testimony, was well aware of this, and people were trusting his judgment in terms of setting up these advantages for Alameda.
Has there been anyone that's come a little bit more towards Sam Bankman-Fried's defense here in terms of who's been giving evidence? It was notable that other long-term friends, people he'd been at university with, then did come on board and work, and perhaps sort of tried to echo that he wasn't someone who was flamboyant. Even though there was a lot of money being spent on a penthouse, he wasn't spending it lavishly on himself.
Yes, Adam Yedidia testified yesterday. He's a former friend of Sam Bankman-Fried's. He had worked for FTX. He testified that Sam didn't live this ostentatious lifestyle, that he wore regular clothes. But I believe that's offset by the millions of dollars in real estate purchases that FTX made and the Lux Life employees had in the Bahamas.
Hannah Miller, great podcast on the extraordinary dealings of FTX and downfall, and I'm sure you'll continue to be an avid viewer and listener in on all that's happening in the trial in here in New York. We thank you so much for running us through what happened yesterday. Meanwhile, turning to another story that we've been following, a phenomenal one in terms of the world of diversity, Fearless Fund. It's a VC foundation's grant program for businesses run by Black women. Now, it has been prohibited from closing its application window on September 30th, or then from picking a winner until further ordered by a court. This is following the lawsuit from the American Alliance for Equal Rights. It argues that the program by the Fearless Fund violates Section 1981, which bans racial discrimination in contracting. Let's bring in Bloomberg's Kelsey Butler to break down what is a complex but far-reaching argument that's happening out in Georgia right now. Ultimately, the argument here is that you cannot level up in terms of allocation of capital here by only giving money, certain funds, to women of color. What is their argument in particular against Fearless Fund here?
Absolutely. So as you mentioned, the group behind this says that this violates the Civil Rights Act of 1866, that essentially by targeting a specific group, though they are underrepresented, it leaves out other groups, specifically on the basis of race. And I remember here is the person behind the organization that's suing, Edward Bloom, who, you know, the name might not be familiar, but is a conservative activist who was involved in the case against Harvard. And as we know, the Supreme Court ultimately banned the use of, banned race-conscious admissions in colleges. So affirmative action is no longer the reality when it comes to college admissions. And certainly that win, I think, emboldened him and probably other conservative activists that, you know, have an issue with diversity programs.
This has got to just be one of quite a few funds that have been set up to allocate money to minorities, whether it's to entrepreneurs who are women, diverse entrepreneurs in many ways. What is the far-reaching effect to something that is going on for one particular fund at the moment?
I think this is certainly going to have a chilling effect. You know, we're not only seeing this play out in courts, but we're seeing politicians dive in and specifically target and, you know, name check companies. And so what that is doing, and what I'm hearing a lot about, is that companies don't want to put a target on their own backs by loudly talking about their diversity programs, by even really keeping ones in place that they already have. They're now, you know, running those by lawyers and seeing, are we in any way potentially running afoul of the law or going to, you know, shine a spotlight on what we're doing.
Thank you for shining a spotlight on it with your reporting. Kelsey Butler really setting up a situation here that many a VC and indeed corporate allocator are now considering. Let's dig a little bit deeper. Joey Mack is also at the front of this. He's the CEO of Chicago Blend. It's a nonprofit working to advance diversity, equity, inclusion in the Chicago region's venture capital industry. And Joey, this does have far-reaching effects. What are your questions coming inbound for you at the moment from diverse founders, diverse VCs who are now worrying about some of the funds perhaps that they've raised from corporate America?
Yeah, well, thank you for having me. Certainly, we were shocked by the brazenness of this lawsuit, but not at all surprised, because we know this is part of a broader push to diminish diversity efforts in business. Certainly, there are lots of questions coming in and around, you know, what does this mean for me, for my firm? But at the end of the day, suing firms like Fearless Fund does nothing to move the industry forward. It only reinforces existing inequities within venture. So, you know, our message to those firms that are investing in underrepresented founders is to continue doing the work. This is going to be a long legal battle. It's just the beginning stages of it. So while that's playing out in the courts, we're encouraging firms to continue investing in underrepresented founders.
Now, we do know that the statistics are pretty awful when it comes to diverse allocation. I mean, ultimately, what is it? Less than 2% of overall capital deployed is in women-led startups. Black founders in the US getting even less than 1% of total venture. But to play the other side here, is it right that you should have affirmative action, that you should have certain funds allocated to only minority-led businesses to help with leveling up, to help with equitable distribution of capital? Is there another way of doing this, Joey?
You know, at the end of the day, having more diversity among the investor class will enable more diverse or more checks to be written to underrepresented founders. So, we know that people tend to associate with and invest in other people who look like them. So, for us, we look at what does diversity look like across the venture ecosystem, across the ecosystem of people who are making those investments. And we've seen that because of the severe underrepresentation of specifically women and people of color, we're seeing that translate to who's actually getting checks. Ultimately, if we can get more dollars in the hands of underrepresented founders, they'll be able to build companies, penetrate new markets that a lot of investors aren't currently looking at, and ultimately build companies that will be durable and that can serve totally different segments of the population that are being overlooked right now.
Joey, we're looking at Chicago Blend backers, Baird being one of them, Techstars, Manifold. Are any institutions, and I think of the Fearless Fund, for example, that has had money, multi-million-dollar allocations from MasterCard, from Costco, from Bank of America. How many of these institutional companies and institutions are worried about supporting non-for-profits like yours, funds like Fearless Funds?
Well, I can speak about the companies and the corporations that have been supporting us. I think they support us because they share our commitment to diversity, equity, and inclusion. They see the business case for why we need to continue investing in underrepresented founders. And, they've continued to support our work. So, although this chilling effect that your previous speaker mentioned is certainly very real, our message to them as well as to other funds is we need to remind ourselves of why we're doing this work. Ultimately, we need to focus on getting more dollars, more venture finance dollars in the hands of underrepresented founders, and that's ultimately how we're going to build a more equitable and competitive tech ecosystem.
So when someone is looking for advice, when they're looking at what's occurring in Georgia, when they're seeing what's happening with the Fearless Fund, what are you saying to VCs that do have a mandate as it stands to just allocate to women of color, people of color, diverse founders more broadly?
Yeah, well, people are definitely fired up. And right now we need to be educated about the legal issues and implications at hand. So that's where Chicago Blend has been focusing our energy. But we also need to be prepared to speak up and stand up against this broader backlash to diversity, whether it's in venture capital or in business more broadly. So again, our advice to firms that invest in underrepresented founders is to continue doing the work. That's ultimately how we're going to bring about positive change.
Are you seeing enough institutions speaking up?
Well, again, the organizations that we work with, they've been very supportive of our approach to, increasing diversity. But I do think that, it would be great for the business community to remember why they are investing in diversity efforts more broadly. Several of the organizations that we work with, they make investments internally as well as externally to support diversity. And our message to them is please continue to double down on that.
Joey Mack, great to have some time with you. Thank you so much, CEO of Chicago Blend. We really appreciate some of the expertise coming from the advice you're currently giving. Meanwhile, coming up, we're going to talk about cyber. MGM says its recent computer hack into its casino hotels is going to cost it big time. We'll have all the details next. Meanwhile, look, you've got to keep an eye on some shares that are on the move today. Amazon, we look at, we were already discussing some of the regulatory overhang, but on the higher side today, up more than 0.8%. Interesting, they're going to be focusing in on those satellites, of course. They've got 2 test satellites to be going into lower orbit today on a rocket, we understand, at 2 p.m. ET. We keep an eye tuned of that. From New York, this is Bloomberg Technology.
I know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on a dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
So you're not selling the Patriots, you're not selling the packaging company. I guess you don't like to sell things, right?
I really don't. We try to create a family environment in everything we're involved in. People want to be part of something that's bigger than themselves.
MGM and has just said that the recent computer hack that shut down many services at its casino hotels will reduce its third quarter profit by about $100 million. And the company also incurred almost $10 million in costs fighting the attack, with the most related to technology consulting services, legal fees. It's all according to a filing. Now, cybersecurity insurance should cover most of the costs, MGM said, although the full impact has yet to be determined. For more, we're pleased to welcome Jaya Balu, Chief Security Officer at cybersecurity firm Rapid7, who is trying to analyze ultimately the costs for businesses here. I can imagine in a macro environment, companies have been reticent to spend on things that they feel are extra. But is cybersecurity one area that they pulled back on, and ultimately does that end up hurting them in the longer term?
I think absolutely. If they're not spending enough preventatively, and there is a rough number that we've tossed around in Europe for quite a long time, which is 10% of your total IT spend is what you should reserve for your cybersecurity spend on making sure that all the things that you integrate into your networks and systems also have this component for cybersecurity, whether that's monitoring and detection or prevention of vulnerabilities or all of the other kind of remediation stuff that you would need to have on hand in order to combat such an incident, and have a certain pot reserved for outside counsel as well as forensic support. But most companies aren't doing that preventative stuff, and then they wind up being caught off guard during an actual incident.
We've had so many headlines with MGM, whether it's the ongoing fallout for Clorox, which is trying to really lay bare how much this is going to cost from their own cybersecurity hack. Is this something that our regulators are trying to eye, that ultimately we're seeing carrots put in place of hey, the upside of not getting a cyber attack, but also a stick put in place?
Absolutely. So from an SEC perspective, as you know, there was a new SEC disclosure for cybersecurity incidents, and it's about reporting material incidents within 4 days of knowledge of the company that they were actually occurred and that they are indeed material. And this is in order to help shareholders make better decisions about the companies that they've invested in. I would argue, though, this is remarkably difficult to do for a lot of these companies. First, in terms of determining what is a material incident. In the fog of the actual incident, that's really hard to do. So that 4 days is an ambitious, aspirational kind of thing that you know while you're actually doing all of this, response to an incident, that you can understand the material impact as well. So that's going to be difficult. And I think the Clorox example is going to be a sort of poster child for a lot of people in the cybersecurity industry who are wrestling with this, because you do see that Clorox is going to report a decline in their profits because of this incident. Not only the direct cost impact, but also the fact that they couldn't stock shelves with their product, and then subsequently will need to report to shareholders what the consequences of this cybersecurity incident was. And coincidentally, it was the same group that attacked MGM.
Yeah, can you talk to us about the groups? Scattered Spider, how and what are they bringing to bear that is so upending certain companies?
Well, they're clearly interested in profit, or at least that's what they claim to be interested in. So there are opportunistic attackers from that perspective who are looking for someone who will pay their fees. They're working together with a ransomware group that was formerly or associated with the Russians, Alpha V. And what they're causing is an enormous amount of impact to these companies to just, get that data ransomed, make sure that those operations are locked until the ransom gets paid.
What we keep hearing time and time again is that AI in particular is going to make companies more vulnerable, but also give them the armor that they need to be able to prevent against such attacks. Who's winning out in this race to ensure that AI is being adopted at the fastest pace possible?
Initially I thought that defenders had a huge head start in this AI race. So we've been having machine learning techniques for a very long time in a lot of cybersecurity tools. And the only types of AI attacks that we were seeing are something called domain generating algorithms. And it is exactly what it sounds like, which is just that you spin up a domain like www or some difficult domain.com in order to stop defenders from finding out what all of those evil domains are and blocking them. So those were the only things we were seeing. And now we're seeing, of course, with things like Darkbird, the ability to craft more, better phishing mails, etc. And I think that the defenders are losing their advantage. That advantage is slowly but surely slipping towards the adversaries. And we need to kind of make sure that cybersecurity companies are adopting AI measures in their products, and that our consumers are buying those products.
The likes of, I've certainly heard Brian Moynihan and other CEOs say, the one area that they never are going to sacrifice, no matter how many macroeconomic headwinds are, is the cyber allocation and the focus on just protecting customers and indeed every stakeholder. Is that something you're seeing ring true, or ultimately have you seen companies worldwide pull back? And what is your answer to that?
I do think you're seeing a decline overall in the amount of appetite to spend on all types of IT things, including cybersecurity. So I'm not seeing that. Actually, I would love that to be true. Let me be clear. But I think that you're seeing CISO budgets shrink as the importance of this role tends to increase. So globally, the trend is not favorable for security when you look at, the actual budget incapacity of these chief security officers.
One to be keeping a keen eye on. We thank you for breaking down just so expertly what currently is afoot here. Jaya Balu, Chief Security Officer, who is probably quite busy at cybersecurity firm Rapid7. Great to have her in the studio. Meanwhile, coming up, X testing the waters for 3 tiers of premium service on their platform. We're going to have all the details for you. And of course, speaking of Elon Musk's company, we're watching the shares of Tesla. Look, the company has once again cut prices on its top-selling models in the US, just days after its third quarter deliveries missed estimates, remember. Now, the car maker marked down starting price of the base Model 3 by $1,250. It discounted the long-range version of the sedan by the same amount, and actually up to $2,250 on some of the more premium offerings that they have. So clearly going for sales over profit right now with Tesla. This is Bloomberg Technology.
obviously we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Formerly known as Twitter, is giving bankers an update on efforts to reinvigorate growth into the platform. CEO Linda Yaccarino saying that it's testing 3 tiers of premium service, which would allow the company to charge customers different amounts depending on how many ads are shown. Bloomberg's Aisha Counts joins us for more, and this all is coming out as they're trying to persuade debt holders in particular that, well, they're managing to grow this business.
Exactly, right? As we all know, the takeover of Twitter was extremely chaotic. $44 billion, which is quite a lot, $13 billion of debt. And so the bankers that help finance the takeover want to see what are they doing to make money, especially after advertising revenue declined 60%. And so that's where these advertising tiers come in. Now, it is going to be for premium users. So again, premium, which used to be called Twitter Blue, you pay about $8 for some additional features like the ability to edit your post and things like that. And so X is testing having 3 different tiers. So basic, standard, and plus. Similar to the way that a Hulu or Netflix operates, the more money you pay, the less ads you're going to see.
Okay. Well, talk about how, therefore, the advertisers are feeling at the moment. Did we get any sense from Linda Yaccarino that they're coming back, staying back, and paying more?
So one of the things that X did say is that advertisers are coming back. So they said in June, about 75% of their top 100 advertisers, so you think about some big marquee names, about 75% of those were back in June. Now that number is up to 90%, but they are spending significantly less. And even X admitted that. And then even by some sort of independent third parties, they're estimating it's like 70, 80% less in some cases. So it's definitely not where it was historically. And advertising revenue has made up the majority of revenue for X traditionally, about 80, 90% of the revenue.
Now, going back to the slightly chaotic purchase of this company, it's not just debt holders that want time with Elon Musk. It seems as though regulators do too. Can you update us with what's going on with the SEC right now?
Yeah, so again, going back to chaotic, right, is the word when you think about the takeover. Actually, before Musk acquired the company, he acquired a stake. So he had about a 9% stake in Twitter at the time. And whenever you acquire over a 5% stake, you have to disclose that to the Securities and Exchange Commission, the SEC, within about 10 days. Musk disclosed it, but disclosed it about a month later. And so the SEC began to probe and like, why did you disclose this late? And Musk was actually supposed to testify last month, but a couple of days before, like 10 to 15 days before, he started making objections, saying maybe we could do a different date or do a different location. And so now they're trying to compel him and try to push him to testify regarding the takeover.
Alex Spiro, of course, the attorney for Musk, saying enough is enough. You've had multiple times with the interviews. Aisha Counts, thanks so much for bringing us up to speed on all things X. Meanwhile, that does it for this edition of Bloomberg Technology. Don't forget to check out our own podcast. You can find it on the terminal as well as online on Apple, Spotify, iHeart. We've got a big week coming up for you next week as well as we head to LA. From New York, this is Bloomberg Technology.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at BloombergLive.com/screentime.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, another red-hot jobs report sends yields flying once again, fanning fears that something will break as rates rise, as volatility in the credit market finally starts to wake up. We begin with the big issue, a blowout print.
Today's data on jobs
was a much higher number than we were expecting.
The incredible strength of the labor market.
This is good news for the economy right now.
This is a much stronger labor market, clearly.
Maybe we've got something that's perfect Goldilocks.
A very tight labor market.
Resilience within the labor market.
The Fed is not going to welcome this report.
The Fed wants the labor market to slow.
Rates are going to have to stay higher for longer.
The Fed's higher for longer narrative.
It puts back on the table a hike for
the 1st of November.
If you can have a strong labor market but not have real wage growth being too high, that would be ideal for the Fed.
When you fall behind right at the beginning of an inflation cycle, you pay the price when you get to the last mile.
Eventually, the cost to be paid for a much higher interest rate environment.
Joining us now, I'm thrilled to say we have Bank of America's Megan Swiber and RJ Gallo of Federated Hermes. And Megan, I'll start with you because nerves were already frayed in the jobs market and the bond market, and then we got this jobs print. What actually stops this sell-off?
Yeah, Katie, I think it's really one of two things here. It's either that we see more pressure on the equity market, driving more of this flight to quality flow back into the risk-free asset, which is treasuries, or we need to see a more substantial turn in the data that gives the market more confidence that the Fed is going to be cutting eventually. It's really one of those two things, and I think that today's data print really puts us more squarely in the view that it's probably more upside to come for rates near term.
Potentially more upside to come. RJ, I want to bring you in here because I'm taking a look at your notes, and you write, this pain should pass. Evidence suggests that the move up in longer yields is nearing an end. Where's the ceiling? Have we already seen it?
Well, I don't know if we've already seen it. I think we're nearing the end, however. I think in the post-pandemic environment, the economy has proven to be much more resilient and much more inflationary than we thought, if you look over the last 2 years or so. I think as a result, the Fed and the markets are grappling to figure out where is fair value. What is the new post-pandemic equilibrium level of yields? The Fed has an R-star of 2.5 in the dots. That's probably dated. The market now thinks R-star must be somewhere up in the 4% range. At this point, value has been restored to the fixed income market. The market is trending almost as if it's all momentum driven. But there is some fundamental value that should assert where equilibrium yields are. And we think we're much closer to a point now where people need to be looking at fixed income and saying, nearly 5% yields on a 10-year, 5% on a 30-year. These are attractive yields, and that the equilibrium yield post-pandemic will not be 2x what it was pre-pandemic.
Megan, come in on that. Has your base assumption of what R-star is, where the equilibrium rate in the bond market actually is, has that changed over the past couple months?
Katie, I think that mentality really is what's caused a lot of folks in the real money community to be early, long, and wrong in this view. And one of the most surprising things that we've seen alongside this very significant sell-off over the past couple weeks is that it's been pretty orderly. We're actually seeing liquidity go down quite well. Speaking with our trading desk in London all this past week, really flows have been generally normal. What I've been really most concerned in looking at alongside these moves are we seeing that capitulation from the real money community? And surprisingly, despite this pressure higher on rates, we're really not seeing that yet. So despite the fact that rates right now are very far above what the Fed is telling us and economists are telling us where this neutral rate can sit, I think that there's just more pressure that we could see come if you do have that capitulation from investors that have been buying rates for that mentality for months now.
Okay, so maybe no one's hitting the panic button, at least just yet. And it was interesting. We heard from San Francisco Fed President Mary Daly earlier in the week, who found a little bit of a silver lining in this bond sell-off that we're seeing.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there.
And RJ, to that point, when you think about what this means for the Fed, when you think about what we've seen, particularly at the long end, what we've seen in real yields, how much tightening has that actually done for the central bank?
Well, I think the Fed's probably, up till recently, the Fed might have been a little frustrated about how longer yields hadn't moved. Maybe in the next tightening cycle, they'll think twice about having sharply inverted dots in the dot plot. Typically, the 10-year Treasury yield rises and matches the terminal Fed funds rate in a tightening cycle. This time, that has not happened yet, but in part, that was because the Fed had been telling us they will tighten drastically to fight the inflation problem, and then they will ease in 24 and 25. I think one of the new developments in September was that they've diminished that easing. They've raised the trajectory of the Fed funds rate in the next couple of years. The markets are struggling a little bit to figure out where is fair value because they don't know that the Fed knows where fair value is. I would suggest that a 5-year forward OIS that's around 440 right now, 5-year forward at 440 is very high in real space and suggests that fixed income investors are going to do better prospectively than we have done recently. Megan makes a good point. Maybe there hasn't been panicky capitulation, but the gapping higher of the market tells you there isn't a fundamental sense of confidence about valuation. And I think at this point, when you're staring 5% pretty much on your screen, you start to think that real yields are the highest they've been since the late 1990s. Value has been restored. We need to start legging in. No, we don't have certainty, but I think that just trading this market like a momentum market, you're probably going to miss the turn.
Well, actually, to that point, I want to talk a little bit more about duration, because when you think about rates, 10 years, 30 years, all near 5%, what does the risk reward of going out the curve right now look like? Of course, rates could go higher, but if we dropped, I mean, what kind of payoff are we looking at?
The skew is clearly favorable. I mean, at this point, being in cash year to date, undeniable winner.
RJ. Up next, the auction block, where it's cold in October, at least when it comes to issuance, with yields on the rise. Details next. This is Real Yield on Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where the surge in yields is causing a slowdown in issuance. Let's start in Europe. This region this week managed only around 12 billion euros of sales as sentiment soured. Only top-rated names like hotel giant Accor ventured into the tough market conditions. Similar story here in the U.S. Weekly volume finishing around $9 billion, well below consensus estimates. Only a few notable names like Darden Restaurants and Dominion Energy brave the market. And the issuance chill really hit U.S. high yield. Rising yields and spreads practically shut down the market as borrowers stayed on the sidelines waiting for calm to return. Now, earlier in the week, Guggenheim's Jim Milstein said that this surge in yields is going to catch up to companies.
A lot of companies levered up when the rates were cheap over the last 10 years, and that bill is now coming due. So companies and most companies can't just pay off their debt. They're refinancing their debt. So they're now refinancing their debt in a much higher interest rate environment.
And you can see here in this chart that the higher costs for high yield companies already taking hold. And joining me now to discuss, Ken Monahan of Amundi and Zach Griffiths of Credit Sites join us now. And Ken, I want to start with you. You think about the cost of capital going higher and higher. If I'm a corporate treasurer and I want to sell bonds right now, what am I to do?
Well, Katie, thanks for having me back. First of all, I think that there's a lot of companies that have sat on the sidelines and are paying a price now for having done so. I was talking with a capital markets guy earlier this week who told me he had 5 different companies that had ignored his advice and said that we're going to wait until rates drop. And it's now a costly error on their part. If you look at between the shift in the last 3 or 4 weeks and in the 5-year and then the increase in spreads, you're talking about an 80 basis point plus move. So I think companies are now going to wait, and I think that they may find it's going to get even worse as spreads are likely to widen from here if the Fed does what it's looking at like it will do, which is to slow the economy.
If spreads continue to widen here, Zach, come in on that, because for a while, credit spreads were going nowhere. We finally start to see some signs of life, spreads moving a little bit higher. Is that durable? How do you think this plays out?
Yeah, Katie, we kind of have a bifurcated view in terms of tactical and strategic. Tactically, we think spreads can move wider in the near term. You've had this huge move in yields, and credit spreads up until very recently had held in pretty well. And so we still take a tactically cautious approach from adding risk at this level. But if we see spreads move back toward that 475 to 500 basis point range, we think that would be an attractive level looking forward, as the yields are very attractive, and we are expecting a more constructive 2024 relative to what we had been anticipating, just given how much strength we're seeing in the economy. And we even think the Fed might have the opportunity to bring rates lower as they focus on the real policy rate versus the nominal policy rate.
And Ken, is that your view as well? When you think about this little bit of a widening that we've started to see just in the past couple of weeks, does that look like an opportunity to you, or do you think that there's more to come?
I think we think there's more to come. You know, I think we've been all waiting patiently, or a number of high yield investors have been waiting patiently, looking at the tea leaves, and in particular things like the senior Fed loan officer survey, which we all watch, and would imply that spreads ought to be much higher than they are. So this is a bit of a catch up here. I think it's been slow to move for a couple of different reasons. One, a lot of companies got the financing they needed done in 2020 and 21, which were back-to-back record years. Two, nominal yields have moved significantly higher, and that's helped as well. And then third, I think if you look at it, a lot of companies in a number of different industries have been operating at record profit margins, so they've had a bit of extra cash to not worry so much. But I think that that's going to change here.
Well, let's talk about how it could change. When you think about refinancing risks, potential maturity walls, when you look into 2024, 2025, and beyond, how real are those risks?
Well, the answer for 2024 is the risk is not enormous, because there's a very small portion of the market. It's like 2% that's maturing in 2024. When you get out to 25, it's a different story. You're looking at almost 10%, and then it's like 14, 15, and 26. And companies don't wait in the high yield market until the last minute, until they refinance. They typically refinance at least a year in advance. So by the time we got to the back end of 24, companies have really got to start chipping away at that 25 and 26 maturities.
And Zach, how painful will that be? To Ken's point, I mean, a lot of these companies, especially in the high yield market, can't wait until the last minute. They're going to be refinancing into much, much higher rates. What does that mean?
It's definitely going to be challenging for fundamentals from an interest coverage perspective. But when we look at cash on balance sheets, even for these high yield companies, it's still elevated historically. And Ken makes a great point that a lot of these companies were able to extend maturities at much lower levels. So when we think about timing of having to address these maturities that are predominantly in 2025 and 2026, we are expecting yields to be moving lower from where they are today around the middle of next year. And so I think that there's going to be an opportunity there, and there's more flexibility on corporate balance sheets to sort of absorb and do some liability management exercises over the course of the next year that allow the impact to certainly have a small deterioration on fundamentals, but not something that we think is going to topple the market altogether.
And Zach, unfortunately, we only have about 30 seconds left, but I'm curious to hear your thoughts. I mean, so much has been about the rates market in equities and in corporate credit. Is this still going to be a macro-driven market going forward?
We do have our eye on some pretty substantial risks. You have CPI next week. The November 1st Treasury refunding and FOMC date is huge. And the other is the federal government may go into shutdown again in mid-November with the House Speaker losing his position. So we do think there's a lot of macro risk for now, but we're expecting that to create opportunities from a longer-term perspective in both investment grade and high-yield credit going into 2024.
All right, have to have you back both soon for a longer conversation. Really appreciate your time on this Friday. My thanks to Ken Monahan and Zach Griffiths. Have a great weekend. Still ahead, though, it's the final spread. The week ahead, a key U.S. inflation print on deck. We'll discuss next. This is Real Yield on Bloomberg.
think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up Monday, the U.S. bond market closed for the holiday. And then on Tuesday, Fed Speak continues with Bostic, Waller, Kashkari, and Daly. Wednesday, we get U.S. PPI and Fed minutes. Thursday, U.S. CPI plus another round of jobless claims. And then Friday, bank earnings kick off with Citi, JP Morgan, and Wells Fargo. Let's talk about CPI, though, because, of course, when you think about the big moving events in the bond market, I would imagine it's these numbers right here. Of course, you're expected to basically see it cool across the board from headline to core. Month over month, core expected to basically stay at the same level, but still maybe a little bit of relief there. But from New York, that does it for us. Same time, same place next week. This is Bloomberg Real Yield, and this is Bloomberg.
We're back
for another season of AI IRL.
My opinions sometimes elicit unfriendly responses from my peers, but let me try to explain my thought on it.
So to start, Twitter and X are two totally different companies in my head. Companies are driven by the culture of the people who are there. They're two totally different places.
Not to ask people about their bosses, but Mark Zuckerberg, how is it changing his priorities?
A lot of time and thought is invested into how you can innovate.
It turns out that the popular chatbots, ChatGPT, Bard, and others are so easily hackable to actually drive a different agenda from what is bounded as a response mechanism.
There's a tipping point here where the images have become so good that really smart people who are by design critical are falling for it. That was number one. But here's the other one that really scared me.
Do you think that there's potential to see kind of an AI rust belt of sorts?
My personal opinion is no. That might be somewhat contrary to what others are thinking.
Do you think that it can replicate the solace and comfort some people feel with religion?
What I have seen is that it really varies depending on how people think about the way that, higher powers or the divine might move through the material world.
I'm John Olin. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on the markets at this hour. The jobs blowout this morning drove the equity markets down and yields higher, but we've had a real turnaround. Now equity markets are gaining, and we're at a session high on the S&P. Right now, about 1.2%. The gain, 43.07, the level there. Take a look at the 10-year yield. Right now, 4.78 is the level. Earlier this morning, we shot up to over 4.88 on the 10-year. So hitting fresh highs since 2007. We've retreated a little bit, obviously, from there. Yields are still high relatively. The Bloomberg Dollar Index continues to come down from the high we saw for the year a couple of days ago. Right now, 1270, 1271, the level on that. And NYMEX crude has, I think, entered correction territory. So down at least 9, maybe 10% this week alone. NYMEX crude trading at $82.72 a barrel. John?
Well, we're certainly watching the oil story here in Canada, Matt, and the currency story as well. It's interesting. We've seen the Canadian dollar stronger against the greenback today because a lot of people in part are thinking, well, maybe the Bank of Canada has got to continue to navigate the inflation challenge given some resiliency in the Canadian job market. So obviously smaller economy, but still the nearly 64,000 jobs that were created in the September period, Matt, was triple what the economists who track these data points were expecting. The unemployment rate in Canada held steady at 5.5%. But the wage growth story, and Matt, we keep talking about these labor challenges across North America right now. Year over year, you saw an increase of more than 5% there as well. And obviously the inflationary effects from that are things that central bankers are watching very closely.
Yes, really fascinating beats here, both in Canada and the U.S. Now, back here, I mentioned the September jobs report was a blowout. Mohammed Al-Arian says investors should be prepared for pain ahead.
This is an economy that got used to ridiculously low interest rates and got used to liquidity injection. The change in the regime is happening really fast. So something is likely to break, probably in the financial markets, but that will have spill back into the economy.
Okay, so as investors navigate all the chatter, let's bring in Liz McCormick, Bloomberg chief correspondent of global macro markets. And Liz, you've been writing pretty extensively about the money flows we're seeing, particularly in money market funds right now, with investors trying to guess where we go from here.
Yeah, it's amazing. The money just keeps plowing in. We got the latest data yesterday, new record, like about 5.7 trillion in change going into money markets because people, I guess, just continually feel like I'm getting paid a great yield to just sit there in safety. Although if you look at the broader yield curve, you see, a re-steepening. It's still inverted. And we're hearing a lot of people favoring the short end of the coupon curve. So like 2 years, 3 year, it just seems like the safer place to be. But yeah, there's a lot of money in money market funds as well.
Liz, why do you think we saw, this morning's price action made a lot of sense to me. If you get a big blowout jobs number, we were looking for 170, we got 336,000 jobs. You would be right to think, well, maybe the Fed still needs to raise rates further. And that's why the market fell, the stock market. Why do you think risk assets have now turned around and rallied higher?
Well, it's interesting, and this happens a lot when we get these very involved reports. Like, without doubt, the headline numbers were blowout. But then you start seeing, like Michael Feroli at JP Morgan was saying that the household figures were much less, he called it boomy, and we saw some stability in the average work week. So people started to look under the hood a little, and I saw several people say, yeah, this definitely increased the chances of a hike by the Fed, even in November meeting, but they don't predict it. But like CPI next week, if that thing is higher, then that's going to be like the nail pin in that would probably get that last hike that the Fed, dot plot has been predicting. But I think so the market's digesting, stock market kind of saying, well, the economy's good, earnings are not bad so far, and maybe we could deal with this 5% yield. But I just think for the bond market, even though rates have come off their highs of the day, it does create a backdrop of, Fed is not going to be pivoting anytime soon to cuts, right? Those cuts moved further out today. They're priced in for next year, but now instead of in July, they're in September. So I think that higher for longer thing is going to hover around, but the stock market kind of seeing the Goldilocks side for the moment.
Liz, do we have a sense on, because everybody keeps talking about, given the level of yields, to a certain extent, maybe part of the Fed's job is done, given the mood in the bond market right now. How closely are you going to be watching where yields sit for the coming weeks until we get that ultimate decision on rates by the Fed?
Yeah, that's a great point. And, Mary Daly of the Fed yesterday was speaking to that point that, maybe these higher rates, may, among other factors, have to work out. Do some of the Fed's work, like you said. But it's interesting. The long end, infamously, the Fed can't control, right? And like Mohamed Al-Arian was saying, the risk is that things really unmoor and then something breaks. We see other banks fail, different things like that. So I've seen a lot of folks say, yeah, the long end, especially with this curve steepening, has, gone up. Maybe that's what the Fed wants, tighter financial conditions. But to a point, and I just think there's just so much more risk. That's why you're saying people say, maybe I don't want to buy 10 or 30-year bonds. There's just too much embedded risk, supply, term premium, you name it, the list go on. But yeah, I think that is what the Fed wants now. They're not talking down the market, but there's a limit, and I don't know exactly what the number is, but we'll see.
You wouldn't think anyone wants to buy the long end, and yet the inflows to TLT just continue. 34 weeks in a row of positive inflows on that bond fund, which is, I think, 20 years plus. So really fascinating stuff. Liz Kappa-McCormick joining us talking about bonds. Thanks so much for that. Let's discuss with S&P's Global Chief Economist, Paul Grunwald. He joins us here in the studio. I'm pleased to say, Paul, thanks so much for coming in. What do you make of the labor market after this jobs number? I mean, not only, as John was saying, was it a huge beat here in the U.S., it was triple what they expected in Canada, so across North America.
Yeah, well, we've been watching this movie play out all year, right? We keep expecting the market to slow down because the Fed and other central banks are raising rates and tightening conditions, and we keep getting these strong numbers. As your colleagues just described, it wasn't necessarily all bad. We got a little bit lower wage growth and some pockets of softness, but I think this points to the fact that maybe the Fed isn't done. Maybe the markets will do the work of the Fed, tightening conditions, but November rate hike's definitely not off the table right now.
Well, and the Fed is kind of working at cross purposes, right? As they try and tighten financial conditions, the U.S. government just hands out more and more money, blowing up bigger and bigger deficits. Stephen Major from HSBC today said he was wrong on the bond market. He's a bull. He said, and I'll quote directly from our story, where we've been wrong is the fact that normally I don't think deficits matter. Do they now matter, Paul?
Well, the policy mix is the issue, right? You've got the Fed trying to tighten and pull back demand, and you've got the authorities, the fiscal authorities, pumping demand into the economy. That makes the Fed's job harder, right? They're trying to raise rates, tighten financial conditions, and slow the economy down, and the Treasury is doing the opposite. So it's going to make everything more difficult. But I think there's been a bit of a wake-up call over the last month or so at the long end, because you've got a large fiscal deficit. We've got a lot of investment around energy transition and kind of this renaissance of manufacturing we've been talking about for a while, and then you've got the Fed rolling off its portfolio with QT, so you put all that together and you're going to get some pressure on the long end of the curve, and I think that's what we're seeing.
Paul, the Bloomberg Intelligence economics team was trying to make the point that when you look under the hood at the state of the jobs market, you can find some cracks, and that arguably, looking at September versus where we are even early in October, that the picture is changing right now. Liz was just talking about the inflation readings next week. If you're trying to determine the Fed's next move, are you looking more at today's jobs report? Are you looking at next week's inflation report?
Yeah, well, I mean, obviously you're looking a little bit at both. The Fed has said that they pay more attention to the other measure of inflation, the one that came out last week, which showed 3.9. But the labor market is the key to the entire slow landing scenario, right? We think if the labor market stays reasonably strong, the Fed can sort of squeeze demand out of the economy gradually, and that will, generate this soft landing. But if the labor market's too strong, which is kind of what we saw today, the Fed's going to have to do more, rates may have to go higher, and then we raise the probability of a sharper slowdown. So we're really in that zone where it's not clear yet. Directionally, we were okay with everything pointing kind of the right way toward a slowdown, but today's labor market's going to at least change the calculus a little bit.
So just to clarify, like for your own current forecast for where the economy goes from here, what are your expectations right now?
Well, we're in the maybe camp for the Fed. I think that after this morning, we're probably in the strong maybe camp for one more hike this year. Obviously, we've got a strong third quarter. The Atlanta Fed nowcast is still tracking about 5% for Q3, but we're in the camp where we think the tightening is going to start to work through on demand, and we've got a slowdown below potential of 2 for the U.S. in Q4 and well into next year. But again, we've been saying that for a number of quarters. It hasn't happened yet.
Yeah, we have a story on the terminal. No recession, and yet companies are still teetering, right? We're starting to see bankruptcies take off. On the consumer level, they're putting a lot more on credit cards. Delinquencies on those credit cards are rising. Delinquencies on auto loans are rising. Student loans repayments are about to kick in again. I mean, are we going to see a soft landing, or does this economy fall into a recession?
Yeah, well, there's going to be some pain on higher rates, right? The whole idea is to tighten financial conditions and slow things down. So we get higher rates. Our credit guys are expecting some uptick in defaults, but it's kind of still in that moderate zone. I think it's really, again, the key of the job market. If the bottom falls out of the job markets and people start losing employment, then you're going to see the delinquencies rise. But now, given where we are in the cycle and given what needs to happen kind of over the next 24 months, I think we're kind of comfortable where it is now, but still early days. We're just starting the deceleration, and this is going to play out for a while. Soft landing doesn't happen in 2 quarters like a recession, right? This is going to be a protracted slowdown, a longer period of subpar growth for the U.S. below 2.
But we saw the Speaker of the House basically ejected for making a bipartisan deal over the weekend. The devil you know may be better than the devil you don't in this case. Do we have another government shutdown, and does that worry you? Does the U.S. government continue to meet its obligations?
Yeah, the U.S. has this weird system. I think we're the only country in the world where you separate the spending decision from the financing decision, so it's kind of set up for maximum drama. Obviously, we hadn't seen a speaker get booted out before, but for us, it's really more of a focus on the long-term debt trajectory, right? Given where we are in the cycle right now, the fiscal deficit in the U.S. is quite high. So what we're hoping is that, the Congress can, get together and put together some sort of plan where we have a declining debt to GDP ratio for a number of years in the U.S., and I think that's really what we're looking for. But again, all this drama in Washington is not helping that outcome.
Paul, great having you here. Thanks so much for joining us. Really appreciate it. S&P Global Chief Economist Paul Grunwald talking to us about the jobs number, the rates situation, and the U.S. government. Coming up, Exxon possibly on the verge of making the biggest deal this century. We'll talk to Stephen Schork next. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
In global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield. You
because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
So you're not selling the Patriots, you're not selling the packaging company. I guess you don't like to sell things, right?
I really don't. We try to create a family environment in everything we're involved in. People want to be part of something that's bigger than themselves.
This is Bloomberg Markets. I'm John Oliphant with Matt Miller. Time now for our Stock of the Hour segment. And we've been tracking the energy sector and specifically Exxon nearing its largest takeover in more than 2 decades as the energy giant seeks to become the dominant U.S. producer of shale oil. The company reportedly in talks to acquire Pioneer Natural Resources and what, Matt, could be a $60 billion deal. And we have increasingly seen these super majors playing catch up to an area that they, about a decade ago, were clearly not as interested in and now have very much, if this deal comes together, this sort of cements that interest which has grown over the years.
Yeah, it looks like the majors weren't as interested. Pioneer, however, was, and now they looked like they were in the right place at the right time. Let's talk to Stephen Shork about this. He's the co-founder and editor of the Shork Report, one of our go-to experts on the oil patch. And Stephen, this is, you know, in shale, I mean, Pioneer is it, right? So if Exxon gets this deal done, how positive do you think it will be in terms of contributing to earnings?
Yeah, well, it's a great move for Exxon, and it's the right way to go in this contentious political environment. So instead of trying to go out and hit home runs, that is, with these mega projects of offshore drilling or drilling into unproven fields where you have years to wait to get any sort of return on investment, by going after the shale patch, you have access to some quick returns at that point. Shale, these wells, they're prolific right when you tap into them, so you get a lot of oil really quickly to the market. Therefore, you're getting a return on investment very quickly, and then they die off. So the acquisition by Exxon will more than double Exxon's position in the field. It will give them access to the most fertile oil producing region in North America, and certainly gives them now a low-cost strategy to access supplies as opposed to waiting for long-lived projects such as, you know, going deeper out into the ocean.
What has happened in oil, Stephen? You know, right now we're looking at NYMEX crude trading for $82.56 a barrel. Last week, somebody bought a barrel for $95.03. You know, why the huge turnaround down?
Well, if they liked buying at 95, I'm sure they really like buying it back at 82 as well. No, it is the volatility that we're seeing in the market. Keep in mind, last week was the final week of the third quarter. So you had a significant run-up in price, little window dressing, as it were, going into last Friday's end of the month. So now we're coming into this month, and you're having kind of that correction, that pullback in price. And really, I do think we did overshoot the market last week, and now we're in that correction phase. So we have had a significant sell-off, one of the largest sell-offs in quite a while at this point. So it just goes to tell you and goes to show you just how volatile the market can be. But Matt, I also want to point out that when we're looking at the forward curve, we're in a situation called backwardation. So when we look at prices, oil prices on a monthly basis, the price for November is higher than the price for December higher than January, so forth. That is a clear telltale that the market is undersupplied relative to where demand is. So we're still looking at a dynamic now. We're in the shoulder month, so demand is at its weakest. Refineries are shuttered temporarily to perform maintenance. But once that refinery demand comes back into the market in November, and we're looking at a low supply situation already relative to demand, you still have the table set for higher prices towards the end of this year and into next year.
Beyond looking at the prices in the market right now, Stephen, a lot of people are looking at the financials for these energy companies. And in Exxon's case, if you look at the free cash flow picture and how things changed last year, the door really opened for the possibility, arguably, to go out and think about these bigger deals, even though they're always interested. Assuming this deal comes together, would you anticipate, because the sort of state of affairs and the balance sheet in the energy sectors have improved, that there could be more activity ahead?
Oh, I think there is. The biggest threat now facing fossil fuel producers in Western countries is access to capital. Some of my larger clients, they're fine. So this cash flow is helping them. They'll be continuing to grow. The problem is going to be with smaller producer. They've already been told by their banks that, hey, you're good. We've got your back for the next couple of years, but 5 years out, we're not going to be there for you. So you're going to see further consolidation as the behemoths go ahead and buy smaller producers that will be starved of capital. So we're going to be looking at a much smaller pool of very large producers over the next 5 years.
And briefly, Stephen, I know you're not a D.C. expert per se, but I wonder what the Washington or the White House reaction might be to a deal like this if it comes together.
Well, judging by their record since going to office, I have to imagine it's going to be quite contentious. And I think they might try to throw up some roadblocks to try to appease, especially going into an election year. So this is a White House that, come on, quite frankly, the president has been to Riyadh. His top people have been to Venezuela, two countries that were, in his words, pariah, and he's asking them to increase production. The gentleman has yet to step into the city of Houston to ask domestic producers to step up. So we're at a situation where we are expressing ourselves to quote-unquote pariahs, and we're shunning our own people. So I think a deal like this is a slap in the face, or they're going to perceive it as to be a slap in the face, and they're not going to react well to this.
Stephen, always appreciate the insight. Yeah, no, thanks for the time. Stephen Shork, editor of the Shork Report, joining us, and we'll keep tabs on what happens on that front. Coming up, why investors are tuning away from Lucid, the latest on the electric vehicle player. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg.
This is Bloomberg Markets. I'm John Ehrlichman along with Matt Miller. Time now for what it's worth. How about $338,000? Electric car maker Lucid is set to burn about $338,000 for every vehicle that it makes this year. That's according to Bloomberg Intelligence estimates. Analysts' average 2023 sales estimates for the company have come down nearly 50% over the last 6 months. And Matt, we've been watching the stock under pressure, getting to an all-time low this week. Introducing lower-priced versions of high-end vehicles. I think it gives people a bit of uncertainty about whether that's being done to grab market share or because the consumer demand is waning.
Yeah, and in fact, I think there's a real question about demand right now for electric vehicles in general. Okay, Lucid may be a different story because they're such expensive vehicles. The amount that they lose per car, I think, is shocking on an, I think, EBITDA level, according to Joel Levington from Bloomberg Intelligence. But you've seen today Tesla lower prices again, which brings into question how much people really want EVs or how much maybe the EV market has already been saturated. Early adopters have gotten their cars already, and for regular people, it may not be the first choice. I got an email this morning from Hertz saying, if I'll rent an EV, they'll give me a free day now and a free day later, which makes me think maybe they're not renting out as many as they would like to. At the top of the hour, at 2 o'clock, we're going to hear from United Auto Workers Union President Shawn Fain for an update on the UAW strike against Ford, General Motors, and Stellantis. It's become somewhat of a Friday tradition, although today at 2 rather than 10 on Facebook Live. Definitely stay tuned for that decision because used car prices continue to climb, inventory continues to drop, and workers, at least many of them, are still on strike. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Too hot to handle, too cold to hold. Live from Studio 2 here in Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to the closing bell here in the U.S. You take a look at the U.S. equity market right now. We've actually switched from losses to gains. Haven't seen that in a while. The S&P 500 absolutely soaring right now, up 1.2%. Even more dramatic if you take a look at some of your big tech names. The NASDAQ 100 up by 1.6%. That's even though the bond market has held its losses, of course, after that blowout jobs report that we got this morning. 10-year yields currently up about 6 basis points or so. We got above 480 earlier. We've come down a little bit from that level, and that's sending no haven bid into the Bloomberg Dollar Index. You can see currently off by about 0.2%, Romaine.
Yeah, all right. Well, let's talk about what we learned this morning here, because the market's, of course, still in search of that pillow top soft landing. They got a better glimpse of the terrain underfoot, Katie, and the floor is lava. 336,000 jobs created in the month of September. That's more than double the average of economists' estimates. And in fact, not a single economist we surveyed even came close to getting that number right. The high estimate was 250K. An upward revision to the August numbers, along with the recent pickup that we saw in those job openings earlier this week, that really does add to the case that the Fed can actually unpause and deliver another rate hike to ensure that inflation is indeed under control. Now, the market did sell off hard, both in the pre-market and early in the cash session, but it really only took a few minutes for the dip buyers to rush back in. The S&P flipping from a 1% loss to a 1% gain on the day, while the 10-year Treasury yield surged 17 basis points before pairing about two-thirds of that advance. But here comes the asterisk. The multi-week bond sell-off has actually been obscuring the fact that quite a few investors have been buying government debt. In the week through October 4th, Treasury funds took in $4.6 billion, a 34th straight week of inflows, according to Bank of America. Strategist over there, Michael Hartnett, saying, quote, "No capitulation here." Equity funds even took in $3.3 billion in inflows, though Hartnett does advise actually selling the S&P at the upper half of the 3,600 to 4,200 range. A range, of course, we're above right now. Hartnett convinced that the bear market has, in his words, some unfinished business. But now here's the funny thing, Katie, as the jobs data may have actually made the Fed's decision a little bit easier towards the end of this month. And in fact, a lot of traders right now are starting to make new bets here that we are going to get a hike. We actually saw that number go up on the on WIRP right after the report.
And of course, as hike bets go up, job cut, or rather rate cut bets have come out of this market a little bit. Right now, you're looking at the 2024 outlook, and you can see that back in July, as recently as July, well over 150 basis points of cuts for next year were priced into that market. That has eased and eased, and right now, about 69 basis points are priced in, so a little under 3 cuts priced into that outlook. But of course, as you can see, that has been easing for some time. And of course, as this outlook changes, you've seen really rampant volume if you take a look at the bond market. I want to highlight TLT in particular. This tracks treasuries over 20 years, and you can see that TLT, the volume has absolutely been surging really steadily throughout 2023, and now we're reaching the highest levels in more than a decade. So, of course, Romaine, as bond traders try to figure out where exactly the Fed is going, where the ceiling on yields might be, you're seeing that reflected in trading volume as well.
Yeah, we certainly are here. Let's kick things off to the close here with Tom Porcelli, PGIM's fixed income chief U.S. economist. And I look at this number here, Tom, 336,000. I don't think anyone could sort of quibble with that is a strong showing. I'm wondering if you could kind of look under the hood for us, though, and give us a sense as to whether 336 is really reflective of the strength of the job market, or should we pay more attention to, I guess, the trend line that we've been seeing for the last few months, which is effectively to the downside?
Yeah, I absolutely love how you frame this question, because I think it is important to look under the hood. Look, by any standard, 336,000 is a big number. But when you go in and really look, what you see is that there's really been one category that's been doing most of the driving. Today it had some help. There were two
population, post-COVID, we're trying to sort of build that back. And then leisure and hospitality. Those two categories collectively, if you strip them out of private job gains, the private job gain wouldn't have been 262,000. It would have been 100,000. That's a big difference. And I think if you do that analysis over the course of the last year, what you'd see is that the sort of the steady slowing in job growth really continues. Now, look, I want to be clear. That's not necessarily a bad thing. In fact, for us, it sort of fits very snugly into our soft landing narrative.
Yeah.
But I wouldn't want the market or anyone, for that matter, to really overreact to what seems like a really strong number. Because again, I think when you sort of drill in a little bit, a couple of categories really explain it.
Well, another component of that I'm hoping you can kind of explain for us is this disparity that we've seen in the last few reports between the household survey portion and I guess basically the business survey. So basically, for our viewers who don't know, you have one component of this where we're getting the data from the companies and others from households, and they seem to be telling two different stories.
Yeah, they are. And look, here's the reality. Both of those surveys can be very volatile. That is just, they don't always align. So I wouldn't make much of it. Again, I do think, though, when you're sort of at, this sort of potential turn, I think it's not unusual for that volatility between the household and the establishment survey to look even more sort of disparate. So actually, in that context, I would argue that it's pretty consistent with where we are in the cycle, which is to say, we're slowing down here.
We're slowing down here, and I want to talk about how what we're seeing in the bond market, specifically when it comes to real yields, is actually translating through into the real economy.
Yeah. So look, I think it's a really, again, another important idea to consider. And so I want to take this angle on this question. I think when I think about yields, so 10-year yields are at 4.77 right now. I think what we have to keep in mind is I think that the Fed. Look, you have to give the Fed a ton of credit. I think that they did a great job with really sort of pressing the idea of, we want to be higher for longer. And I think the market completely bought into it, fully. But I think, and this gets to what Mary Daly was talking about yesterday, and I think her comment was so spot on. Financial conditions tightening really reduces the need for any additional hikes from here. And so when I look at the market's reaction now, just sort of nominal reaction, I love, and I think the market is smart to have taken back most of the knee-jerk reaction that we saw on the back of this. So look, I don't doubt for a second, and I don't know many people that do, that yields are supposed to be higher relative to where we were pre-pandemic.
Yeah.
And I think that's what we're seeing, whether it's in real yields or nominal yields.
Yeah.
That's what we're moving.
All right, Tom, I'm going to have to leave it there. Great to catch up with you. Tom Priscilla there over at PGIM here, helping us kick us off to the close. We're covering a lot of stories here as we start off the show, including a relatively historic launch that you're watching right here. Amazon's Atlas V rocket just launching, carrying the first of two satellites going into the air. Of course, this is part of a much broader plan by Jeff Bezos and his Project Kuiper team to launch more than 3,000 satellites, of course, that will basically engulf the Earth here and provide, at some point, internet coverage to all those mere mortals down here on Earth. You're taking a look there at that rocket, now firmly off the ground, heading out into space with its payload. We'll have more coverage coming up here on The Close. This is Bloomberg.
Closed loop guidance is in. Everything's looking good. Coming up our next throttle phase, we'll be limiting the vehicle acceleration to 2.5 Gs for payload bearing jets. Holding acceleration at 2.5 Gs.
I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Right now, you're watching the control room here of a long-delayed effort by Amazon to launch thousands of satellites into space that would effectively provide internet coverage across the Earth here. We just saw the liftoff here of the latest rocket here that was supposed to launch more than a year ago, carrying 2 satellites into low Earth orbit, again, as part of a broader ambition by the company to basically blanket the Earth's atmosphere with about 3,326 satellites in total. We'll try to get you some additional details on that as soon as we get them here. But we do want to go back to the big story of the day, and that, of course, is the big jobs report and the market reaction to it. Jerome Schneider, Managing Director and Head of Short-Term Portfolio Management and Funding over at PIMCO, joins us now here in Studio 2. And Jerome, let's get right to it. The number came in. I don't think anyone can say it wasn't a good number. Is the number, when you overlay it with the other data we've gotten, going to be enough for the Fed to make a meaningful case to the market that it is indeed going to follow through with that one more rate hike this year?
Well, I'm not sure necessarily that the Fed has to make a case to the market. We've seen the market clearly mark to market to the Fed's outcome at that point in time. One of the consequences of the data today, it probably puts at least into scope the consideration of another rate hike, given how strong it was. And although the household number at only 86,000 was a little bit more tempered, I think what we are seeing is several things. One, inflation, average hourly earnings is a little bit more in check than people had expected, but not exactly in the landing zone that the Federal Reserve wants. Number 2, job growth remains strong, and we've had that 2 data points this week, the JOLTS surveys being a little bit stronger than people expected, and again, the headline number today being stronger than expected. What we need to ultimately recognize is that this is a methodical process where the current landscape might take some time to work itself out into the marketplace. And as a result, we have to realize that this is a slow and bumpy deceleration that goes on over a period of time. It's not going to be an immediate process that happens. And so one data point is really being reacted to by the market as opposed to the Federal Reserve. The Federal Reserve is going to be at this higher point for a prolonged period of time, as long as they can digest what is going to happen in the medium term. Again, wage pressures are going to be the focal point of 2024.
Well, I'm curious then what you make of some of the market reaction. I mean, as we speak, we're talking about stocks at session highs, and yields, which at one point were up 10 to 15, 17 basis points, have also come down a little bit. So now you're seeing buying in stocks and you're seeing a certain degree of buying in bonds. What is that telling us?
Well, I think that it says that the market is reflecting that this is going to be a process. The knee-jerk reaction at higher yields is simply reacting to the headline. We see a lot of quantitative behavior in that. But longer term, really, investors are going to have to rationalize 2 things. What is their economic outlook? How does it reconcile to where their investment process is? How do investors rationalize a higher cost of capital environment? And that also includes higher real rates, inflation-adjusted rates. And while on one hand that creates opportunity for fixed income investors, for capital deployers, that's also a rational examination that they have to do to think about how they want to invest for the future. And that might actually be more delayed or deliberate over periods of time. And so for an investor point of view, where does this create today? Well, it creates an opportunity set where for a decade or more, investors have really focused on the capital appreciation side of the investment metrics. But now it's actually on the other side of total return, which is income generation and yield. And so whether you think the proper yield for the 10-year note is 4.50, 4.75, 5%, or even higher, what we are in this environment today is that the yield and income that is within the yield curve is actually quite attractive, and more importantly, really a lower volatility contributor to returns than what we witnessed over the past decade or so.
Well, to that last point, a lower volatility contributor to returns, I don't think it's lost on anyone that the bond market has been way more volatile than the stock market this year. And when you think about, a lot of your traditional portfolio setups, your 60-40, your risk parity sort of portfolios, a lot of people would argue actually it's the fixed income side that's adding volatility right now.
Yeah, and without a doubt. And part of that has to do with the continued recalibration of expectations of where future rate hikes are. But when you survey the landscape where we are today, we're reaching the crescendo of those rate hikes. We're reaching the crescendo of a recalibration of term premiums at this point in time. And sure, the slope of the 2-year versus 10-year can continue to recalibrate closer to a positive level. But fundamentally, what we're finding is that most of those portfolios weren't necessarily at 60-40. They were actually something about 35-65 in favor of equities. Now we're finding that the added income is putting people to dip their toes in the water for the front end of the yield curve initially and then move out and add some interest rate exposure. What we are finding is the balance of people trying to rationalize that is coinciding with the Federal Reserve's perhaps last or near last action to tighten monetary policy for the foreseeable future.
And I would imagine if we really are in a higher for longer environment, if we don't get the first Fed cut for however long, that only boosts the appeal of some of these very short-dated instruments.
Absolutely. And I think one of the consequences is investors have a mindset of 2022, which is they see rates move higher and they recognize that there's a capital loss potentially with that. But what we are today is that the yield and income from the yield curve predominantly creates a large amount of cushion. So for example, a front-end yield, a portfolio will yield about 6.5%. And if a year or two of interest rate exposure, that gives you a lot of cushion for the Fed to go if they should decide to move higher, significantly higher perhaps, to not produce a negative total return. So fixed income landscape is dramatically different clearly than a year or two. Perhaps that's an understatement, but what we rationalize that is that the environment for potential rate hikes in the future, substantive rate hikes in the future, is somewhat diminished at this point in time. Now, 2024, 2025 obviously reshuffles the cards a bit, but what we think in the foreseeable future is that Fed remains on hold, and perhaps they need to rationalize inflation as the headwinds to continue to reduce inflation become slightly more than people expect at that point in time.
In that time frame, you think investors will stay committed to whatever side of the trade they're on? I guess this is more of a liquidity question than anything else.
That's a great question. Yeah. And I think that commitment goes hand in hand with understanding there's a lot of risks in the world right now. We clearly have just meandered around the risk of a government shutdown. We have geopolitical risk. We have obviously higher rates. I think that what we really find ourselves in is a liquidity discussion where investors want to be very cognizant of liquidity, not only from a defensive metric, knowing how much they have in the portfolios and how much cash they can deploy, but also an offensive metric, meaning that when those opportunities reveal themselves, they want to be able to pivot very quickly to do so. So that's one of the reasons you see so much cash sitting on the sidelines at this point in time. But there's a big difference in that regard. The big difference is that being in money market funds, being in T-bills, comes with a liquidity cost, meaning you're earning just basically the fixed rate at the Fed, as opposed to earning some of the higher yields that are in the front of the yield curve by being in the 1 to 2 year space, and that's about 6.5% yield. Ultimately, I think this is an investor situation when you think about the entire landscape, the balance of situation is favoring income for the foreseeable future.
Jerome, always great to talk to you. Really appreciate you coming into the studio today. Jerome Schneider there over at PIMCO. We're covering a lot of stories here as we kick you off to the close, including the auto workers strike here in the U.S. We just heard from Sean Fain, the head of the United Auto Workers Union, saying that he plans to actually spare Ford and Stellantis from any new strikes this week here. There's a lot of volatility in the shares right now with Ford and GM spiking higher. Two interesting notes here that he talked about here. They are considering a plan to strike at a GM SUV plant in Arlington, Texas, but he did say they've made progress with GM on talks enough that GM has agreed to place its EV battery making under a master agreement. Again, this is coming from the UAW, so we still need to confirm this with GM itself, but that would actually be a very encouraging development than should it be true. Fain says that the UAW was ready to strike that GM plant before that battery deal. We'll keep an eye here on what Sean Fain has to say, as well as the response by the automakers. A lot more coverage coming up here on The Close. This is Bloomberg.
And where we are now. Looking at wages, our first wage proposal from the companies was a 9% rate.
Obviously, we're trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
All right, continuing our full coverage here of a big jobs report and a big reaction in the markets to it. Let's bring in Chris Brightman, research affiliate CEO and CIO, to talk a little bit more about this. And I do want to start off. I understand, Chris, that you have sort of these knee-jerk reactions anytime you have the reports, but to see the sort of flip-flop in markets from, basically right at the open of the cash session to really just a few minutes later, we're at session highs right now on stocks and right now near session lows when it comes to Treasury yields. Where do you think the market right now is trying to price in?
I don't try to read too much into one day's choppy market. You say we're at the session high for stocks, but it looks to me like at the middle of the year, we hit a high in the stock market, and we've been in a downtrend since. And since the end of June, we've had a 100 basis point plus increase in the 10-year yield. And the economic impact of a 100 basis point increase in long-term rates, and that's a term premium increase. That's not a short end issue. That's a year, 18 months to get that into the economy. So we're very concerned and becoming increasingly defensive.
Oh, just real quickly though on the term premium, because I'm glad you brought that up. Why don't you think we've actually seen more of a term premium? Is that sort of a function of the sell-off itself, meaning are traders and investors sort of driving that, or is there something more structural happening?
Well, as I said, I think we've had a pretty meaningful increase in the term premium. We've got, moving towards a flatter yield curve, but a flatter yield curve with long rates rising quite a bit.
Oh, I gotcha.
And we've got, to oversimplify, we've got close to 5% nominal interest rates across the curve.
And when you think about nearly 5% on the 10-year, on the 30-year, is that attractive to you? Is this a time to really leg into duration, or do you think there's more pain to come?
Yeah. Picking up on some of the things that your last guest, Jerome, said, I think that the yield component of returns available in the front end everything from money market funds, possibly out to an aggregate bond position, but particularly the 1 to 2 to 3 year opportunity is awfully attractive given the risks we're seeing facing the equity market. I mean, the difference between the earning yield on the equity market and the yields offered on the bond market are remarkable. And positioning longer out the curve with duration, I think, is complex, because while that might prove a profitable trade, as and if we trend into a recession, which I think is likely, I think the longer term risks are significant. Meaning, look, the federal government of the United States is not going to be able to pay 5% interest rates. The growth rate of the economy is just not going to allow 5% interest rates. And with our debt to GDP over 100%, with us running enormous government deficits during a strong economy. Think about what kind of deficits we're going to be running if and when we're in a recession. We've got some very long-term risks that make me hesitant to go too far out the curve.
And Chris, there's a lot to dig into there, but we only have about 30 seconds left with you. To pick up on that point that it could be a profitable trade to go out the curve if there's a recession, do you think that's what it's going to take to meaningfully send the yields lower?
Yes, I think that to get yields lower, we're going to need a recession or just the market discounting that we're going into recession.
All right, Chris, really appreciate your time today. That is Chris Brightman of Research Affiliates. You take a look at this stock market, though, Romain, and you wouldn't know how we started this morning lower, but now you can see the S&P 500 flip to gains and then some.
Yeah, and this is really a cross-asset story. Of course, you saw the same flip-flop going on in the yield space, the same flip-flop on the VIX, and a similar flip-flop in the commodity space.
Absolutely. You're looking at crude oil up by 0.3%. We're going to get into the why. From New York, this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is the countdown to the close. A lot of volatility today in the equity markets, even more volatility going on in the bond markets. The commodity space hasn't been left out of the equation either. Abigail Doolittle, she's standing by right now with our commodities close. Abigail.
Yeah, so we have a nice rally for commodities. Overall risk rally with commodities and stocks going higher. Natural gas up 5.6%. Traders really betting on the cooler weather coming, unfortunately, next week. Silver up 3.6%. The dollar easing off of those highs, so giving some of the precious metals a chance. Copper up 2.4%. Now, earlier, it had been on pace for its worst week of the year, but because of this gain, that's no longer the case. And then sugar gaining 2.2% as El Nino fallout has hit both supplies, crops in production in India and Thailand. But of course, on the week, similar to stocks, well, it depends on what index you're looking at, because now some stocks are higher on the week. The Bloomberg Commodity Index, it is down on the week, heading toward its worst week since August. And then we also have oil down on the week. This is really the standout story, of course, on the week relative to commodities, down 8.8%, back at a 82 handle, as investors are simply not buying, I guess, into the OPEC cuts, sustaining that oil price. A real reversal from last week's high, Romaine.
All right, Abigail, thank you. And let's pivot to one of the biggest stories, not just in the commodity markets, but overall markets today. That, of course, is ExxonMobil nearing a deal to buy Pioneer Natural Resources. Now, if successful, it would be the largest takeover for the energy giant in 2 decades. Bloomberg's Alex Steele is all over the story. And Alex, provided there are no complications, this actually closes. What does Exxon get from Pioneer?
A lot of rock in the Permian. So the deal with Pioneer Natural Resources is it is one of the biggest independent shale players. And what that means is you want a big chunk of rock that you can drill down and drill sideways. Like, that's the holy grail. And they have a lot of it in super, super good rock areas. And Exxon gets that. It has its own, which is great, but in order to run the replacement cycles, you need to keep your oil production high enough to replace the oil that you're losing every year. You really need more. And this is where they get the more.
What's sort of the payoff, though? I mean, we're talking about proven reserves. As Exxon actually, well, I mean, this is a dumb question. I assume they've done the math here, because when I look at the purchase price, I do wonder about them recouping this and how soon.
Funnily enough, I mean, someone asked me that too. I'm like, I'm hoping they looked at the numbers.
I hope so.
But let's assume that they did.
Okay.
2 points to that. One analyst was saying that the high quality inventory for Pioneer is a 10% return at oil sub 50.
Okay.
So, like, that's really good, considering that oil still has an 82 handle, as Abigail was just saying.
Yeah.
However, to your point, Exxon did buy XTO Energy, which was a nat gas play in 2010. They paid a boatload of money for it, and then natural gas prices crashed. And that literally has been emblematic of not doing M&A well. Like, analysts have said that. So you're totally right to bring up the price point, as we know it as 60 bill. Also, I think the question is, does it say we're at a peak Permian? Or are we close? Are we running out of the super easy oil to drill?
And I thought we were.
Well, I think that this raises more of the question.
Okay.
There are productivity issues for all the shale players over the last couple quarters. That seems to have stabilized, but does raise the question, if the easy stuff has been drilled, you need the big guys to come in with bigger cash flow and big stuff and big guns and big technology to get even more out of the rock.
So Exxon is big, potentially getting even bigger here. When we talk about how big it could actually be if this acquisition goes through, I mean, who do we compare this new company to? How big would this be on a geopolitical scale even?
So I think the total would be something like back of the envelope calculation, like 1.2 million barrels of oil a day. That's more than some OPEC numbers. And that's from shale. Like, that's just the shale play. And then you add on all their other plays. So it would be enormous. It would surpass Occidental. It would surpass Chevron within the Permian Basin. So, yeah, it would be huge. And it brings the question, like, is this going to be a wave of M&A for some of the big guys in the shale space to get this scale that they really need going forward?
All right, Alex, Steele, of course, you can catch her every day here on the European close, of course, also knows everything there is to know about the commodity space, keeping the conversation going right now with Bill Smead, founder and CIO over at Smead Capital Management, multi-billion-dollar fund with about 25% of the portfolio in energy and gas names like Conoco, Occidental, Apache, and Devon Energy. Exxon, not a major holding, Bill, but I am curious as your thoughts here about this deal for Exxon and the potential accretion to earnings.
Well, first of all, if you're going to get demonized for drilling new holes in the ground, why wouldn't you buy existing streams, many of which the drilling's already been done, to extend the life of your business? See, look, I think about all of this based on how long we think it's going to take to transition completely to cleaner energy. If you're a person that thinks we could transition in 10 years, the oil and gas business is going to end up surviving on the fact that they provide 40% of the electricity through natural gas in the United States. And that's only going to go up because the other sources of electricity in the United States, other than renewables, are declining. Coal-fired is going to disappear, et cetera. So the price of electricity is going to go up a lot. How do you produce electricity? The number one way now is through natural gas. Well, how do you find natural gas? Drilling for oil in the same rock that Alex is talking about.
Yeah.
So it's kind of a wonderful setup where if you try to drill someplace new, you're going to get demonized by the body politic, right? They hate you for it. Everybody hates you.
Yeah.
Or would you rather take some existing business? And by the way, the spreads between Exxon and Chevron, the two popular, highly liquid, very large companies that have massive passive ownership, their shares trade way more expensive than the rest of the industry. Therefore, they are the natural acquirers, and they are also interested in extending the life of their company.
Well, that's what I'm interested in. I mean, we should point out, Darren Woods, who runs Exxon, has been pretty vocal about this now for the last couple of years when it comes to the energy transition and the idea that that transition is going to be a lot more elongated. And, well, the oil and gas companies can't just exactly sit and wait for that to happen. But I think what he also has said, and I'm sure you know this, Bill, is that there has to probably be some sort of consolidation. I know Pioneer Natural, that seems like a natural fit, pun intended. But when you look across the landscape here, do you anticipate we could be seeing more deals like this?
Yes. In fact, I just read a quote from 2 years ago that Shell, recognizing how you want to talk about hostile to oil and gas in the United States. I was in Europe 2 weeks ago for a week of business meetings, and it is 5 times more hostile in Europe. So Shell is looking to pivot their company away from Europe toward the United States. So here you go. There's a huge company. So thinking about the timing and buying Mobil, right? So Exxon bought Mobil in 99.
Yeah.
Well, within 12 months, BP bought Arco back then, right? So there's Shell. There's Chevron, which has a huge capitalization, attempted to buy Anadarko. What was the best assets in Anadarko? Permian. Who owns Anadarko? Oxy. Why was Anadarko worth $33 billion to Chevron? In 2019, it's $65 a barrel, and now the entire Oxy Corporation, both Oxy and Anadarko, trades at like a $55 billion market cap, with $33 billion of that Chevron was willing to spend back in 2019. So there's all kinds of possibilities. Warren Buffett's the largest shareholder of both companies. It wouldn't bring a tear to his eye to have those two end up in one shot. So, and then down the line, Devon Energy, Apache, Oventive has great. These people all have great assets, and everybody hates them, and their stocks are half the price in terms of various, price to earnings, price to cash flow, price to free cash flow.
Right.
They trade at huge discounts to these more highly thought of, larger liquid companies.
Well, Bill, how do you approach that as an investor? Because looking at your portfolio, about 25% is in oil and gas companies. If we're entering into a period of maybe more M&A in the industry, how do you structure your portfolio around that?
Well, we ride our winners to a fault. So our largest position is Oxy. Unfortunately, what used to be our largest position, Continental Resources, got taken private by the founder back in late 22. So we had to replace that large position and our position in Oxy and Conoco and add to it these others. But these others are just screaming for attention, either natural stock price appreciation or an acquirer to come in and pick them off.
All right, Bill, really great to catch up with you. Appreciate your time on a day like today. Our thanks to Bill Smead, of course, Smead Capital Management founder and CIO. Now, still ahead on the close, the fallout from data breaches on MGM and Clorox could lead to more growth opportunities for the software security sector. Next, we'll speak to one analyst about the growth trends he's seeing for companies like Zscaler and Datadog. That's next. This is Bloomberg.
Names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
The top names in global leadership are on Bloomberg.
Right from the start, I decided to open our border and to take in millions of refugees from Ukraine. We believed, and we still believe, that it is necessary, and we try to serve as neighbors should do.
If we want peace, if we want a negotiated outcome, strengthen Ukraine on the battlefield, because that's the only way to convince Putin that he will not win on the battlefield.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Disney. Bernstein's starting coverage of big media companies rating Disney outperformed, setting the price target at 103, bullish on the growth story there, primarily because of the direct-to-consumer streaming business, which the analyst says is the only credible challenger to Netflix. Shares of Disney having a pretty great day, up about 3%. Next, let's take a look at Eli Lilly. Bank of America raising its price target to a street high $700 a share, keeping a buy rating, saying that the move stems from the recent frenzy over weight loss and obesity treatments, which the analyst says is going to be the value driver for Lilly and its Mounjaro drug. Shares of Lilly up almost 4% on the day. And finally, AES. We're basically a power plant operator here, getting a downgrade down to neutral over at UBS, with the price target being slashed almost in half to a street low $13 a share. Why? The analyst putting the blame on higher interest rates, saying the higher cost of debt financing is going to limit growth opportunities for the utility company. Those shares down 1% on the day, and those are some of our top calls. We do want to stay in the sell side space here and take a little bit of a closer look at some of the high profile cyber attacks that we've been hearing about on casinos, and of course, as we've been talking about all week long, on Clorox. That really is highlighting the need for upgraded security software, and it could fuel demand for companies like Zscaler and Datadog. Piper Sandler recently upgraded both to outperform, and joining us right now is a man behind that upgrade, Rob Owens. He covers the security and infrastructure software sector for Piper. And let's just start off here, Rob. I mean, there's always been this talk here about the importance of cybersecurity components for companies and for individuals themselves, for that matter, too, here. What's different now about the pace of spending and how that could potentially benefit names like Datadog and Zscaler?
Yeah, Romain, I think we need to look at the pace of innovation, to be honest with you. Shift to cloud, we're now contemplating Gen AI and what that means from a productivity standpoint, but what does that mean for the bad actors that are out there? And cyber, unfortunately, is always playing catch up. And I think it's been over the last couple of months with these high-profile ransomware attacks, whether it's the casinos, you mentioned Caesars MGM, or even Clorox, just what the cost of insecurity is. In a lot of cases, they pay the ransom, and hopefully nothing bad happens. Or in MGM's case, they try to rebuild their systems. So, as we look forward, we think that security is paramount to everything that organizations are doing from a digital transformation standpoint. And upgrading Datadog and Zscaler is partly that. It's also partly that we think that things are starting to get better for a lot of these tech companies. Stability was a major theme in the second quarter. We think that's going to be a major theme in the third quarter. And so as we start to look forward from an investment standpoint, these are two very disruptive, high-profile names that we believe investors should own.
Well, given the importance of cybersecurity, especially right now, do you think either of these names could be M&A targets? I mean, I think about Cisco buying Splunk, for example, which of course is a competitor to Datadog. Do you think that we could see something similar play out here?
We think a lot of a lot of these cyber companies are potential targets in the space. Security, you've always seen it kind of consolidated by tech bellwethers. Microsoft has a big presence. Cisco has a big presence. I mean, historically, IBM has played in the space. Oracle has played in the space. But I think what we've seen just in the last decade is the emergence of a lot of these best-of-breed companies, whether it's a Palo Alto Networks or CrowdStrike, Zscaler to that end. Datadog plays a little bit more on the application side, whether I'm giving you information about the infrastructure your app's running on, how your app is running, but there also is a security play there as well. So are they targets? I think a lot of this space could be a target potentially for M&A. Honestly, just given the dynamics around the problem, given the growth rates, and given this is a highly profitable space as well.
Highly profitable, but even still, I mean, you think about the revenue growth deceleration that we saw over the past couple quarters for Datadog. How confident are you, especially going into 2024, that will recover?
Yeah, and that's part of the call here relative to Datadog. They talked about some of those early cloud optimizers effectively improving, and they saw sequential improvement back in the June quarter. Some of the different early indicators we look at in terms of web traffic and other trends, as well as looking at DevOps in general and what a lot of the adjacent companies to Datadog are saying, I think we're seeing a basing here. So as we look at 2024, and obviously coming out of the third quarter and into the fourth, the focus will turn to where 2024 estimates are. We feel pretty good that 2024 should be a reasonable year for these companies, and we might start to see some acceleration in these models.
I am curious as to why we haven't seen maybe a little bit more consolidation in this industry, Rob. Is just the structure of it, does it lend, does it make it more favorable, to have kind of a broader group of companies out there operating in the space at a smaller scale? Or is there an argument to be made of maybe folding some of these companies into some of the larger software names?
The answer is yes to both questions. I do think you see consolidation, and naturally what we saw was kind of intra-domain consolidation, where network security vendors acquired all the network capabilities, endpoint security vendors acquired all the endpoint capabilities, identity doing the same. And so you've seen that out of Palo Alto and Fortinet, you've seen that out of CrowdStrike, you've seen that out of Okta. Is anyone bridging the gap kind of cross-domain? Yeah, we are starting to see that, because I think in large part when we think about extended detection and response, or taking signals from all the different inputs to detect breach, to detect threat, to detect where vulnerabilities could lie, we will start to see that happen. Now, consolidation is playing out, and I think that we look at it, unfortunately, just through the purview of public companies. Mind you, there's 2,000 to 3,000 security companies. It's been one of the largest invested in spaces over the last decade. And so it's not unusual for a lot of the larger companies to be making acquisitions every quarter. They're just very small in nature. And so they can leverage the platform that they have, the go-to-market capabilities that they have. But from a bigger consolidation standpoint, yeah, I think we're going to continue to see it play out. And we'll also see the emergence of new best-of-breed companies come to market.
All right, Rob, going to have to leave it there. Great stuff. Rob Owens over at Piper Sandler. A closer look at Datadog and Zscaler. Both names having pretty good days. In fact, Datadog having its best day today, going back to early May. Coming up after the break, we're going to take a look at a lot of activity going on in the shares of GM and Ford. We're learning that the United Auto Workers may be providing the automakers with a bit of a reprieve, as we're learning that they are finally making progress on some of the labor talks. That conversation coming up after the break. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field, because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
I wish I were here to announce a tentative agreement at one or more of these companies, but I do want to be really clear. We are making significant progress. In just 3 weeks, we have moved these companies further than anyone thought was possible.
Well, that was UAW President Shawn Fain speaking just moments ago. And for more, let's bring in Bloomberg Detroit Bureau Chief David Welch. And David, this is the first time in 3 weeks that we haven't actually seen the strike expanded necessarily, but there's still a lot of distance here.
Yeah, I think there is, but it's also probably the most positive that UAW President Shawn Fain has been. I think the big breakthrough, in fact, point. He said the big breakthrough is that General Motors has agreed to some sort of foundation that will bring future battery workers into the UAW's master agreement, which is what they're working on right now for the next 4 years. No specifics on it in terms of pay or compensation or how it's going to be handled, but it's a pretty big concession because automakers are worried about the profitability of electric vehicles going forward, and they're going to be paying higher wages for the workers who make the battery cells that go into them.
Well, I mean, this does appear to have been one of the big sticking points, and I guess the fact that we're learning there's been some sort of commitment by that, at least with GM, is certainly encouraging. What about some of the other big issues, though, David, that we know were on the table here? Have they made progress on any of those?
It sounds like they have on pay. Ford has upped its offer on pay raise to 23%. The other two companies are still at 20%, but they were all stuck around 20% for the past few weeks in terms of offers. So it sounds like Ford's budging there, and the others will probably have to follow. Pensions are the one issue I think he didn't talk about. It's still outstanding. There's still a lot of back and forth on that. I don't think they'll go back to these defined benefit pension plans that were a thing of that, I go back to the 90s when steel and rail companies went bankrupt, and later GM and Chrysler did, with pensions being one of the big liabilities. They're not going to want to go back to that, but I think the union will get some sort of enhancement to the 401k plans. But I think that's one of the big issues on the table. There are always a lot of things around work rules that do cost the companies money, that they're less of a headline item, I should say, but they are important in these agreements. You got to remember the UAW contracts are 600 or 700 pages. So there's a lot of stuff in there. Yeah. But those are the big issues, and it sounds like in terms of pay, in terms of cost of living, and now battery plants, there's progress on different fronts of the three companies on all of these things, to the point where the union doesn't believe they have to expand this.
All right, David Welch, our man out there in Detroit, keeping an eye here on the United Auto Workers strike. The latest news out of Sean Fain saying the progress has been made, at least with regards to GM and its commitments here to the EV transition. We should point out shares of GM and Ford spiking here in the afternoon, Katie Greifeld, as we head towards the final hour of trading. And the broader market, of course, has been spiking as well, much, I think, to my surprise. I don't know about yours.
I was a little surprised,
okay,
I have
I'm
to
glad
say.
I'm not alone.
When I saw futures move after the minutes after the jobs report, I was like, okay, this makes sense. You have bond yields up, you have stocks down. And now I'm not quite sure what the narrative is, but man, what a strong day for stocks.
Yeah, absolutely. You're talking almost 2% gains right now on the NASDAQ, 1.5% on the S&P. Now looking at what's going to potentially break that weekly losing streak that we've been on. Yield still elevated. We should point that out here. 4.78 on a 10-year yield, and NYMEX crude slightly higher as well.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. The top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, next fall. But then our take was, that's great. You can have these amazing giant general models. What would be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together? and have those models working for you that you own.
Right.
These models like really talented graduates that occasionally went a bit weird, called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet.
Mm-hmm.
But you can train them yourself, or you can just show them some examples, and they learn very quickly.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
It's about 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Let's get a view from the top here on this Friday afternoon. A view from the top that looks a lot different from what we saw on Friday morning. We got that jobs report earlier today, and it looked like we were headed for a pretty big sell-off, and that flipped big time, Katie.
I knew that there was going to be volatility after the jobs report. I wasn't expecting it to the upside in the equity market. I'm not quite sure what the narrative is here, Romaine. Maybe it's just Friday trading. Maybe it's something else. But yeah you're looking at quite a strong gain for the S&P 500 right now.
And we should point out, some people have been advocating that the sell-off had kind of gone a little bit too far, too fast. And so I think there are some dip buyers here. Even if you think the market still has a little bit more room to the downside, I think longer term, most people think that we could see a material increase, at least heading into next year. So if you see a bargain like that, why not pick it up if you're a longer-term investor? I do think it's interesting to see the moves in TLT. So you are seeing that in the red here on the day, and that has still been the story. So we should point out, even with the flip-flop, if you will, in the Treasury space, this is still a sell-off that we're in the middle of.
Something to rely on, and it's the bond market. And I mean, to that point, when it comes to the stock market, even with the sell-off that we saw in September, it's still been a pretty resilient market. We're still up 10% on the year, which isn't too bad.
Yeah, absolutely. 5% though yields on the 2-year yield, pretty much 5% across the board here on the long end of the curve. Flip up the board real quickly because we're heading into earnings season, believe it or not. And of course, that starts with the big banks, but there should be a big focus on the small banks right now, because when you talk about credit card delinquencies, on average, they're not doing too bad. That's the line at the very bottom of your screen. I want you to pay attention to the line at the top of your screen, because those are the delinquencies specific to small banks. And this is a big concern. Dick Bobet and a few others have been raising this issue here, that the big crisis that we had earlier this year with the regional banks hasn't quite completely played itself out.
Yeah, I see a red circle on that screen, and that usually tells me that something bad is happening. Going to be really interesting to hear from those smaller banks.
Enhance.
Let's talk about some individual movers today. I want to start with Levi Strauss. The quarterly revenue came in light. That led the company to take a, quote, cautious approach to its projections. And you can see that shares, actually, they flipped a little bit higher. This was another name that had been down.
What were you looking at back there?
I was just looking at the screen, you know.
Okay.
It's sneaky. But yeah, now shares a little bit higher, had been down about 3%. Let's also talk about Pioneer Natural. Of course, we know the story there. According to people familiar, Exxon nearing a takeover of that company for about $60 billion.
Yeah.
Could be completed in the coming days, according to the Wall Street Journal.
Talking about like one of the biggest deals of the century in this space.
I know. It's going to be fascinating to watch. And let's talk about MGM quickly. Of course, we know that computer hack. They said recently it's going to reduce third quarter profit by about $100 million. Stock has been slammed. Maybe we're seeing some of relief sort of bounce today because shares are up 6%.
Yeah, interesting though that you're not seeing as much juice out of Clorox, which of course also said it was hurt by those shares up 1%, but nowhere near being able to recoup the losses from the previous days. All right, guys, we are about 1 hour away from the closing bell. Sit tight. Our cross-platform coverage counting you down to the close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic here alongside Katie 555 Greifeld. We're joined right now by our colleagues Carol Masser, just mentioned in today for vacationing Tim Stenovic. Carol, if you don't know, don't ask. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and on YouTube. As Carol Masser talks over me, I don't like when the tables are turned, Carol Masser. I will say this, though. Let's talk about the market here, because the tables really did turn there. Off of the back of that jobs report, the knee-jerk reaction was to the downside, but that flipped in a big way by the time we got to the start of the close.
Yeah, I have to say, listening into surveillance this morning and thinking, okay, it's going to be a certain tone in the markets today, and then we turned around. Having said that, I feel like this is the conundrum that is 2023. As the markets, get a certain piece of economic data or some news, if you will, from the Fed or some Fed speak, and we go one way, and then we kind of can switch gears if something new comes out. Having said that, great piece on the terminal that talks about this 5% bond market environment and how it will impact everything from M&A. We're already seeing it play out in the housing market. So much going on, Jess.
And especially when you're looking not just what's happening in the U.S. with the 10-year Treasury yield, but also some of its counterparts overseas, Germany, as well as Japan, getting close to that 5% threshold there. And it's interesting, the other day I wrote a piece where there was a chart in there looking at the earnings yield for the S&P 500, basically on par when you're looking at its counterpart there, what's happening in the bond market. And so really, basically, you can earn more money elsewhere at this point. But then you look at today's big rally, what's going on there, right?
Jess, I actually wrote that same story about last month. If you look at 6-month Treasury bills, I mean, basically
I wrote it 5 years ago.
In the bond market right now, you can find way more competitive yields and earnings than you're actually getting in equities. But to the point that, something will break. I saw, I think it was Mohamed El-Erian come out and say that yields at 5% or where the Fed is going, something will break. Clearly, the job market hasn't broken yet.
Okay. Well, yeah. Well, that's part of the issue, though. I don't know. I mean, you can look at the jobs report today and you can say, okay, it was a good jobs report. Doesn't that provide the narrative for the soft landing? Or you look at that jobs report and you say, oh my God, 336,000 jobs created. The Fed has to hike about 20 more times.
Well, but it's interesting, right? And we got the headline on non-farm, and I think it was such a shocker because it blew away any estimate that was out there. But right, we talked about average hours worked remained flat and below last year's surge. We talked about, that's of course the household surgery.
Oh, no.
Well, it could feel like surgery. The household.
What do you think Carol Masser is doing in her household at night when no one's watching?
I don't, probably something
I walk
cool.
a lot of dogs. I do a little bit of dishes.
That sounds fun.
And I read in.
If
why
I
are
say,
you asking?
How many dogs?
Why am I asking?
I have 2 now.
Wow.
Because you are just a riddle wrapped inside a mystery, inside an enigma, and we want to know more about you, Carol.
The other thing is, speaking of enigma, though, that jobs report today, right? The headline saying one thing, and then as we dig deeper into the participation rate, maybe, this is why many are saying that the market has kind of turned around here.
Well, also, really, when you're looking at those wage pressures easing more so compared to when you're obviously seeing still that strength in the labor market there. But I wanted to point out when you're looking at the Goldman Sachs most shorted stocks, that basket, it's actually up more than 1%. And then also the non-profitable tech stocks, which have really gotten hammered in recent weeks, those were up more than 1% too today.
Yeah, there's a lot of bets sort of blowing up right now, of course, as the market, again, we were all coming in and we expected a certain reaction. We got something different. I mean, that's the headache for a lot of money managers right now as well.
Yeah, and it gets back to that whole idea of just the volatile nature of this. And we should point out that volatility keeps a lot of folks on the sideline, whether the market's going in the green or in the red. The fact is, a lot of people want to see stability before they come back and make any sort of conviction bet.
Yeah. You know who likes volatility, though?
No.
Traders.
That's true.
Oh.
Silver lining.
On that note.
On that note. All right, we'll be back in less than an hour's time. Our cross-platform coverage. We're going to wrap up
the sounded true.
We're going to wrap up the trading day and the trading week. Join us, Radio, TV, YouTube, and Bloomberg Originals. Join us for Beyond the Bell at 4 p.m. Wall Street time.
We continue our markets coverage right here.
to me says we're in for a near-term rally. Maybe nothing huge, but 3-4 days, a move back to the 21-day moving average at 43.60, or even, if we really get a head of steam, maybe up to 4,400. I still think we're in bearish conditions, but the pattern over a lot of rallies or a lot of sell-offs is, you sell off, you get a little bit of a bounce, you sell off, you get a little bit of bounce. This looks like we're due for one of those little bounces.
Well, in fact, if we go into the Bloomberg terminal, you make a really good case, because while the one-year uptrend has been broken to the downside, there appears to be this other little rally that's presenting itself, and that's actually not the chart we were talking about, but it does appear as though we could get up to those levels that you were just talking about. What's the impetus here? Is it the fact, Romain was mentioning that at the highs, the 10-year yield was up 17 basis points. Is it the fact that we're off of those levels? The other day we saw 488, so stocks digesting these higher levels, at least for now?
Yeah, I think it's a combination of money flows, technical levels, and things just maybe got overdone on the interest rate side. They got way overdone this morning when the news came out. We've now bounced off the 200-day moving average 4 days in a row. There was a ton of open interest at that 4,200 strike for October in SPX. Yep. That's producing a natural floor as well. And so you've got a combination of money flows and technical levels putting in a floor, and then interest rates kind of made that top out, and people dove in, and as soon as they started to back off, money poured in, and like I said, it looks like it's continued to happen.
Well, it's funny. I'm taking a look at this chart that we just put together earlier, that near-term bullish range. It actually, I don't know, it looks a little heavy there. So the bearish break may just hold, but maybe we get a couple more days, to your point. Mark, in terms of the VIX, everybody earlier this week was talking about this slight inversion of the VIX, and we all know that, well, many of us know that backwardation. That means that it's typically accompanies into some sort of a capitulation bottom. What is the VIX telling you now? Do you think that we're going to go back toward real complacent levels, or are we going to hang out here at the current 17 level or so?
Well, I think it could pull back a little bit back to 16. We're going to need to see a little follow through, more than a day or two, for, I think, us to get into the 14s, 13s again. But the VIX curve is back in contango, meaning the front end of the curve is trading at a discount to the back end of the curve. That's generally is bullish for markets, but we've been fluttering about between flat, contango, flat, and backwardation. So VIX is kind of showing it's still trying to figure out exactly what's going on. Yep. We got this close on multiple occasions of really flipping into backwardation. Right. That would have been a sign that things are bad, but we seem to have pulled out of it.
Yeah, new tea leaves, and next week will be a new week with CPI and earnings kicking off for the banks. Mark Sebastian, CEO of Option Pit, thanks for joining us for Options Insight today. And from New York, this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the close. Katie, it's been an incredible week here when we talk about the volatility in the equity space. But I also want to point out, we talk about the sell-off in treasuries, which we should point out has still continued. The jump that we've seen in yields, 20, 21 basis points on the 10-year this week alone here. And the volatility between Monday and today, just absolutely phenomenal.
Yeah, I'm a little bit tired, I have to say. It's been a long couple of days, long couple of weeks, really, when you think about this bond sell-off. But the equity market, it's actually going to snap its weekly losing streak, the S&P 500. A lot of those gains just coming today, flipping it back to positive.
Yeah, absolutely. You take out today's gains, even another half a percentage point out of some of those, and we're actually back down into the red on the week. But I think some folks will take the reprieve, particularly because we're heading into what, of course, is going to be the start of an earnings season towards the end of next week, where we're going to hopefully maybe get a little more clarity as how these companies are doing.
Don't forget inflation, too.
Is that coming again?
It's next week.
I'm off
This is
that
Bloomberg.
day.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Patriots, you're not selling the packaging company. I guess you don't like to sell things, right?
I really don't. We try to create a family environment in everything we're involved in. People want to be part of something that's bigger than themselves.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is the countdown to the close. About 30 minutes left to go here, Katie, in the day and in the week.
In the day and the week, and what a way to end the week. You look at the S&P 500 right now, currently up about 1.5%. You look at the circle behind me, and it's pretty much all green. Almost every single sector in the green right now. Big tech leading the way. Information technology up about 2.3%, closely followed by communication services. Then we have industrials, utilities. The list goes on. You look at what's not participating in this rally, there's only one sector to speak of. Consumer staples currently off by about 0.4%, Romaine.
Yeah, let's take a look at some of the individual movers out there on the day and on the week. Actually, one of the big movers is Edwards Life Sciences, actually at the top, near the top of the list here on a weekly basis, a 2.5% gain, aiding in that as well. Advanced Micro Devices also getting a nice bid here on the day. In fact, a lot of the names in the tech space, particularly in the semiconductor space, are showing their mettle here, not only on the day, but on the week as well. Meanwhile, two interesting stories. First on Sleep Number, an interesting downgrade today. Analysts really concerned here about some of the foot traffic trends that they've been seeing in the retail space, not only specifically for Sleep Number, but for a lot of other peers in that space as well. So keep an eye on that, and keep an eye on Pepsi. The shares were actually down on the day. They've actually been lower in about 12 of the last 15 sessions here, actually down more than a 10% here since the all-time highs that they hit earlier this year. And a lot of that has to do about something we're going to talk about a little bit later, and that's the growing popularity of these weight loss drugs, and whether, well, if we're all losing weight and on those drugs, we're in theory not going to be eating as many snacks, candy, and sodas and other things here. That could have a material impact on fundamentals as we head into an earnings season. And as we head into that earnings season, which does start towards the end of next week here, this is actually going to be in focus here. What you're looking at right now is the cash balance in the S&P 500 on an aggregate basis. And of course, what most investors want to know is, are they going to get some of that cash? Whether it's going to be through buybacks, whether it's going to be through dividends, or maybe some sort of reinvestment that ultimately would mean greater returns for investors remains to be seen here. But there is a big cash pile sitting here right now that has to be deployed, or at least investors want to see deployed, Katie.
Well, let's go from that cash pile to my favorite place to hang out, the ETF world, because I'm thrilled to say that the money manager behind the largest active ETF in the industry launched a new fund last week, the JP Morgan Hedged Equity Laddered Overlay ETF, or HELLO, is geared towards investors bracing for a period of uncertainty. Joining us now, I'm pleased to say we have Hamilton Rayner. He is Managing Director and Head of U.S. Equity Derivatives at JP Morgan Asset Management. Hamilton, it's great to see you.
Hello.
On this, hello, that's cute. So before this segment actually started, you said today is the day, the type of day for why you actually launched this ETF. Tell us a little bit about it.
Sure. So thank you for having me. This morning at 8:30, we have an unemployment number, and immediately the market sold off precipitously, down about 35 handles in the S&P. And as you just said, if you look at where we are today, we're up about 1.5%, over 60 handles, a 95 handle swing in a day. And the idea of a hedged equity strategy is not about rooting or wanting the market to go down, but helping people get invested and, more importantly, stay invested. So imagine that person that went into their machines and sold stuff this morning at 9:31 or 10 o'clock. They've left all of this on the table. So it's so important to help people get invested and stay invested.
So get invested, stay invested, but of course, because this is a heavily hedged approach, that means that you potentially miss out on the upside. If we were to enter into a really roaring bull market, which maybe it looked like we were in over the summer, you would leave some money on the table. What is the conversation that you have with your potential investors about that?
So Romaine just talked a little bit about the amount of cash that corporates have. The amount of cash that is in individual investors right now is unprecedented. I think the number is over 30% in cash. And cash isn't trash, but you can't retire on cash. The average number is about 20%. So what we're talking to clients about is, how about getting some of that cash off the sidelines and get it to work for you in the equity market? Are you willing to forego some of the upside of the equity market in return for having all the downside? You're going to get a lot more yeses than nos.
I am curious, though, as to what you think maybe sort of breaks the stasis that we've seen. There's a lot of people, they're scared to come back into this market, or at least scared to commit any new money into the market, primarily because of the volatility.
So it's interesting. If you look where the S&P 500 volatility is, the VIX, it's about average. I think last I looked, it was about 17, 18. Long-term average is 16 to 18.
Yeah.
What's really interesting, though, is there's this index that you guys are familiar with called the MOVE Index, the fixed income, the volatility of fixed income. Long-term average of that is 80 to 85. It's about 130. So fixed income is a great asset class. Bonds are back, absolutely. but they're not with no volatility. So when think about building a portfolio, it's about balancing return with risk. And so owning a hedge equity strategy or owning some equities actually don't add as much volatility as you would think relative to long-term history.
Well, this may be a dumb question, but like with something like Hello, if you incorporate that into a broader portfolio here, does that, to a certain extent, and I know it'll vary depending on the client, does that actually lower the risk profile?
It depends where you start, where you fund it from.
Yeah.
If you think about, there's two different things. If you have a 60-40 portfolio, then you would take 10 from the 60, 10 from the 40, and it keeps your volatility risk profile the same.
Okay.
But if you have a portfolio that's 50, 30, 20, and you take it from cash, you actually increase your risk a little bit, but you're still below that long-term 60-40 risk profile. Or if you're overweight duration and you take it from that, you're actually kind of keeping volatility pretty similarly. So the starting point is not what, is making sure that your risk profile stays similar.
Well, on the topic of cash, you made the point that you can't retire on cash. And if you look at a product like Hello, is that really who you're targeting? Is it more people thinking about, what they're going to live on, their retirement accounts? Who is the ideal investor, do you think, for this product?
So the ideal investor is somebody that just wants to own more stocks, right? I mean, we want people to own stocks, but in a more conservative manner. So if you have, if you guys are fully invested in stocks, God bless you. Don't buy Hello.
Yeah.
But there aren't that many people that are either all in on stocks and not just a little bit nervous, as you said, Romaine. So my ideal investor is someone that wants to own a little bit more stocks, but do it in a more conservative
I mean, I sort of laugh because I remember, I probably shouldn't share this, a couple of years ago, kind of before the big jump in yields here, I was looking at my allocation of my own portfolio, and it was very heavily weighted towards stocks, very little in bonds.
And if you kept it, you're doing just fine.
Very little in bonds, and then I was like, I don't want any bonds, and of course, that looks pretty ridiculous now in hindsight. But I do wonder about the competition, right? The idea that if we are in a new rate regime here, and you can actually get, at least on a yield basis, some significant return by holding bonds in a much broader portfolio.
So I'm pro bonds. I think bonds are a great asset class. However, when you think about bonds historically, there's two things you've expected from bonds. Number one, income.
Yeah.
We got income now, Romaine. It's pretty darn good.
Okay.
But number two, you expect an
Because I'm closer to retirement age than I look, so I'm a little worried here. So,
but what's interesting is life expectancy has gone on, so you're going to live longer than you thought. You can't just go to cash, Romaine.
Oh, gosh.
And the other thing you expect from bonds is something that's going to zig when markets zag. And that's kind of left us at the altar last year, this year, and many, many times. So if you want to have something that will zig when the market zags, the combination of an equity portfolio combined with a bona fide hedge that will zig when the market zags actually helps people get invested, stay invested. So life expectancy 10 years ago was in the 80s. Now it's in the 90s. People need to own riskier assets later in life. That's somebody that we want to own the strategy.
You've got to own stocks, and you've got to keep working. That's the future.
Thank you, Katie.
Hamilton, it's great to see you. Thank you for joining us. That is Hamilton Rayner of JP Morgan Asset Management. Now, coming up on the close, beer and candy stocks, they're going down after Walmart says it's feeling the impact on shopping demand from people taking Ozempic, Wegovy, and other appetite-suppressing medications. There are stocks of the hour coming up next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Close. It's time now for our stock of the hour. We're taking a closer look at some of the beer and candy staples out there. Interesting comments by Walmart earlier this week saying that it's seen an impact on shopping demand for a lot of snacks and stuff because of those folks who are taking weight loss drugs like Ozempic and Wegovy, basically appetite-suppressing medications. And there's some concerns that this could have a longer-term impact on food and beverage companies like Mondelez, like Pepsi, even Kellanova, the company behind Cheez-It and Pringles. Instead of naming their company Cheez-It or Pringles, they named it Kellanova. That's a whole nother conversation, but John Edwards is joining us right now. Talk a little bit more about this. Yeah. I'm actually fascinated by this because
as are we, yes.
It sort of makes sense, but I feel like the market reaction seems to be a little premature. I mean, I understand that okay, if you're on this drug, you're not going to have the cravings for some of these things, at least in theory. But are we taking these drugs already at such a mass scale where I need to start re-rating PepsiCo and Mondelez and all these other names?
Yeah, see, I think not quite yet.
Yeah.
You know, the key phrase in your intro was longer term.
Okay.
So, you know, companies are definitely trying to position themselves for when these drugs become, you know, more prevalent in the market, or, you know, or the use becomes wider, but they're not quite there yet. So I think some of, you know, to make, you know, day-to-day stock trading decisions based on comments right now is, I think, a little early.
Have you tried this drug yet?
I personally
what
have not.
You, Katie? I mean, I just want like a sample. You know how they sometimes give you samples?
Just like a little
just to see.
bit,
I want to see.
the weight loss drug.
Yeah, I don't know.
I don't know. It could be interesting. No, I have not tried it, but I understand that if you make candy or beer that your shares would go down theoretically. But what would this mean for Walmart theoretically? Would they actually benefit from this when you think about their pharmacies?
Yeah, well, they're saying that they're already seeing a benefit in the pharmacies. They're already getting, you know, a lot of prescriptions being filled there. And they're saying that, you know, while they are starting to see among those users some pullback in food shopping, they expect to, you know, maybe make that up on the apparel size as people, you know, have to resize and, you know, get new pants.
Oh,
yes.
see that?
Really looking.
Well, that's just it. I feel like a department store, which effectively what Walmart is to a certain extent, would benefit, or at least would have the ability to sort of buffer whatever it loses, and you buying, you know, snacks and things like that. But I do want to go back to PepsiCo because I was just going through just the decline in that stock. It's been pretty significant, 19% from the all-time highs. And just in the last 3 weeks alone, they're down like 10%. And it seems to be directly related to this.
Yeah.
Now, they're a little bit more of a monolith because they make their money off snack foods.
Right.
Yeah.
Yeah, but, you know, for right now, snack foods are one of the growth areas in food in general. So,
which is why we all need to be on Ozempic and Wegovy.
Well, exactly.
Yeah.
But, you know, I think, you know, not to, you know, give investment advice or anything, but I think it does seem a little early to be selling these stocks off based on this when, the projections are for deep penetration
I am curious,
years out.
have we heard from any other companies that have spoken explicitly about this other than Walmart?
Well, as you mentioned, Kellanova's CEO did talk to us about the fact that they are, this is the former Kellogg company that has spun off their cereal operations.
Yeah.
They talked to us about how they are, watching it closely, getting ready in case they need to make some changes, but obviously not doing a whole lot just yet.
All right. John Edwards, the third there, who helps lead our consumer coverage here at Bloomberg. A look at some of the stocks that could be affected here by the trend of everybody trying to eat less and lose weight. Coming up here, we're going to focus back on the broader markets, back on the economic data. Ed Yardeni going to be joining us, President and Chief Investment Strategist over at Yardeni Research.